for Public Service Commission hearing in docket 1957-2, application of Dominion Energy Utah to increase distribution rates and charges and make tariff modifications. This is the Phase 1 hearing. We also have a public witness hearing today starting at 6 p.m. Are there any preliminary matters before we go to appearances? I'm not seeing any indication, so why don't we start with appearances for the utility.
Thank you. My name is Jennifer Nelson-Clark. I'm counsel for Dominion Energy Utah. Mr. Cameron Sabin is also here as counsel for the company. We have Alan Felsenthal, Robert Hevert, Kelly Mendenhall, and Jordan Stevenson here as witnesses for the company, and all have filed pre-filed testimony.
Okay. Thank you. For the Division of Public Utilities?
Good morning, I'm Justin Jetter with the Utah Attorney General's Office. I'm here today representing the Utah Division of Public Utilities. The division intends to present 5 witnesses at this hearing: Douglas Wheelwright, David Thompson, Jeff Einfeld, Eric Orton, and Casey Coleman.
Okay, thank you. Mr. Moore or Mr. Snar?
Robert Moore of the AG's office, representing the Office of Consumer Services.
And Stephen Snar with the AG's office, also representing the Office of Consumer Services.
We have 3 witnesses today, Allison Anderson of the office, Donna Ramses, and Daniel Lawton.
Okay, thank you. Mr. Meekum?
Steve Meekum, representing the American Natural Gas Council, and I have Mr. Bruce Oliver as our witness who will testify in this hearing.
Okay, thank you. Major Kirk?
Good morning, Major Scott Kirk with U.S. Air Force on behalf of federal executive agencies. And today we'll have one witness, Michael Gorman with Brubaker and Associates.
Okay. Mr. Russell?
Thank you. Philip Russell on behalf of the Utah Association of Energy Users. We will have one witness, Mr. Kevin Higgins.
Okay, thank you. We have 2 interveners who did not file testimony in Phase 1, Nucor Steel and U.S. Magnesium. Is anyone in the room planning to participate in any way from those 2 interveners? I'm not seeing any indication. Okay, with that, I think we'll go to Dominion Energy Utah for your first witness.
Thank you. The company calls Kelly B. Mendenhall.
Good morning, Mr. Mendenhall. Good morning. Do you swear to tell the truth?
Yes.
Thank you.
Good morning.
Good morning.
Could you please state your name and business address for the record, please?
My name is Kelly B. Mendenhall, and my business address is 333 South State Street, Salt Lake City, Utah.
And what position do you hold with the company?
I'm the Director of Regulatory and Pricing for Dominion Energy Utah.
Mr. Mendenhall, did you file direct testimony in this docket labeled as DEU Exhibit 1.0 with accompanying exhibits DEU Exhibit 1.01 through 1.15?
Yes.
And did you also file pre-filed rebuttal testimony marked as DEU Exhibit 1.0R with accompanying exhibits 1.01R through 1.05R?
Yes,
And do you adopt those documents as your testimony today?
I do.
The company would move for the admission of DEU Exhibit 1.0 with accompanying exhibits, DEU Exhibits 1.01 through 1.15, as well as DEU Exhibit 1.0R with attached exhibits 1.01R through 1.05R.
Okay. If any party has any objection to that motion, please indicate to me. And I'm not seeing any objection in the room, so the motion is granted. I did forget to mention, we do have some confidential exhibits in this docket, not much confidential testimony, but some confidential exhibits. And so, again, like usual, I think we're going to rely primarily on the counsel in the room to inform us if a witness starts to go somewhere on direct. You should know, but if things start to go in a certain direction on cross-examination, please try to keep us apprised of that as we move forward.
Thank you. Mr. Mendenhall, can you summarize your testimony in this docket?
Certainly. So in my testimony, I discussed 3 issues. I discussed the merger commitments, the infrastructure tracker mechanism, and the level of equity that the company is proposing. In my direct testimony, with respect to the merger commitments, I provide evidence that the company has complied with all the merger commitments in docket 16-057-01. And in my rebuttal testimony, I provided evidence in response to concerns raised by the division that the company is meeting all of its customer service goals with the exception of 2, goals that are related to the transponder replacement program. And a remediation plan for those two goals was approved and put in place in docket 19-057-25. And the company expects those two metrics will be in compliance by September of next year. With respect to the infrastructure tracker, I made 3 proposals to that program. First, I proposed to change the filing date of the master list from April 30th to June 30th. And that was to allow our mapping department to have extra time to compile the data to make that report. No parties commented on that proposal. The second proposal was, I proposed to change the way overspent amounts are handled from year to year. And parties seem to be generally in agreement with that proposal. And the third proposal I made was to increase the infrastructure tracker amount from $72 million to $80 million. And that was, I provided evidence showing that the construction costs of the program are outpacing the GDP deflator rate that is used as an inflation rate in that program. And as a result, the company needs to increase that level of spending to $80 million to continue to make a prudent amount of investment. The OCS, DPU, and UAE objected to that proposal. Their arguments were mainly based around the fact that they determined that the company should just be able to shoulder those additional costs in between a general rate case. And I provided evidence in my rebuttal testimony that the company is currently already incurring capital expenditures of about $90 million per year outside of a tracker and shouldering those costs in between a rate case. And so to add an additional $10 million to that just seems unreasonable. Additionally, I provided some additional evidence related to inflation rates. I compared an additional 6 of inflation factors from Global Insight that are based on mainline construction with the GDP deflator and showed that on average over the last 9 years, those inflation rates are outpacing the GDP deflator rate by 200 to 300%. With regards to equity, in my rebuttal testimony, I addressed the proposals by Mr. Gorman and Mr. Oliver to reduce the proposed level of equity that the company is asking for, which is 55%. And I think it's important to take a step back here and look at why we are at 55%. And so I want to direct your attention to a few of my exhibits. If we can start in my rebuttal exhibit, DEU Exhibit 1.02R. And DEU Exhibit 1.02R is actually a rating action that Moody's submitted in January of 2018. And the rating action title is Moody's Changes Outlooks on 25 U.S. Regulated utilities primarily impacted by tax reform.
1.02R
1.02R, yes.
to your direct,
To my rebuttal.
to your rebuttal.
Yeah. Yeah, so Exhibit 1.02 and my rebuttal testimony. Okay, so if we just start at the beginning of the report, the first sentence, it says Moody's Investor Services has changed the rating outlooks to negative from stable for 24 regulated utilities and utility holding companies. Then if we go down to the section right below it called Ratings Rationale and read the first sentence, it says, today's action primarily applies to companies that already had limited cushion in their rating for deterioration in financial performance, will be incrementally impacted by changes in the tax law, and where we now expect key credit metrics to be lower for longer. And then if we move down to the next paragraph, beginning of that paragraph says tax reform is credit negative for U.S. regulated utilities because the lower 21% statutory tax rate reduces cash collected from customers, while the loss of bonus depreciation reduces tax deferrals, all else being equal. Moody's calculates that the recent changes in tax laws will dilute a utility's ratio of cash flow before changes in working capital to debt by approximately 150 to 250 basis points on average, depending to some degree on the size of the company's capital expenditure programs. I will point out that Dominion Energy Utah has one of the highest growth rates in the country. We also, as I mentioned earlier, are replacing a fair amount of pipe on our system, and so we have high capital expenditures, and the elimination of that bonus depreciation definitely put strain on our credit metrics. If you turn to the next page, page 2, Moody's lists the 24 companies that are that's concerned about, and if you go down 2/3 of the way to that page, it's actually the 11th utility. You can see issuer Questar Gas Company outlook changed to negative from stable, and Questar Gas Company is actually the legal name of Dominion Energy Utah. So that occurred in January of 2018. So I'd like to turn next to my exhibit in my direct testimony, which is DEU 1.05. And DEU 1.05 was a Moody's credit opinion that was issued on January 30th of 2019. And if you go to page 1 of that exhibit, there's a section, the beginning section is called Summary. If you go down to the second paragraph, I'm going to read that paragraph. And it reads, the Questar Gas credit profile is constrained by 1, very weak financial metrics versus peers, 2, a base rate freeze and tax reform impacts that will reduce cash flow metrics through 2020, and 3, a highly levered parent company. So I want to talk about that second point, the base rate freeze and tax reform impacts. While this has been a credit strain to the company, it's been very beneficial for customers. So if we talk about the base rate freeze, as we all know, in 2016, as part of the merger, the company withdrew a $22 million rate case. And it's hard to say what the result of that rate case would have been, but I think it's safe to say that it most likely would have resulted in some sort of increase for customers. That combined with the fact that the company agreed to stay out of a rate case until 2019, I think has been beneficial to customers. Although it's, I will admit, difficult to quantify. I think something that's a little easier to quantify is the impact of tax reform on customers. Reducing that tax rate to 21% has definitely been a benefit to customers, and to the tune of about $20 million per year in reduced rates. The company, when tax reform was passed, willingly came forth, made the appropriate filings to return that money to customers, and it's been a benefit to customers. If you look at the other side of the equation, if we turn to page 3 of that document, DEU 1.05, and the second section on that page is called Weakened Cash Flow Will Persist Over the Next 18 Months, but Managing Financial Policies Should Help Improve Metrics. And if you go to the second paragraph in that section, and it's the last sentence in that section, I'm going to read it. It reads, in January 2019, Questar Gas received commission approval to exceed the 55% equity layer of capitalization that was ordered in the 2016 merger approval. This should help stave off the pace of increasing debt during the cash flow stagnation and keep CFO pre-WC to debt and CFO pre-WC less dividends to debt between 16 to 18%. So we were able to appreciate the work of the other parties in this particular instance to allow the company to go over 55% level of equity. So currently we're at about 60%. We're projecting about 60%. And that difference between 55% and 60% is about $8 million. And so we're asking right now shareholders to fund that, to shoulder that cost. And so now if you look at $20 million of tax benefits to customers, asking shareholders to shoulder $8 million of equity, I think it's unreasonable for the company to not be allowed its 55% level of equity. So I'd like to turn finally to, in my rebuttal testimony, DEU Exhibit 1.01R. And DEU Exhibit 1.01R is a credit opinion that was issued by Moody's on August 19th, 2019. And the title of this report is Questar Gas Company Update Following Downgrade to A3. And so in this report, Moody's downgrades the company from A2 to A3, which is still investment grade. But I'd like to direct your attention to page 2 of that report, where it lists as credit challenges: base rate freeze through 2020 and tax reform impacts will weaken financial metrics. So the two things I mentioned earlier in January are still a concern to Moody's. Elevated capital spend over the next 3 years, and a highly levered parent that carries higher credit risk. And then if you move down to the section that says factors that could lead to a downgrade, there are 2 items: cash flow to debt metrics below 16% on a sustained basis, and if regulatory support or the ability to recover costs were to decline. So I think the proposal by Mr. Gorman and Mr. Oliver to allow the company a 50% level of equity or 52% level of equity that is below the level of equity that the company is actually incurring would fall in that category. The ability to recover costs. If that were to be approved, we would not be able to recover those costs. One last item I'd like to draw your attention to on page 4. The first section there is called Supportive Regulatory Environments with Key Cost Recovery Features. If you go down to the 4th paragraph of that section, it states, in July, Questar Gas filed for its first general rate case increase since 2014 with the PSCU. The filing requests just over a $19 million annual revenue increase based on a $1.8 billion rate base with a 10.5% allowed ROE on an equity layer of 55%. The filing also requests a continuation of the infrastructure rider and the recovery cap be raised to $80 million per year. The latter would be credit positive since it would maintain an important element of predictable cost recovery. So where disallowing those equity costs would be a credit negative that could lead to a downgrade, they point out that approval of the tracker to $80 million would actually be a credit positive. The last thing I discussed in my rebuttal testimony related to the 55% is I talked about commission precedent. And in the 90s, when rate cases were litigated, the commission ordered that the company's actual capital structure should be used. Since 2000, most of the cases have been settled, but those settlements have been based on equity levels that were at the company's actual capital structure. So I think commission precedent also points to the approval of a 55% level of equity. So that concludes my summary.
Mr. Mendenhall is available for cross-examination and commission questions.
Thank you, Mr. Cheddar. Do you have any questions for Mr. Mendenhall?
I do. Good morning.
Good morning, Mr. Jetter.
You stated in your testimony that the company is committed to maintaining safe, reliable service and taking whatever steps are necessary to do that. Is that
correct?
Accurate. You've also stated that the proposal to replace additional high-pressure pipe outside of the tracker would be unreasonable.
Correct.
Did you replace pipelines, including high-pressure pipelines that may have been at risk before the tracker existed?
Yes, we did.
And was that unreasonable?
No, it was not.
If the tracker didn't exist, would you continue to replace those pipelines?
Yes, and the result would be we would most likely be in for rate cases more often. I think all of the parties have testified in this case that the tracker program should continue because it's a good balance between cost recovery for the company, and keeping customer rates stable.
Thank you. Well, and so over the past 6 years since the last rate case, the company's been replacing additional pipe outside of the tracker, is that correct?
Correct.
And during that period, has the company been significantly under-earning as a result?
They've been under-earning, yes.
Um,
And I think also, if you review these credit agency documents that I talked about, I think it's also put pressure on our credit metrics.
And so would you then intend to stop any of those additional necessary pipe replacements if the tracker was retained at its current level?
No. But as I mentioned, it could cause us to be filing rate cases more frequently, which adds additional administrative burdens and costs to everybody.
Thank you. Those are the only questions that I have.
Thank you.
Thank you. Mr. Moore or Mr. Snar?
We have no cross-examination of Mr. Mendenhall.
Thank you. Major Kirk?
No questions.
Mr. Meekum?
Just a couple, thank you. Mr. Mendenhall, you mentioned that in the Moody's report of January 2019, one of the considerations was that the parent company was higher levered. How is it leveraged today? How is it different? Is it higher? Is it lower? What is it?
I actually am not sure, but one of the nice things, if you read the entire report, is the Moody's also cites all of the ring fencing provisions that the company has that resulted from the merger that help protect it against the or from its parents' potential leverage.
So they're not as concerned about that, is that what you're saying by the ring fencing?
I think the ring fencing helps to offset that concern.
But it was a concern in January 2019.
Right. Why don't we turn to the report and I can walk?
No, I don't need that. Okay. Then you referred to 1.0, let's see here, 1, I think it was.
1.01R,
Under
the downgrade.
your detailed credit considerations, support a regulatory environment with key cost features. Page 4, I think it was, you referred to.
Yes,
Yeah, 101R.
yes.
I'm not sure your microphone's on, Mr. Meekum.
I think it's just not close
Not
enough.
close enough. Okay, thanks.
Under the paragraph entitled, despite current rate case, financial metrics expected to remain lower than historical levels.
Correct.
You see that?
Yep.
And then in the second part of that paragraph, it says, however, we also think it likely that the ultimate order of this commission, I put that in parentheticals, will authorize an allowed ROE and equity layer that is less than the company's request of 10.5%, allowed ROE and 55% equity layer, since these levels are high for what the commission has allowed for rate-making purposes.
Correct. And if you read the first sentence, it says, we assume that the Utah rate case will boost Questar Gas's rate-based net income and cash flow since the company has not received a base rate increase since 2014. And none of the parties in this case, other than the company, are proposing an increase in net income or revenue.
But you see that they're clearly considering what this commission will do, and apparently they're expecting something lower than what you're asking.
Yes.
Okay, thank you. I think that's all I have.
Thank you, Mr. Russell.
Thank you. Just a couple of quick questions about the infrastructure tracker
Sure.
spending cap. And I think it may be useful to turn to page 21 of your direct testimony.
Sure. Page 21?
Yeah.
Yes.
All I'd like to do at this point is just walk through the history of that spending cap. My understanding is that the spending cap was initially set when the infrastructure tracker pilot program was approved in the '09 docket, and that spending cap was initially set at $55 million annually plus inflation. Is that right?
Correct.
And did that run through the 2013 year?
Yes, it did.
I asked that because of your footnote 4 at the bottom seems to indicate that it did, but it wasn't clear to me.
It did, yeah.
Okay, and then in the 2013 rate case, the infrastructure tracker spending cap was increased, I gather, to $65 million plus inflation.
Right, and that was to include IHP mains as part of the program, whereas before it was just a basket of high pressure pipes.
Sure, and then you've got this table that runs from the bottom of page 21 onto page 22.
Right.
The column that says budget, is that the spending cap for that year?
Yes, it is.
Okay, so it shows a budget of $59 million in 2013. 2014, we hit that $65 million mark, right?
Right, and the reason why the budget was high in 2013, I mean, it looks like the budget was 59 and we spent 54.9, is because when the program was originally approved in 2009, we actually weren't using the GDP deflator. We were using the steel index, which was a much higher inflation rate. And so as a result, we were seeing higher increases in that cap. In the 2013 case, through settlement, it was determined that in steel inflation rate should be replaced with the lower GDP deflator rate.
And we can see for each year following that 2014 year what the budget was. And does the variance in those numbers, is that just up to inflation for that year in those budget numbers?
I'd have to go back and look, but my guess is it probably had to do with scheduling of projects, and sometimes there may be cost overruns, or there may be a city that wants you out of their streets quicker, and so that was one of the reasons why I proposed some flexibility in the way overages are handled. Was to give our engineering group more flexibility so that they could keep their customers happy, which is the cities.
Sorry, the question I asked was not the one I intended to ask. I used the word variance, which
Okay.
was not intended to refer to that last column there. I was actually just referring to the changes in the budget from one year to the next.
Sorry, so you have to
No,
repeat your question.
you're fine. I asked the wrong question. I'll ask
Okay.
it again. The changes in the budget from 2014 to 2015 to 2016, I'm trying to understand whether that's just because of inflation and any, inflation changes from one year to the next, or if there's some other,
Yeah, honestly, I don't know. It could be inflation, it could be cost overruns, it could be, we had a project that had to be accelerated, and so we moved it up one year and then spent less the next year. It could be a variety of things.
okay, fair enough. And then, do you know what the number in that budget column would be for 2019? I know we're not quite done with it yet, but.
I think it's around 70 million.
Okay, and then just finally, the increase that you're requesting in this docket is to move that budget number to 80 million?
Correct. Well, so if everything were kept as is, the 2020 budget number would be 72 million. So yes, I'm proposing to increase it from about 72 to 80 million.
Okay, thank you. That's all I have.
Mr. Chairman, may I ask one more question?
Sure.
Thank you. Mr. Mendenhall, you noted in your testimony that Dominion was downgraded from A2 to A3. Did I understand that correctly?
That's correct.
Now, if there happened to be a downgrade from there as a result of this case or something else, to one step down, have you calculated what that cost would be?
You mean on the cost of debt?
Yeah.
I haven't. But I do think it's important to point out that more important, I would say, than the cost of debt is that credit rating. Particularly, we're enjoying economic great economic times right now, but if we ever get in a situation when there's a downturn or a recession, that credit rating becomes extremely important as we try to place debt in the public market and try to meet our customers' needs. We have to be able to, there's a flight to quality, because during downtimes, there's not as much capital available as is needed. And so that credit rating becomes extremely valuable during those times.
But did I understand the difference between 55% and 60% equity ratio was about an $8 million value?
Correct.
So you know the 5% difference is an $8 million value, but a downgrade would be something far less than that, would it not?
I don't know. I have not calculated that.
Thank you.
Okay, thank you. Any redirect?
No redirect, thank you.
Okay, Commissioner White, do you have any questions for Mr. Mendenhall?
No questions, thank you. Thank you.
Commissioner Clark?
Good morning.
Good morning.
Regarding the reference to the parent company and its being highly levered,
Right.
and that being a constraint on Questar Gas's credit profile, the first reference, I think, in the Moody's reports that I'm seeing was in a report dated 22 December 2017. And
Okay.
I note that for you just to assist maybe with the point of my question,
Sure.
which is, has the leveraged status of your parent company changed since the merger in any material way?
Yeah, and I might be able to direct you to a paragraph, if you give me one moment, as I was reviewing this last night. Yes, if you turn to 1.05, DEU Exhibit 1.05, and this is once again the January 2019 credit opinion, credit update. And this is talking about exactly your question. So if you turn to page 4 of that report, there's a section that says parent contagion risk reduced by utility ring fencing type provisions and de-risking events in 2018. So I think everyone's familiar with the ring fencing provisions that were set in the merger. But if you go to the second paragraph of that section, it says, moreover, Dominion made significant progress toward lowering its business and financial risk in 2018. Some of the key features include the reduction of holding company debt by around $8 billion, $5 billion on a consolidated basis by way of selling 3 merchant power generation plants and its 50% interest in Blue Racer BA1 stable midstream gas business with higher risk operations. Furthermore, the acquisition of ScanaCorp, BA1 positive, added over $800 million of rate-regulated utility cash flow to the consolidated operations and provides a more geographic and regulatory diversity going forward. So I think the answer to your question is there's been some improvements.
So it's less levered today than it was
Yes.
when the merger
Yes.
took place? Thank you. That concludes my questions.
Thank you.
And I don't have anything,
Great.
I don't have
Thank
anything
you.
else, so thank you for your testimony this morning.
Thank
Mr.
you.
Mendenhall. Yeah, so if you can call your next witness.
Sure, just didn't want to presume.
Sure.
Dominion Energy Utah calls Mr. Hevert to the stand.
And I think someone may have a cell phone too close to the microphone. We're getting a little bit of feedback. Good morning, Mr. Hevert. Do you swear to tell the truth? I do. Thank you.
Good morning, Mr. Hevert. Would you please state your full name for the record?
I think
I
you're-
don't think your
you're
mic is on. Let's try that one more time.
How's that?
That's better.
There we go. Robert Hevert. My last name is spelled H-E-V as in Victor, E-R-T.
Mr. Hevert, could you please provide the commission with a sketch of your background, education, and your professional experience, please?
Yes. And my educational background includes a bachelor's degree with a double major in business and economics with a concentration in finance. I also hold an MBA, likewise with a concentration in finance. And I hold the Chartered Financial Analyst designation. In terms of my work history, I have about 30 years of experience in regulated industries, starting first as a revenue requirements analyst at a telecommunications utility, and then spending about 10 years at a publicly traded natural gas utility. There, I was responsible for much of the company's treasury operations. So I managed its day-to-day cash flow, was responsible for issuing all long-term securities, common equity, preferred equity, long-term debt. And as part of my role as the planning function as well, I was responsible for the company's financial and strategic planning. I advised the company and had responsibility for the allocation of that capital that was raised. As a consultant, I've been involved in many transactions as well, advising companies on both the buy and the sell side of asset-based and corporate transactions. And I would say, if I considered the securities I issued as in the treasury function, the transactions I advised on as a consultant, it's been many billions of dollars worth of transactions. I also, as a consultant, have advised boards of directors on strategic issues, on dividend policy, and I've testified over 250 times on a number of issues, regulatory policy issues, transaction-related, but I would say principally regarding the cost of equity.
Thank you, Mr. Hevert. Have you submitted direct and rebuttal testimony in this matter?
Yes, I have.
I have your direct testimony as being Exhibit 2.0, DEU Exhibit 2.0, with Exhibits 2.01 through 2.11, and your rebuttal testimony as Exhibit DEU 2.0R, with Exhibits 2.01R to 2.24R. Is that correct?
Yes, that is correct.
The company would move to admit that testimony into the record.
If anyone objects to that motion, please indicate to me. And I'm not seeing any objection in the room, so the motion is granted.
Mr. Hevert, do you have any corrections to either your direct or your rebuttal testimony?
I do have a handful of typographical errors I'd like to correct in my rebuttal testimony.
Okay, please go ahead and do that now.
Thank you. The first is at page 53, and it is on line 992.
Is this your direct?
In my rebuttal testimony,
Rebuttal.
sir, I'm sorry. So page 53, line 992, equation 6 should be equation 7. On page 54, line 1000, the same correction should be made. What is labeled as equation 6 should be equation 7. The same goes for line 1008, also at the left-hand margin. Equation 6 should be equation 7. Going to page 57.
Are you, this is your rebuttal or your direct?
I am
it's your
so
direct.
sorry.
It's
This
your
is my direct
Yeah.
testimony.
So
You would
let's,
think I would know that.
that's okay. Let's start over. Just identify in your direct testimony those same lines and where you're
Yes.
making the correction.
I apologize.
No, that's okay.
So my direct testimony, page 53, line 992. Equation 6 should be equation 7.
You said the line number again on page?
992?
992
Yes, 992.
on page, oh, I'm looking at different page numbers, sorry.
That's okay. I led you astray, I apologize. Next is page 54, line 1000. Left-hand margin, equation 6 should be equation 7. Also on page 54, line 1008, equation 6 should be equation 7. Page 57, line 1070, again toward the left-hand margin, equation 7 should be equation 8. And lastly, on page 58, line 1084, equation 8 should be equation 9, and you'll be happy to know I have no changes to my rebuttal.
With those changes, Mr. Hever, do you adopt your direct and your rebuttal testimony as your testimony in this proceeding?
Yes, I do.
Have you prepared for the commission a summary of your direct and rebuttal testimonies?
I have.
Would you please go ahead and provide that to the commission now?
Yes, thank you. Good morning, Chair LeVar and members of the commission. My testimony addresses two principal issues: the cost of equity, which we often refer to as the return on equity, and the capital structure that should be used for rate-making purposes. There are theoretical aspects of both, but there are very practical aspects also that we should consider. Principally, we have to consider that utilities must compete for capital in an increasingly complex market environment. And because of their obligation to serve, utilities must be able to access that capital efficiently at reasonable costs and terms, regardless of market conditions. And as a consequence, both investors and customers have an interest in a financially strong utility. And in return on equity and capital structure set in this proceeding will have a direct bearing on that financial strength. If we turn first to the cost of equity is simply the return an investor requires to commit his capital to the equity of a firm. It is unlike debt, or the cost of debt, in several ways, one of which is we cannot observe the cost of equity. We can observe the cost of debt and interest rates, but we have to estimate the cost of equity by applying financial models to market data. Each of those models is meant to capture a different aspect of investor behavior, and investor behavior changes over time and with market conditions. As a consequence, no one model best captures investor behavior at all times under all market conditions, and that is why analysts in regulatory proceedings and analysts and investors in practice tend to use multiple models. And that is also why we look at the cost of equity typically as a range. Yes, there is a point estimate provided, but frequently the cost of equity is considered within a range. Now, my recommendation is within a range of 9.9% to 10.75%, and I've provided a point estimate of 10.5%. My range is within 5 basis points of the company's currently authorized 9.85% return on equity. The opposing witnesses report cost of equity estimates in the range of 8.09% to 9.68%, and their recommendations range from 9% to 9.5%. Now, at the upper end, the 9.5% is Mr. Oliver's recommendation. And while I do not want to speak for Mr. Oliver, my understanding is that he views 9%, which is the midpoint of his estimated range, to be a reasonable estimate of the company's actual cost of equity. He recommends 9.5% for the sake of gradualism, moving gradually from the currently authorized 9.85% to what he may consider to be the cost of capital now. In my view, the role of rate of return witnesses in these proceedings is to provide the Commission our estimates of the return investors require. That is what I've done. In my view, it is the Commission's difficult task to apply gradualism in the context of rate making. I view the cost of equity as what we are meant to provide you in this case. So whereas my recommendation, my cost of equity estimates suggest the cost of equity has slightly increased, if we look at the lower end of my range, since 2013, 2014, the opposing witnesses suggest it has fallen, perhaps in the range of 60 to 85 basis points, or if we were to take Mr. Oliver's recommendation by 35 basis points. But the question is it more likely that the cost of equity has increased or decreased since 2013, 2014? And in my view, there are good reasons to think it has increased. First, all the witnesses in this proceeding, I think, agree that authorized returns from other jurisdictions are at least a reasonable benchmark to consider. And if we look back through 2013, the authorized return has remained very stable at about 9.7%. So to me, the question is, has the cost of equity now increased or decreased from 9.7%? And I think it's more likely to have increased. If we think about what happened in 2013, the Federal Reserve injected about $1 trillion of capital into the equity markets with the stated intention of bringing down interest rates and dampening market volatility. It no longer is in the business of injecting capital in the capital markets. Over that period, utility stocks have become more volatile relative to the overall market. Tax reform has put downward pressure on utilities' cash flows, and it made utilities less attractive to other sectors that could take advantage of tax reform in ways utilities could not. And we heard Mr. Mendenhall this morning talk about the company's downgrade due largely to cash flow concerns. On balance, when I think about those factors, it appears to me that it is more likely that the cost of equity has increased from 9.7%, from 9.85%, than it has decreased. And so when I look at my range, the lower end being 9.9%, I think that is entirely reasonable. When we consider the methods the witnesses in this proceeding use, we all generally use the same approaches, or at least forms of the same approaches. The discounted cash flow model, the capital asset pricing model, some form of expected earnings, some form of a risk premium method. And while we have different approaches, again, when I look at how I've applied the models, when I look at the results they produce, when I consider what's happened in the capital markets, when I think about the company's recent downgrade, it does seem to me that my conclusion that the cost of equity has increased is reasonable in the context of those results. Turning now to the company's capital structure, we know the company recommends 55%, which is below its 60% actual capital structure. I mentioned earlier I spent some time managing a balance sheet for a publicly traded utility, and I've learned during that period that managing a balance sheet for a utility is complex. You are subject to many constraints. You are trying to satisfy many objectives. All of them change over time. And although no two utilities are identical, utilities tend to face the same types of constraints and tend to try to satisfy the same types of objectives. And that is why I think industry practice is a reasonable benchmark to consider. When we look at industry practice, especially at the operating company level, 55% is entirely reasonable. And when we think about the credit rating process, and we understand that it is often based on qualitative assessments, and it is based on forward-looking assessments of metrics, I do not think we can draw conclusions based on one or two pro forma calculations, as Mr. Lawton and Mr. Gorman have done. I think 55% is a very appropriate target in this case. And lastly, what I would say is because 55% is an appropriate equity ratio target, I do not think it would be proper to reduce the company's return on equity in recognition of it. When we think about the fact that the company's actual capital structure is 60%, its proposed capital structure of 55% actually includes more financial risk. It includes more leverage than the actual capital structure. If we're going to make any adjustment to the return, it would have to be an upward adjustment in recognition of the fact that the actual capital structure is less leveraged. The actual capital structure has less leverage. The proposed capital structure would have more leverage, more financial risk. and therefore any adjustment we would make to the return on equity would have to be an upward adjustment. I've not proposed one in this case, but if we were to consider an adjustment, in my view, that's the direction it should move. Thank you, and that does conclude my summary.
Thank you, Mr. Hevert. Mr. Hevert is available for cross-examination.
Thank you. Mr. Jetter?
Good morning, Mr. Hevert.
Good morning.
Well, I'm going to jump around a little bit here. Is it an accurate summary of your CAPM model, or the way that you've calculated it, that you apply an adjustment factor to the betas because your belief that betas of companies trend toward 1 over time?
I'm going to quibble with your words a little bit. The betas that I use are adjusted. I do not make those adjustments.
Okay.
Value Line and Bloomberg, both services that are widely relied upon, not only in regulatory proceedings but in practice, apply those adjustments as their default practice.
Okay, and the reason that adjustment is made is because of a perceived trend toward 1.
It's 2 reasons. The original proposition was that was based on Marshall Bloom's study in the mid-'70s. Since then, it's become apparent that the adjustment process has more predictive power. If you were to look at beta coefficients, they're calculated typically on historical data, either 2 or 5 years. But the beta coefficient, like every other element of cost of equity models, is meant to be forward-looking. When we look at the adjustment that both Bloomberg and Value Line apply, the adjustment is more likely to be a forward-looking view of expected risk for investors.
And have you reviewed the historical betas of Dominion Energy, Inc., the holding company?
No, I have no reason to in this case. It has really no relevance to me.
Okay. Have you reviewed historical betas of utilities in general?
I've been doing this work for a little while, so yes, I'm familiar
Okay.
with them.
When was the last time that you saw a beta for a natural gas utility that approached 1?
Just bear with me for a moment, if you would.
And I'll clarify that question, an unadjusted beta that approaches 1.
I'm sorry, thank you for that clarification. I cannot tell you, I've not really looked at unadjustment betas over time, so I couldn't really tell you.
Okay, and so you couldn't tell me if unadjusted betas do in fact trend toward 1?
Oh, I can tell you betas move around quite a bit. And I can tell you, for example, in my direct testimony on page 59, chart 9, we look at the components of beta coefficients and we see how they change over time. You have to remember beta coefficients are a function of 2 parameters, relative volatility and correlations. As I talked about a little bit earlier today, relative volatility has gone up, but correlations have fallen. They've fallen in large measure coincident with the Federal Reserve's quantitative easing initiative and then subsequently with the Tax Act. So they will move over time, raw betas will, but they will change, and when you change, I think it's very important to understand why they've changed.
And so is that an answer a no then? Or is that a
no
yes?
to what question?
Have you observed a historical trend of betas of natural gas utilities to 1?
Toward 1. I can't say. I can say unadjusted beta coefficients move around. The other thing I'll say is it depends on how you calculate them. If you calculate beta coefficients based on a 1-day or a 30-day holding period, it will have a difference in the movement of betas over time. So I really couldn't say, based on your question, what the trend would be.
Okay, but you've applied a method based on a trend that assumes that occurs.
As I said earlier, I applied a method that is widely used in practice. It is widely used in regulatory proceedings, and it has the benefit of being a forward-looking view of systematic risk for investors.
Okay. And
So in my view, the question is, what principles do investors apply? And when I realize, when you think about the fact that the default for Value Line and Bloomberg is to apply adjusted betas, then I think that's the proper approach.
Can I ask you maybe just a background question then? If you apply a method more often, does that make it more accurate?
I'm sorry, when you say you, who is you?
Anyone, the investment industry, if they apply a method generally for the entire financial market, does that make it accurate for a segment of the market?
It makes it, it's an interesting question. If investors adopt that method, then it makes an accurate view. It's an accurate measure of investors' views, and that's what we're after here.
Okay, and so then we would expect, if they're applying that method, then we would expect betas of natural gas utilities to trend toward 1?
I didn't say that, no.
No, so you don't know that that's the case or not?
Don't know what's the case.
That whether natural gas utilities betas trend toward 1?
As I said, I do not, but what we do know is that it is the practice to use adjusted beta coefficients. And I'm sorry, when I say the practice, I should be more clear. It is the practice among investors and in the regulatory proceedings with which I'm familiar.
I'd like to, I'm going to jump around a little bit here to a few different areas.
Okay.
So is it your understanding, I'd like to turn, this is in your rebuttal testimony, and I'm looking at beginning on line 147 through 149.
Yes, I'm there.
Okay. And that states that, and tell me if I read this correctly, that Moody's Investor Services, for example, notes that 32.5% of the weight it gives to various factors considered in its ratings determinations are focused on cash flow. Is that correct?
It is.
And the cash flow that results from a determination on return on rate base, the cost of capital, the cash flow is calculated as a result of the weighted average cost of capital. Is that correct? It's weighted average cost of capital multiplied by the rate base.
I think there's a more direct way of doing it. If we just take the broad view that cash flow would be net income plus certain non-cash items, principally depreciation, it would be net income plus depreciation. So net income would be the product of the return on equity and the equity portion of the capital structure. Doing it your way, you'd have to take out the effects of interest.
And so where I'm going here is you could have multiple different ROEs with the same cash flow depending on the capital structure. Is that correct?
So is your question, on an absolute basis, could there be different combinations of rate base, equity ratio, ROE that would give you the same cash flow?
Yes, that's correct.
Yes, but the important point here is that when the companies, when the rating agencies look at cash flow, it's always relative to something. So here it's cash flow relative to debt, it's cash flow relative to interest, it's cash flow relative to capital investments. So absolute cash flow, sure, I agree with you, there could be, probably an infinite number of combinations, but what matters is cash flow relative to some other metric.
Okay, and from a customer's perspective who's paying this cash flow, who's providing that revenue, a customer would be effectively indifferent to for example, the current authorized 9.85 ROE with a 52% equity ratio. That would be roughly equivalent in a customer's bill to a 9.55 ROE with a 55% equity. Is that accurate?
I'm sorry, so your question is, would there be a combination of equity ratios and ROEs applied to a constant rate base that would create the same level of cash flow?
Well, what I'm asking about specifically is for customers of the utility in Utah, at a 55% equity percentage in the capital structure, a baseline ROE of 9.55 would be equivalent to utility customers of what they are currently paying at a rate of 9.85 ROE and 52%.
I see your question, I'm sorry. That may be true arithmetically, but I think we have to get back to the issues we just talked about a minute ago, which is as you reduce the equity portion of the capital structure, as you increase the financial leverage, you're going to start to create additional risks for the company. And as you increase that financial leverage, you're going to increase the interest the company has to pay. So while they may provide the same algebraic result, they do not provide the same, I would say, the same financial result.
Have you calculated the estimated cost of a capital structure? Have you calculated any estimate of what the debt increase in cost would be to increase the debt ratio to 48%?
So if your question is, do I know what the increased cost of debt would be for a 1 or 2 notch downgrade?
Yes.
Relative. I don't know that offhand, but what I would say is that is what we refer to in finance as a partial analysis. You cannot begin and end the analysis there. You have to consider all the other effects of that type of change on the company's risk profile.
But haven't you done that now? Because you are estimating a 55% equity ratio, when in fact it's currently around 60%.
Well, that was my point earlier. The company has a 55% equity ratio. The actual, is proposing 55%. The actual is 60%. It is more leveraged. The company's proposed equity ratio implies more leverage than the actual. My point there was that if we're going to make an adjustment to the rate of return to reflect financial risk, it should be an upward adjustment.
Did you make a downward adjustment in light of the 55% versus 60% actual?
Did I make a downward adjustment in my rate of return?
Yes.
I made no adjustment, but as I said a minute ago, if there were to be an adjustment, it would be an upward adjustment.
You've testified, I'm going to move to another section of your testimony here, and this is in your rebuttal testimony at line 130.
Yes, I'm there.
Okay. And is this an accurate reading that you testified that, in my view, investors would not be satisfied with an unduly low ROE, open parenthesis, 9.25%, end parenthesis, simply because it would have been lower but for gradualism?
Yes, that's correct.
And if a commission authorized a return on equity of 9.25%, the consequence of that, is that a fair assumption? Or would it be your testimony? What is your testimony? What would happen if the commission authorized a 9.25%?
Well, we have a real near-time example of what would happen. In late November, the Texas Utility Commission deliberated and determined it would authorize an ROE of 9.25% for CenterPoint Energy Houston Electric. It would decrease the company's proposed equity ratio, and it would enforce some ring fencing provisions. Once that happened, the market reacted, and reacted quite strongly. CenterPoint lost about 16% of its value at that time in connection with that deliberation. Now, subsequently, the commission decided that the parties should negotiate a settlement. When the market understood that the commission would look to a negotiated settlement, would not necessarily enforce that 9.25% and other provisions, the company recovered about 6% of that 16% loss. So we know, we have a near real-time example of how the market reacts to returns to a regulatory decision it considers to be negative.
Are you aware in that instance of that utility having a difficult time raising capital? Were they able to raise capital to, are you aware of any instance where they were not able to raise capital to complete any of their projects?
Well, this happened in late November, and my recollection is that Goldman Sachs, for example, came out and said, boy, as a result of this deliberation, the company is going to have to return a considerable amount of equity. It's going to have to dividend it up to the parent company, which means it would have to go out to the capital markets, find that equity, but it would have to get that equity at a depressed valuation as a result of the decision. And then if the company were to have to go out to enter the debt markets, I don't know what would happen, to be honest with you, but I can imagine, again, based on my experience, that debt investors likewise would have reacted. So we'll go back to a point that Mr. Mendenhall made. With utilities, the issue is not often, can you raise capital? You can often raise capital. The question is, at what terms? Here, the company would have to raise a lot of money at depressed valuations, which in the end would be expensive to customers.
And so, did I actually accurately understand your answer that the answer is no, that you're not aware of them having a difficult time raising capital?
That's not my answer. My answer is utilities can typically raise capital, often even in distressed markets.
Okay.
The issue though is the terms at which they have to raise that capital. We saw companies in 2008 going out and issuing long-term debt simply to have cash available because their lenders would not let them draw down revolving credit agreements. They felt the change in the market was a material adverse change and restricted drawdowns. So companies actually had to borrow long simply for the purpose of having cash. They could do it. They were able to borrow long, but that's an extraordinarily expensive source of cash.
Are you familiar with a Virginia decision from November 21st of this year?
I am.
And you testified in that docket?
I did.
Is that right? And you viewed another subsidiary of Dominion Energy Incorporated as a higher risk than Dominion Energy Utah, is that correct?
I'm sorry, can you repeat the question?
You recommended a higher ROE in that case, did you not?
I did, yes.
And the commission in that case in Virginia set the ROE at 9.2%, is that correct?
It did, and we should understand that case, the structure of that case is entirely and fundamentally different from what we're doing here. The purpose of that case was to set the return for two reasons. One is as the base return upon which the commission would add what it refers to as an enhanced return for the purpose of adjustment clauses. Those adjustment clauses are specifically related to certain types of investment in generating and transmission assets. It's not a base rate proceeding. The second purpose is to establish the return against which the company's earnings would be measured in its first triennial review, which would occur in 2021. Those earnings are measured by reference to the base 9.2% plus 70 basis points, so effectively 9.9%. Under the legislation, the most the commission could do at that point is reduce the company's revenues by $50 million, and it could not authorize an increase in revenue. So it's a fundamentally different proceeding.
And so, based on what you just testified, your recommendation in that case would have been adjusted to 11.45% ROE?
So for the purpose of the earnings test, the earnings test, that's right, the earnings test would have been 10.75% plus 70 basis points. That would have been the threshold for the earnings test.
Okay, and in your testimony, did you apply the same models that you've applied in this case?
For the most part, yes.
And you use those same models to calculate a 10.75%.
Again, for the most part.
And based on the same review of those models, or based on a review of those models, that commission, along with other testimony, resulted in a 9.2. Is that correct?
That's correct.
And that's significantly lower than what you're asking Utah customers to pay.
I'm sorry, 9.2% is
Yes.
less than 9.9 to 10.75. I agree with that math,
And
yes.
is there a reason that Utah customers should pay more?
Pay more than what?
Pay more than a 9.2 or even a 9.7?
Well, let's go back. The purpose of that Virginia order was two reasons. One, for the earnings test, which will happen in 2021, but currently it is for the rate adjustment clauses. And the enhanced return on those rate adjustment clauses ranges from 100 to 200 basis points. So the return there would be 10.2 to 11.2%.
Thank you. I'm going to move to a little bit different portion of your testimony.
Okay?
And this is your analysis of the electrification risk. It's your view that, is this accurate representation that your testimony is that investors are recognizing a risk of electrification and therefore should be, are entitled to a higher rate of return because of that risk?
That's a very good question. I think here, when we think about electrification, this is one of those risks that is extraordinarily difficult to quantify. And we know it's a concern for investors. We can see what is happening in terms of the pushback against natural gas, admittedly along the coasts. But when you look at it from an investor's perspective, the question becomes, is there a risk out there that admittedly is difficult to quantify, admittedly is difficult to time, but nonetheless poses a risk to customers? It would be what people sometimes refer to as a tail risk. It's right now a low probability, but a high impact risk. So I think it is something that investors consider, but if your question is, can I put bounds around it? I can't.
And so the follow-up question to that is that something that should be considered then when reviewing capital expansion plans, such as those proposed by this company?
Well, I think that's something for the commission to consider. I think the commission would consider all sorts of requirements in the company's resource planning process. But as I said, this is a long-term issue, difficult to quantify, difficult to time.
And is it your testimony that recognition of that risk in rates and rate of return for investors is effectively compensating investors for bearing the burden of that risk, for taking responsibility for the results of that?
I think it's a consideration right now on the minds of investors. And your question as to compensation for that risk, I guess I look at it as, is this something that's on their minds? Is this something that would cause an investor to consider allocating their capital in one sector or another to one company or another? I think it is. I just don't know how much at this point.
So do you think that investors believe that they will wear that risk?
I'm sorry,
That investors will wear the risk of electrification?
I
As
think
opposed to customers at the utility?
I think it's a consideration, yes. We don't know how the policy implications will work out, but that uncertainty is out there. But it could go either way. I agree with you.
And if an adjustment was made for that, if customers are paying more in equity for shareholders to bear that risk, would you agree with me then that it would be unfair for ratepayers who also bear the risk of stranded assets as a result of that.
I don't think we can answer that question yet. I think it's just all too uncertain.
And so maybe they pay for some of it, but they get no benefit? Is that,
I'm sorry, who pays?
customers pay for a higher ROE?
Again, I think it's just too uncertain at this point to say how it will play out.
Are you aware of any significant rate reduction measures that Dominion Energy Utah has taken or is taking in the near future that would significantly reduce their risk?
I'm sorry, can you tell me what you mean by rate reduction measures?
Risk reduction measures.
Oh,
If I
I'm sorry.
misspoke, I apologize.
No, that's okay. So can you ask your question one more time? I'm sorry.
Sure. Are you aware of, you discussed electrification as a risk enhancement effectively, something that increases risk. Are you aware of any actions by Dominion Energy Utah or proposed capital projects that will significantly reduce its risk?
I cannot speak to capital projects. I can say that the company's 60% equity ratio certainly is something that, from an investor's point of view, would mitigate risk.
If you are aware of a capital project that was approved by the commission that would reduce risk by a company calculated value of $140 million per year, would that significantly change your evaluation?
I can't answer the question. I don't know. What do you mean by reducing risk? I just can't answer the question.
I'd like to, may I approach the witness? I have a cross exhibit.
Yes.
And for the record, I'd like to mark this as DPU Cross Exhibit 1. Could you please identify the cover of this document, what this is?
Yes, it is the rebuttal testimony of Michael L. Platt for Dominion Energy Utah in docket number 19-057-13.
Thank you. And would you turn to, this is page 2. And would you please read, let's see. Let's start with reading line 28 to the end of the first sentence on line 30.
I'm sorry, you want to read it or read it out loud?
Yeah, if you wouldn't mind just reading that into the record.
Sure. Further, the Chem C. Gardner Policy Institute determined that this loss of service would result in negative monetary loss of between $1.4 and $2.4 billion on gross state product, parens GSP. That means the annual risk to GSP alone of this specific scenario is between $70 million and $120 million, based on the fact that there is a 5% annual probability that a design day will occur.
Thank you. And I'd like to jump down to save a little bit of time. Beginning on line, and maybe I'll just read this to make it easier, and you can tell me if I'm reading this correctly. On line 47, near the end, I'll represent that this is a summary of the risk calculation done by Mr. Platt. And it says, a shortfall consisting of $157 million at temperatures between 1 degree F and 3 degrees F, which are slightly less probable at 0.31% annually, adds about $500,000 for a total risk of approximately $141,500,000. Continuing to add risk of lower probability or lower consequence events does not significantly increase the amount of risk that will be alleviated with the addition of the LNG facility. Recognizing that Dominion may not be responsible for all of that $1.4 to $2.4 billion in gross state product of a 5% risk annually event, that's a significant risk reduction by the addition of the LNG facility, is it not?
I'm sorry, but I simply can't comment on this. This is an analysis I haven't seen. It's a project with which I'm not familiar. I don't know the calculations. I don't know the assessment. I don't know what risk is being measured. I don't know how it's being measured. I'm sorry, but I simply can't give you any insights
Okay,
here.
well, let's make it a hypothetical then. Hypothetically, if the company was accurate in its calculation of these risks, would you apply a downward adjustment from previous rate of returns based on a significant reduction in risk?
I don't even know you say these risks. I don't even know what these risks are.
A risk of a gas supply shortfall and the cost as calculated by the company.
I'm sorry, I just can't comment on it. In my view, it's too complex an analysis for me to sit here, look at this testimony, try to understand the analysis, the basis of the analysis, the assumptions, the results, and provide you a meaningful comment. I'm sorry.
Okay. Let me change it to just a hypothetical that might be a little easier. If utility customers spent a significant amount of money to purchase an insurance policy that would cover a risk that was calculated to be $141 million with a 5%, well, it was an annual average risk value of $141 million. And that insurance policy was in effect, would you consider that a risk reduction measure that would be relevant in your analysis of ROE?
I can't say, and I can't say for this reason. The cost of equity is a comparative exercise. We have to look at the risks taken on alternative investments. If we all go back and understand the principle of opportunity costs, it is the cost of equity is based on the return and risk associated with the next alternative, the next comparable alternative. If the risks you're talking about are insurable and are insurable across the industry and other companies likewise have similar insurance policies in place, then I cannot see how it would affect the cost of equity.
Well, how would you assume it would affect the cost of equity in a situation where one utility has this insurance policy and one does not?
It's just too, it's too hypothetical a question to answer, and based on the analysis you've given me, too complex for me to sit here and render an opinion. Does providing insurance reduce the risk to people? I don't know. I'll tell you in my, again, practical experience going back to working at a utility, typically you buy insurance because you've got an incremental risk, and if insurance brings your incremental risk down to the risk faced by other utilities, then no, it would have no effect. But that's a very general assumption.
And so if investors had in fact purchased a utility with this known risk and then added this incrementally, wouldn't you expect that that reduction in risk would be valued by shareholders?
So if your hypothetical is if investors bought a utility at a risk they knew to be higher than others, then of course that would have showed up in the price. And you're saying that there'd be some sort of adjustment to the return. Again, it's hard to imagine how that would not already have been figured into the return. So I just don't follow your hypothetical that way.
My hypothetical is if investors purchase any investment at a given time, you would assume, is a fair assumption that they view that the return they expect on that investment as they purchase it to be equal to or greater than the investment they're making.
Let me try to recast your question to be sure I understand it. Is your question, when investors invest in an asset or equity, do they assume there's a level of risk that in the end will be the level of risk?
No, so what I'm saying is, if investors purchase a natural gas utility with a known risk that's significant and unknown ability to mitigate that risk, they would value that differently than a utility, the same gas utility, all else equal, that has mitigated that risk.
Okay, so I don't mean to be going round and round on this, but if you've got a utility, they've got an incremental risk. And when I say incremental, I mean a risk not faced by any of its peers. Is that the gist of your question?
Yeah, let's say it's a utility-specific risk.
Okay, so it's not faced by anybody else. It's something investors realize, then the return, if unmitigated, would be higher than the return they would require on other investments.
Thank you. I would like to move to enter DPU Exhibit 1 into the record of the hearing.
If any party objects to that, please indicate to me.
I don't have an objection other than to say, I don't know that this witness has any ability to say anything about it, but if you want to take it in, you've certainly already seen it, so I don't really care if it's in the record. I just don't think this witness was able to say anything about it or about the content of it, so.
Okay. I think with that, the motion's granted to enter this as an exhibit.
I'd like to ask you a few questions next about your capital asset pricing model.
Okay.
Mr. Jeter, I wonder if this would be an appropriate time for a short break so we can give our court reporter and everyone in the room
That
a
would be
10-minute
great.
break or so.
Yeah.
Seems like you have a little bit more
I do
to
have a
go
little
with.
bit more.
Why don't we break until 10:40? Record, and we'll go back to Mr. Jeter.
Hi, I'd like to ask the commission if I might approach the witness again with another exhibit.
Yes.
Is it okay if I proceed?
Yes.
Thank you. Mr. Hebert, I've handed you a copy that I will represent as a Dominion Energy investor meetings December 2019 presentation slide deck that has been printed. Does that accurately reflect what I've provided to you?
It does, yes.
I'd like to mark this, just for the record, as DPU Cross Exhibit 2. And I'd actually just like to ask a few brief questions about this. And specifically, well, let's start out with a little bit of background. Have you seen this before?
Not this particular version, no.
Okay. Are you familiar with investor meetings that utilities would hold?
I am, yes.
And the purpose of those meetings is to present information on things like financial projections to investors, is that correct?
Among other things, yes, I agree with that.
Okay. And I would like to have you turn to page 6 of this presentation.
Yes, I'm there.
And looking at page 6, it states that 2019 operating earnings per share were $4.15 to $4.30 per share, and EPS growth is 5% for next year, semicolon, 5% plus thereafter. Is that correct?
Yes.
And 5% is lower than the growth rate that you applied in your capital asset pricing model. Is that correct? Or, excuse me, I apologize, your discounted cash flow earnings per share growth rate.
I think there are probably 3 points. One is, yes, I would say on average, that's true. Second, what matters here would be the longer term. It says 5% plus, so we don't know what the plus means. And third, this is for, of course, the consolidated company, and our analyses look at Dominion Energy Utah on a standalone basis.
Okay. Do you think that Dominion Energy Utah is more or less risky than Dominion Energy Incorporated?
Well, I think generally, if you were to look at it from the perspective of, say, a Moody's will typically reduce the parent company by one notch due to what it refers to as structural subordination. So there could be reasons why the parent company may be more risky than the operating utility.
Thank you. That's the only questions I have about this exhibit. And just a moment. I have no further questions. Thank you, Mr. Everett.
Thank you.
Thank you. Mr. Moore or Mr. Snar?
Do you want to ask for redirect?
I think we generally go to cross from all the parties before redirect, but if you'd like me to go to one of the other parties before and come back
No,
to
no,
you,
I'm
I'd be
ready.
happy to.
Thank you.
Okay.
Good morning, Mr. Herbert.
Good morning.
Isn't it true that you believe that employing the financial models used to estimate ROE, one must use reasonable judgment in applying those models and assessing the reasonableness of their results?
Yes, I agree with that.
Would you mind pulling your microphone just a little bit closer so it gets on the streaming? Thank you.
Isn't it also true that in this case, in assessing the reasonableness of the model's results, it is useful to compare the model's results to the average ROEs for gas utilities in 2019?
That's a good point, and it's something I mentioned in my direct statement opening up. I do think that authorized returns over time, how they've changed over time, and the current level of authorized returns are an important benchmark, and the question is, as I'd mentioned earlier, is it more likely the company's cost of equity is higher than 9.7%? I think it is. Is it more likely that it has increased from 9.8%, 9.85%? I think it has.
We're going to hand you a document marked OCS Exhibit H1. May we approach?
Yes.
Thank you.
I'll represent that this is an American Gas Association rate and regularly update from July 1st through September 30th.
I'm sorry, I have a Moody's Investor Service
Oh,
docket.
that must have gotten in the wrong. You can hold on to that.
Okay.
And introduce that later.
Okay, I appreciate the heads up.
Everybody else check to see if it's, they have the right thing. I don't know how you got that one. Go save it.
Okay, well, thank you. Okay, I think we're speaking to the same document now.
All right, this is the American Gas Association rate and regularly update from July 1st through September 30th, 2019.
Yes,
Correct?
yes, I agree.
May I direct your attention to the second full sentence, third line down in the body of the document, which is highlighted and states the average ROE authorized for gas utilities was 9.68 in cases designed during the first 9 months of 2019, just above the 9.59 in the full year 2018. Did I read that correctly?
You did, and that's consistent with what I had said earlier.
I request to omit cross-exhibit H1.
Okay, if anyone objects to that motion, please indicate to me. I'm not seeing any objections, so it's granted.
Isn't it true that there's an 82-point base difference between your requested ROE of 10.5 and the AGA reported ROE of 9.68?
I would say two things. First, there's a 22 basis point difference between 9.68% and 9.9%, which is the lower end of my recommended range, but nonetheless is part of my recommendation. But as to the difference between 10.5% and 9.68%, yes, I agree with you.
On page 4, lines 60 to 63 of your direct testimony, you indicated there are 3 factors that may affect the risk Dominion faces that have not been considered in the models you propose. The risk of electrification, the risk associated with Dominion's planned capital expenditures, and the risk of regulatory environment. Is that correct?
I'm sorry,
Page
I
4.
see that on page 3, but yeah.
Oh, I apologize. Maybe I made another mistake.
No, that's, you heard me this morning. I'm in no position to criticize.
Okay, let's take these factors one at a time. Electrification. When you refer to electrification, you mean the transition away from carbon-based fuel to electricity to meet the demands now serviced by burning gas. Isn't that correct?
It is, and it's what we were talking about a little bit earlier this morning. the sort of long-term, unquantifiable, but nonetheless not inconsequential uncertainty.
We're going to hand out OCS Cross Exhibit H2, which I believe you have a copy of.
Okay. It's January 30. Yes, sir. Excellent. Thank you. I had a head start with this one.
This exhibit is a copy of Moody's Investor Services Questar Gas Company Credit Opinion, January 30th, 2019. May I ask you to turn to page 4 and read the highlighted portion?
Yes. Page 4, the highlighted portion, falls under a subheading of low carbon transition risk. And it reads, Questar Gas has low carbon transition risk within the utility sector because it is a gas LDC, any natural gas commodity purchase costs are fully passed through to customers with an effective cost recovery mechanism. Moreover, the company's decoupling mechanism helps to insulate its financial profile from the potential negative impacts of lower sales volume should usage decline.
Let's turn now to the risks associated with capital spending. On page 28, 512, 513 of your direct testimony, I'll wait until you get there.
And I'm sorry, which lines?
Line 512 to line 513.
Yes, I'm there.
I believe you stated that the company's projected capital spending program is nearly $1.10 billion in this Utah territory for 2019 to 2023. Isn't that correct?
Correct.
Isn't it true that approximately 30% of these planned capital expenditures will be covered through the infrastructure tracker?
That's my understanding, and I would say that, again, when we talk about the cost of equity being a comparative exercise, the question becomes, do other companies have infrastructure trackers in place? And they do. They're very, very common within the industry. Every company has different circumstances. Every company faces different replacement requirements. Nonetheless, the prevalence of infrastructure trackers does not mean that if a company has one, it is less risky than its peers.
But that reduces the risk of capital expenditures, isn't that correct?
It increases the timeliness of the recovery, and you bring up a couple important points. It increases the timeliness of recovery and effectively puts the company in the place it would have been if it did not have to make those investments in the first place. That is the basis of infrastructure trackers throughout the industry. It is a credit supportive mechanism. As you'll see throughout this Moody's credit opinion, it refers to being credit supportive. It is not credit enhancing. That is to say, these trackers do not make the company's credit profile even better than others. It supports its current credit profile because absent those structures, its credit profile would come under downward pressure.
Isn't it also, are you finished?
I hope so.
Isn't it true that the approximately another third of these capital expenditures are covered by the company's annual non-cash depreciation?
So is your question, does depreciation fund a portion of capital expenditures?
Approximately 1/3, a little less.
I don't know how much depreciation is of the company's revenue requirement. I could not tell you that offhand. But if the question is, can you trace a dollar of cash flow generated by depreciation to a dollar of capital investments, I'm not sure you can do that. But if your question is depreciation roughly 30% of the revenue requirement, I cannot tell you one way or another, and I have no reason to disagree with you.
With regard to the risks associated with the regulatory environment, isn't it true that the company has in place regulatory mechanisms viewed with favor in the investment community and rating agencies? The forecast test year, the sales and revenue decoupling, weather normalization, and as we've been talking about, the infrastructure replacement tracker.
It does, and all those things are very helpful to support the company's credit rating. The other point, I think, not to belabor the obvious, is that notwithstanding those mechanisms, the company still was downgraded in August.
Could I have you look at cross-exhibit H1 again?
This is the,
Oh, no, I didn't.
oh, I'm sorry.
Sorry, that should be H2, the same one you're looking at.
So this is the AGA summary?
No, this is the Moody's.
The Moody's, okay.
Could you read the highlighted portion? At the top of page 3?
Yes, and this falls under the broad category of detailed credit considerations and the subcategory of supportive regulatory environments with key cost recovery features, and it reads, Questar Gas's credit profile is underpinned by its low-risk gas distributions operations in very supportive regulatory environments. The PSCU and PSCW provide Questar Gas with cost recovery provisions that allow the company to recover prudently incurred costs on a timely basis. And again, I think what I would say is that is helpful. It is credit supportive. The regulatory environment certainly is credit supportive. And a departure from a credit supportive regulatory environment would be viewed as a credit negative from the perspective of the rating agencies.
Let's turn to the topic of capital structure now.
Okay.
On page 43 to 44, lines 797 to lines 800 of your direct testimony,
So this would be on line 797, there's a sentence beginning as the percentage?
yeah, as the percentage of debt in the capital structure increases, so do the fixed obligations for the replacement, for the repayment of the debt. Consequently, as the degree of financial leverage increases, the risk of financial distress, i.e. financial risk, also increases. Is that correct?
Yes, that's correct.
I read that correctly.
You did.
Could I again ask you to refer to OCS cross-exhibit H, the AGA rate and regulatory update, and ask you to look at the last paragraph in the full sentence, starting with line 3, which is highlighted and states, the average allowed equity ratio for gas utilities nationwide was 52.52% in the first 9 months of 2019, compared with 50.09 in 2018 and 49.44 in 2017. Did I read that correctly?
You did, and of course, you note there the increasing trend in the authorized equity ratio over time.
Dominion is seeking a capital structure of 55 equity and 40% debt, which is less than the average. Isn't that correct?
We have to talk about what we mean by the average. It is less than what you talked about here, this average authorized equity ratio. When we look at the average equity ratio in place among natural gas operating utilities, 55% is not less than the actual capital structures in place.
So you disagree? I'm lost. You disagree with the sentence that I just read?
Oh, no, I don't disagree with that at all. What I am saying is that if you look at the actual capital structures in place, if you were to look at what the companies actually carry on their balance sheet for common equity and long-term debt. At the operating company level, it is higher. In fact, it is the average since the third quarter of 2013, and this is on page 96 of my rebuttal testimony, has been about 57.59%. So that average equity ratio in place among operating companies is somewhat higher than the 55% equity ratio the company proposes in this case.
But the average authorized capital structure is 52.52%.
Yes, that's what AGA reports, of course, again, up from 49.88% in 2017. But yes, I agree with that.
Turning to your analytical models, isn't it true that your constant growth DCF model includes ROEs as high as 28.83%?
Well, I think we should turn to that exhibit.
That exhibit is DEU Exhibit 2.01, I believe.
Right, so this is on my direct testimony,
Yes.
and we're looking at page 1 of 3.
I was looking at page 37, line 880 to 881.
Okay.
Oh, I'm sorry, that's not your testimony. The DEU exhibit I was referring to was 2.01.
Yes.
And don't you
Yes.
have an upper range in that exhibit at 28.83%?
So the high, let me talk about how we present these results. We present the results for this discounted cash flow model 3 ways. One is based on an average growth rate, and recall the constant growth discounted cash flow model effectively is the dividend yield plus the expected growth rate. So we show 3 measures of the expected growth rate, the average of the lowest for each company, the average of the average for each company, and the average of the high for each company. So the 28.83 you're referring to is one of the high growth rates that's reported for one of the companies. But yes, you're correct, that number is there. And the other thing I would say is if you look down to the average and the mean result, you'll see the average and the median. The median is 11.88%. The average is 13.52%. The upper end of my range is 10.75%. So obviously, these did not weigh heavily in my recommendation.
Is it your opinion that a return of 28.83% is consistent with market conditions facing an investment as safe as a gas utility?
Well, that goes to my last point, right? These numbers, 13.52%, 11.88%, I think are just too high for a natural gas utility. So they are above my recommended range. So I would not give that number much weight.
Thank you. I have no further questions.
Thank you.
Major Kirk, do you have any questions for this witness?
Yes, sir, I do. Sir, you said that the industry average rate of return on equity was 9.7%.
What I've said is that it has been consistently in the 9.7% range since about 2013.
And you said there was good reasons to think that it has increased since then.
For the company, yes.
But for other companies, there's examples of it being much lower than that. Is that correct?
I'm not sorry. I'm sorry. We may be talking about 2 different things here. If your question is, have there been authorized returns below 9.7%, if that's your question, yes, then I would agree with that. There obviously have been others above 9.7 because 9.7 is the average.
A couple of those below we talked about was Center Point, Texas at 9.25%. That's one case?
Well, Center Point, Texas is an electric distribution case, not a natural gas case. But yes, it was 9.25%, and as I'd mentioned earlier, the market reaction was, it was notable.
But there hasn't actually been a credit down rating of CenterPoint in Texas since that announcement yet, has there?
It's too soon, I think. I mean, what we were talking about was a commission deliberation in late November. The commission's decision was supposed to have been rendered on, of all days, Friday the 13th. And that, as I understand it, is the day that the commission decided that it would be better for the parties to try to negotiate a settlement. So I think it would be premature for the rating agencies to have a rating action before they understand the likely outcome of those discussions.
But they haven't made any announcement yet, right?
That's my understanding, yes.
We also talked about 9.2% in Virginia. That's another case where it's below the 9.7 average, right?
Right, and again, I won't belabor the point, but it is a fundamentally different case. It's not a base rate proceeding as we have here.
In Colorado recently, Excel Energy had a 9.3%.
I cannot comment on Excel Energy's case. I was not in that one. I don't know whether that was electric or gas. I cannot tell you.
Let's look at a very recent gas case settlement. Last week, the Wyoming Commission approved a settlement in that case with Black Hills Wyoming Gas for 9.4%. Are you aware of that?
No, thank you for letting me know.
Would you say that, I mean, Dominion, Q-Star Gas Company does business in Wyoming too, don't they?
It does, yeah.
And Black Hills Wyoming Gas is also a gas company.
It is one of the, excuse me, one of the many companies that have had returns authorized this year that, again, have fallen in the 9.7% range. I'm not sure that one observation at 9.4% would meaningfully change that.
Earlier you said that you thought 55% capital structure was entirely reasonable and the industry practice.
I think there are 2 points that I made. One is if you look at industry practice by reference to natural gas operating companies, 55% is slightly below what we see. Second, if you consider the cash flow issues Mr. Mendenhall spoke about this morning, I do think 55% is a reasonable target, yes.
As far as authorized capital structures go, the more common industry approved capital structure is in the 51 to 52% range, correct?
I'm not sure. You'd say that we just saw a minute ago. 52.5% was the average that the American Gas Association reported. I think when we look at average authorized equity ratios, it's a data point. I agree. But to me, for the purposes of understanding how the company, pardon me, capitalizes itself relative to practice, I tend to look at what's in place at the other operating companies. But yes, 52.5% was the 2019 average so far, again, meaning somewhere above, somewhere below.
And last week in that settlement with Black Hills Wyoming Gas, it was approved, the capital structure approved there was 50.23%. Are you aware of that?
No, but again, thanks for letting me know, but it does not change my perspective at all.
No further questions. Thank you.
Thank you.
Thank you. Mr. Meekum.
I represent the American Natural Gas Council, which is a group of small commercial customers that takes transportation service from from Dominion, formerly Questar.
Yes.
In your rebuttal testimony on page 4, you summarized all of the recommended rates of return from all of the rate of return witnesses, correct?
I do, correct, table
And
one.
you have, and this, earlier this morning, you stated that Mr. Oliver, who's appearing for the ANGC party, has recommended 9.5%, correct?
That's correct.
Now, you understand that that recommendation was based on an equity ratio of really nothing more than 52%. Did you understand that?
I do.
And you understood from his testimony that were he to go to the 55% equity ratio, his recommendation would be 9%?
Yes, and I think that's fundamentally incorrect.
Oh, I didn't doubt that.
Just to be clear.
So really, when you consider all of the other witnesses in this proceeding, they are all clustered at the low end of 9. 2 9s, 1 9.9, and 1 9.25, and you at 10.5.
2 points there. That's true. When we look at those returns, and I guess if we were to consider Mr. Oliver's 9.5, they range from 9% to 9.5%.
Well, that's assuming, again, right, the equity ratio at 52%, not 55%. So go ahead, I'm sorry, I cut you off.
Well, then tell me, what would his recommendation be at 55%, so we can have the conversation?
9%.
Okay, so he's at 9%. The range is then 9 to 9.25%. We've all talked about for a bit this morning that the average has long been 9.7%. My recommendation at the low end of my recommended range is 20 basis points removed from that. So if we were to look at authorized returns without giving any effect to the company's circumstances, I would say my recommendation is far closer to the more relevant benchmark of what is being approved elsewhere.
And just for fun, I took the 5 witnesses appearing on cost of capital and averaged them and came to 9.37, which includes your 10.5. But obviously, you think that's out of the range.
I'm sorry,
If you take 9.25, 9.1, 2 9s, and 10.5, the average of those mixed together is 9.37% rate of return.
Okay, I'm not following the import of that, but I would agree with your math.
Okay, well, thank you. Perhaps we could get even more fundamental. Do you agree that the cost of equity financing is generally greater for a gas distribution utility and for its ratepayers than the cost of debt financing?
Yes, I agree with that.
And in this proceeding, are you aware of what the cost of debt is that's being put forward?
Yes.
4.37, if that helps.
Yes, I addressed that, yes.
Okay. And again, as you've stated more than once, your recommendation is 10.5%.
Within the range of 9.9 to 10.75, correct.
So your proposed cost of equity is roughly 2.4 times Dominion's cost of debt before taking into account the effective income taxes. Is that correct?
Well, let's break that down a little bit. If you're looking at the point estimate, I agree. When you talk about the effective income taxes, I mean, now we're looking at a revenue requirement effect as opposed to the cost of equity from the investor's perspective. But again, I would not disagree with your math.
Okay, thank you. And do you accept that when you recommend 10.5%, it needs to be grossed up for income taxes?
Yes, I understand that.
And the effect of that is 13.95%?
I understand.
Gross it up?
I'm sorry, I didn't mean to
You
interrupt
agree?
you. Yes, I have done that math, I agree.
Okay, thank you. And you've already stated that you agree that the commission needs to look at the effect on ratepayers and to assess the reasonableness of Dominion's overall cost of capital and its consistency with sound financial management and utility operations, correct?
I think the commission, this commission, all commissions have the difficult task of balancing the interests of investors and ratepayers. Now, when we talk about things like differences in recommended returns, you can talk about the difference in the revenue requirement. But of course, the difference on net income is a multiple of the difference in the revenue requirement. If there was a change in the revenue requirement of 3%, the difference on net income, a reduction of 3% of the revenue requirement, the reduction in net income would be a multiple of that, possibly 10%. So I do think those are all things we have to consider.
Okay. Have you presented any evidence in your testimony that demonstrates that Dominion's utility operations can't be operated on a financially sound basis with a capital structure of approximately 50%?
Let me tell you what I've presented. Your question is one that I'll go back to earlier, one of industry practice. When I look at practice, it is at about 57%. Given the company's cash flow concerns, given the company's cash flow considerations, given Moody's observations about the company's weak credit metrics relative to its peers, if the company were to have an authorized equity ratio of 50%, it clearly would put downward pressure on the company's already weak credit metrics. Could the company operate? I'm sure it could. How difficult would it be for it to be able to raise the capital it needs? How difficult would it be for it to maintain its credit profile, to be able to access the long-term capital, the day-to-day liquidity it needs? I think that is far more difficult.
Well, Mr. Mendenhall testified that the company was downgraded from A2 to A3. Did you hear that this morning?
Yes, I'm aware of that.
Have you calculated what the cost of that was or is?
Well, I think we talked about that a little bit this morning. You can talk about the effect of the incremental credit spread of losing one notch. That's just one part of the analysis, and it's a very small part of the analysis. When we look at the fact that Moody's still considers the company's cash flow-related credit metrics to be weak, when we consider the fact that the company was among few that were identified for a downgrade and among few that actually were downgraded, as I understand it, that means an incremental level of risk to equity investors. So you can certainly try to calculate the incremental effect of losing one credit notch and the higher credit spread associated with that. But that is only part of the analysis, and that should not be the basis of a determination that 50% is a proper equity ratio.
But if there were a downgrade, or in this case, when there was a downgrade, isn't the effect on the cost of debt on the incremental amount that the company would have to go out and get?
Yes, I agree with that. It is on the incremental amount. The debt that's already existing would be there. Now,
It would not have any effect on that existing debt, correct?
let me finish.
Okay.
It would not have any effect on the embedded cost of debt. It would have an effect on the incremental debt. Now, my understanding is the company's debt is all privately placed. It is not placed in the public market. It is not of sufficient size, for example, to be what is considered index eligible, meaning it can be put in an index and it would be very liquid. Again, based on my practical experience, when you're dealing with private placements, it is a less liquid market, and a downgrade not only affects the cost of debt, but it also affects your ability to place the debt when you need to.
And then you heard Mr. Mendenhall, if I understood him correctly, testify that the difference between a 60% equity ratio and a 55% equity ratio was about $8 million.
I do, but I don't, I also have to wonder, for example, we talked a little bit this morning about the situation with CenterPoint. If the company were to have to move to a 55% equity ratio from 60%, and it meant to align its actual capital structure with the rate-making capital structure, that means it would have to somehow return dividend up equity. Given its cash flow situation, I just don't know where that cash would come from. I don't know how that would happen. So it's true, you could move it down and the effect would be $8 million a year. But again, from my perspective, the analysis does not end there.
Do you know what the monetary value is of the difference between 55% and 50%? is it the same as 55 to 60? In other words, is it $8 million or so, or did you make that calculation?
No, I could not tell you, but what I would say, you talk about the monetary value. What I would say is that if the company's actual capital structure is 60% and it's proposed as 55, and you're moving it down now to 50, from the equity investor's perspective, that is a significant increase in financial risk. And as I'd said earlier this morning, any adjustment you would have to make to the cost of equity in connection with that change would be a positive adjustment.
But you agree that the cost of equity financing is significantly higher than the cost of debt financing.
Well, that's just the nature of capital markets.
So we'll use Mr. Mendenhall's $8 million figure from 55 to 60. How does that compare to the incremental increase on debt financing that may occur, or if there happened to be a downgrade?
As I said, I cannot tell you. I've not done that math, nor would I end the analysis there. I think if we were going to move the equity ratio down from the current level of 60% to 50%, the analysis becomes far more complicated at that point.
Okay. So at your 55%, you didn't really take into account what the impact would be on ratepayers, or did you?
The impact relative to what?
The cost of equity, but the difference in cost of equity between a 50% equity ratio and a 55% equity ratio, you didn't consider the impact of that on ratepayers?
In my testimony, no, because I don't think you can do that without making an upward adjustment to the cost of equity, which I've not done.
Okay, thank you. Let's look at your rebuttal testimony, Table 10.
And what page is that? I'm sorry.
It's page 96 of 105.
Okay. Yes, I'm there.
So, am I to understand that the operating companies for which you show common equity ratios in this table are subsidiaries of your chosen proxy group investors? Excuse me, proxy group companies?
Yes, they're subsidiaries, or in a case where One Gas, where the company operates as a single division, really.
Which one is that?
One Gas.
Oh, I'm sorry.
Yes.
My
Oh,
hearing,
I'm sorry, I didn't mean One Gas. The company's name is One Gas.
And is it your position that Table 10 is a representative sample of all distribution utilities in the country?
I think Table 10 is the best representation we have of the operating companies within the natural gas proxy group.
And the numbers that are reflected in Table 10, the equity ratio numbers, are those actual common equity numbers?
Yes.
None of them have been approved by regulators.
I'm sorry, you say none of them have been approved by
Well,
regulators.
is it true that none of them have been approved? Is this just an actual common equity ratio outcome for each of those companies?
I think, well, let me back up. When I was in charge of managing a company's balance sheet, we had to seek approval for debt issuances. And so our capital structure necessarily was subject to regulation because we needed to seek approval for the issuance of securities. To the extent any of these companies, and I cannot tell you whether they go through a similar process, but to the extent any of them need to get approval for the issuance of securities, then I would say yes, they are subject to regulation.
Have they been before a Public Service Commission and been approved at those levels?
I think I just answered your question. As in my experience,
I wasn't sure which regulators you were speaking of, Securities and Exchange or PSC.
oh, I was following your question. I assumed you were talking about regulatory commissions. And that is my answer, that in my experience, companies often need to get the approval of their state regulatory commissions to issue securities.
But let me just, as an example.
Sure.
So North Jersey Natural Gas Company, quarter two, 2019, shows 61.04%. That's an actual common equity ratio number for that company?
It is, and thank you for pointing something out. That should be New Jersey Natural Gas Company. I'm actually from North Jersey, so that was probably a slip on my end.
And did they go before their Public Service Commission and get an equity ratio approved at 61.04%?
I'm going to go back to my prior answer. To the extent any of these companies, and I cannot tell you what the regulatory requirements are in each of these states, I can just tell you what my experience was. To the extent they need approval to issue securities, then the equity ratio would be an outcome of the approval to issue securities.
But as an example, in this proceeding, we're not here to issue securities. You're arguing for a 55% common equity ratio. Did New Jersey Natural Gas go before the New Jersey Commission and seek a 61% common equity ratio?
I don't know, but that's not the point of this analysis. The point of the analysis is to see how the companies actually are capitalizing their balance sheets. And again, you look at what's happening here. The company is actually capitalizing its balance sheet with 60% equity, different than the 55% equity ratio it's proposing here.
And on this table, you see a variety of equity ratios ranging perhaps from 48% to 71% or so. Is that correct?
Yes, I agree with that.
Why do some gas distribution utilities operate with substantially higher equity ratios than others?
You know, it depends on each company's circumstance. As I said in my opening statement, companies are similar in terms of the objectives and constraints they face, but they're not identical. No two companies are the same, and therefore you would not expect their capital structures to be identical either. I cannot tell you why one is higher than another, but what we can do is look at these companies, and we see that the average is about 57.5%. When I think about the company's situation, when we think about its cash flow circumstances, 55%, which is, again, less than its actual 60% equity ratio, seems to me to be consistent with practice and reasonable.
Now, Northwest Natural Gas and Southwest Gas Corporation are at the low end of the range. Is that correct?
They are.
Do you know how their credit ratings are in comparison to Dominion's distribution utility?
I would say probably within a notch or two.
So they're very much the same.
They may be. What I cannot tell you is whether Moody's made the same observations. I do not know that either of those two companies were downgraded in August, and I cannot tell you whether Moody's has said their cash flow metrics are weak relative to their peers, as Moody's has said in the case of the company.
So do you provide any evidence in your testimony that the 55-45 capital structure will minimize the cost of capital that Dominion ratepayers are asked to bear while maintaining the company's ability to raise incremental capital on reasonable terms?
Well, you bring up a point I made in my opening statement, which is that capital structure optimization is highly, highly complex. And there's a difference between what people often refer to as minimizing the weighted average cost of capital and optimizing the capital structure. I said earlier that utilities face common constraints and have common objectives, and in my experience, a common objective for a utility is to minimize its overall cost of capital. But it does so subject to constraints. It does so subject to the constraint that it must maintain access. It must maintain its credit profile. It has to have the financial community's support. So the calculation of an optimal capital structure is highly complex, but if you're trying to equate it with minimizing the weighted average cost of capital, they are not always the same thing.
Do you know what the common equity ratios were that were last approved for rate-making purposes for each of the gas operating companies in Table 10?
I cannot tell you as I sit here, no.
Do you know any of them off the top of your head?
Not off the top of my head, no. And it's, again, for the purpose of this analysis and this assessment, I did not need to know.
Let's turn to page 15 of your direct testimony,
Okay.
around line 286. The issue is proxy group screening criteria.
Yes, I'm there.
At lines 300, 301, the last screening criteria you present is significant events. Did you use that criterion in other proceedings?
I do, yes.
Okay. So then if you turn to Exhibit DEU 201.
Okay. I'm there.
Do columns 5, 6, and 7 on page 1 of that exhibit present the earnings growth estimates on which you relied to compute your DCF returns?
5, 6, 7, and 8. So I'm sorry, is your question the earnings growth forecast?
Yes.
I'm sorry, then yes, you're
5,
correct.
6, and 7.
Yes, I'm sorry.
And then in column 7 of that table, the line for Northwest Natural Holding Company, there's an entry of 25.50%. Now, I'm assuming you'd agree that none of the earnings growth estimates for your proxy group companies from Zacks and First Call are greater than 7.2%. That's in columns 5 and 6 of that exhibit.
Yes, I agree with that.
And am I correct that with the exception of the value line earnings growth estimate for New Jersey Natural Resources Corporation, Value Line's earnings growth estimates are all at least 100 basis points greater than the estimates from Zacks and First Call for the same companies?
Yes, it's an interesting question. For example, if you were to look at Spire, you see the First Call estimate is 2.82%. Now, if we think about a long-term expected rate of inflation of 2%, that would suggest real growth of slightly less than 0.8%. That strikes me as an unreasonably low growth rate, but nonetheless, I left it in. So, yes, I agree 5.5% is greater than 2.82%, but I think 2.82% is a pretty low number. But again, based on my convention, I've left it in.
So with that 25.50% earnings growth estimate for the Northwest Natural Holding Company, it's 2.5 times the highest Value Line earnings growth estimate for any of the other proxy companies, is it not?
Sure, but if we're going to start going down the road of taking out growth rates, we have to take out high growth rates, we have to take out low growth rates. We wind up in a cycle then determining what's an outlier and what's not. That's why it's long been my convention to present the growth rates and to show both the mean and the median result, the median being the result that mitigates the effect of outliers.
But it skews the average up, does it not?
Which is why I show the median as well.
Do you think that 25.5% growth rate sustainable over the long term?
No, nor do I think 2.82% is sustainable in the long term. The question is, when we look at these companies in aggregate, when we calculate the aggregate discounted cash flow result and we look at the mean or the median, is that number reasonable? And just going through these, let's say we were to remove Northwest Natural Gas, But then we were also to remove Spire Incorporated, which is the low. The median does not change. It remains 9.75%. That's why I believe looking at the median, including all the growth rates, is a proper approach.
Wasn't there a significant event at Northwest Natural Holding Company?
There was an impairment that was taken on a storage facility, and that was 2 years ago.
So about a $200 million loss? Is that what I understood is correct?
I remember it was about that. Yeah, that's about right.
And so that then affected the numbers going forward that we're talking about now.
Right, but if you look at the fact, as you talked about earlier, the earnings growth rates from Zacks and First Call for Northwest Natural, if anything, are below the others. So to the extent we look at the perspectives of a variety of analysts, I don't think it's proper to exclude the company on that basis.
Do you know if Spire, you cite Spire as the low, but did they have a significant event like Northwest did?
When you say like Northwest did Spire take an impairment charge? I don't think Spire took an impairment charge, not that I'm aware of.
But my point is that one suffered a significant event, and as far as we know, the other did not. Is that correct? Okay, go ahead, sorry.
Thank you. Northwest Natural took an impairment charge. It sounds like you're familiar with the timing. That was probably about 2 years ago. Looking forward, how does that affect the financial community's views of the company's prospects? And again, if we go back to the fact that Northwest Natural's expected growth rates from Zacks and First Call are really lower than the other companies, I don't see that the financial community as a whole views that event going forward as one that would preclude it from being a proper proxy company.
Let's take a look at column 8 on 2.01.
Okay.
Am I correct that the data in that column present estimates you've developed to assess retention growth for your proxy group companies?
Yes, that's right.
And then as stated in your direct testimony at lines 956 to 958, the retention growth model is a generally recognized and widely taught method for estimating long-term growth. Did I properly represent that?
So I think what you quoted were on lines 956 and 957, and it goes on to say it's an alternative approach to the use of analyst growth estimates.
Yeah, I just quoted that the retention growth model is a generally recognized and widely taught method for estimating long-term growth.
Yes, I agree with that.
And is it your assessment that the retention growth model generally produces reasonable estimates of long-term earnings growth?
It can. It doesn't always, but it can.
Am I correct that the retention growth estimate shown in 2.01 for Northwest Holding Company is 6.42%, or about 1/4 of the 25.50 earnings growth estimate value line offered for the same company?
Yes, that's right.
Okay, now let's take a look at 2.01R. Again on page 1.
Okay, I'm there.
Thank you. So 2.01R shows, what's the value line earnings growth estimate shown for Northwestern Natural Holdings Company there?
That's 27.
So it's up from the 25.5.
Yes, 2 percentage points.
And then am I correct that the retention growth estimate for Northwestern Natural Gas in that exhibit is 6.19%.
It is.
So while your retention growth estimate for Northwestern declined from 6.42% in your direct testimony to 6.19% in rebuttal, the value line estimate of earnings growth for Northwestern increased further from 25.5 to 27% in the analysis supporting your rebuttal testimony. Is that correct?
Right. So what that shows us is that when we look at retention growth, when we consider it as an alternative, 6.19 generally falls within the range of what we're seeing from Zach's perhaps first call. I agree, the value line growth rate went up, retention growth rate went down, moderated the effect a little bit. But again, if you were to go through the exercise we talked about a little bit earlier, which is to eliminate, if we wanted to, Northwest Natural Gas, and then the lowest result, which is Spire, the 9.98% median result shown on page 1 does not change. It remains 9.98%. That is the point of reporting the medians.
Okay, thank you. Now, if you turn to page 85 of your rebuttal testimony.
I'm sorry about that. Yes, I'm there.
So at lines 1568 and 1569, you indicate that value line is widely relied upon by investors.
I do.
Have investors historically relied on value lines timeliness factors to predict short-run stock performance?
I think the timeliness factor, I think the safety ranking, I think a lot of the parameters shown in value line are relied on by principally retail investors.
Have you presented any evidence of the extent to which investors rely on value lines estimates of long-term, say 3 to 5 years, earnings growth estimates, or long-term estimates of equity returns?
Is your question, have I looked at the issue of do value lines growth rate, earnings growth rates, do earnings growth rates in particular affect utility stock valuation levels? Then in other proceedings, absolutely, I have done that.
In this proceeding, is there evidence that shows that they rely on it for long-term bases?
No, it really did not come up that much in this proceeding.
Okay.
In other proceedings, we have long drawn out what I find interesting and perhaps other people find tedious arguments about the efficacy of different growth rates, and then we will present those analyses. But it wasn't so much of an issue here.
Okay, thank you. Have you provided any evidence of the accuracy and reliability of value lines' long-term earnings growth estimates for the record of this proceeding?
I haven't, and there's no need to. The question is not whether ex post, whether looking backwards, a forecast is accurate. The question is whether currently, looking forward, investors rely on them. And we've no reason to believe investors do not rely on growth rates provided by analysts.
Let's, for just a minute, turn to page 86 of your rebuttal testimony at lines 1582 and 1583.
Yes.
There?
Yes, I'm there.
And you state that although not a full measure of equity risk, credit ratings suggest that the company's business risk is not dissimilar to its peers. Would you explain what you see as the difference between equity risk and business risk as you've used those terms?
Well, first off, we have to unpack your question a bit, I think. When we talk about equity risk would be the risk to which equity investors are exposed, and it typically would fall in two areas: financial risk and business risk. Business risk generally relates to the variability of income, the variability of cash flows. Financial risk generally relates to the incremental risk associated with additional degrees of debt, additional degrees of financial leverage in the capital structure. Now, when we look at credit ratings, typically they are for the benefit of debt holders. They do not fully measure equity risk, principally because equity investors are exposed to risks beyond those to which debt investors are exposed. Debt investors have contractual obligations in their favor, and they have a priority position on the claim of cash flows to equity investors. Secondly, debt is finite in life and equity is perpetual in life. So when we look at the issue of equity risk and business risk is one factor of equity risk. Now, in this circumstance, if the company's credit rating at the time is A3, it's been downgraded relative to the group, that incremental change, as we've been talking about a fair amount today, I think is important to the financial community.
So perhaps in there you explained what you believe a full measure of equity risk means. What, perhaps you could narrow it down for me.
So let's look at it this way. Let me try to explain it a slightly different way. I think we can agree, we talked about a little bit earlier this morning, that the cost of debt is below the cost of equity. That is the case because debt investors are exposed to less risk than equity investors. They have protections not afforded equity investors. They have a priority position in terms of claims on cash flow, and they have a finite life. So in that sense, equity risk goes beyond debt risk. Now, both debt and equity investors face business and financial risk. The point is that equity investors are exposed to those risks to a greater degree than debt investors. Does that help you?
It does. I guess I'm just trying to understand what you mean by full measure.
It's not, it is if we were to look at credit ratings as a measure of equity risk, it may be incomplete because there are additional risks to which equity investors are exposed. Now, we can certainly draw inferences. Again, in this situation in particular, where you have a company that was one of 24, a subset of the entire sector, that was noticed for, that was put on credit watch with negative implications, and then a company that is one of the few in the sector that actually was downgraded. I think from that, we can draw an inference that that poses an additional risk to equity investors.
Thank you. Let's turn for a minute to flotation costs.
Okay.
At 94, pages 94 and 95 of your rebuttal.
Yes. Yes, I'm there.
Have you presented any evidence of actual flotation costs incurred by DEU's parent company since its acquisition of Questar Gas?
If you just bear with me 1 minute. I'm sorry. So on DEU Exhibit 2-09, we have two issuances by Dominion Energy, one in March of 2018 and one in April of 2016.
And when did the acquisition occur?
I knew you were going to ask me that question. I can't tell you the exact date off the top of my head, I'm sorry.
Unfortunately, I can't remember either.
Good. I don't feel quite so bad now.
I know it was post-April of 16.
Right.
I just don't know about March of 18.
Right.
Well, I'll ask another, go ahead, you want to?
I believe it's September of 2016, is my September 2016.
That's right. I thought it was more recent than that. Okay, thank you. Can Dominion Energy obtain additional equity capital through means such as retention of earnings that don't require the incurrence of equity issuance costs?
Yes.
Okay, thank you. I'm not sure if you've had a chance to look at DEU 3.31, which is Mr. Stevenson's testimony, but would you accept, subject to check, that in that 3.31 exhibit, it shows the company's unappropriated retained earnings increasing from 296 million to 660.5 million in the proposed capital structure for this proceeding?
Yes, that the company has retained equity, has not dividended equity up to the parent. Yes, I believe that's true.
In your rebuttal testimony in lines 1731 to 1734, address Dominion Energy's allocation of net proceeds from equity issuance to its subsidiaries.
I'm sorry, where were you?
It's your rebuttal at lines 1731 to 1734.
Yes, I'm there.
And so it addresses the allocation of the net proceeds from equity issuance to its subsidiaries, correct?
Right, so this is in the context of flotation costs, correct?
Right, yeah. And do you know how many subsidiaries Dominion has?
Oh, a fair number.
Would you say over 100?
Well, if you were to assume, if you were to look at every limited liability corporation, for example, associated with a given project, that could be.
And do I understand that you suggest that those issuance costs incurred by Dominion to raise equity capital should be allocated among Dominion subsidiaries in proportion to Dominion's allocation of the proceeds from the equity issuance?
Question, how does that 5 basis points get allocated throughout? It's based on the actual equity in place at the subsidiary company, because when the parent issues equity, it incurs flotation costs. The actual proceeds are less than the gross proceeds. Every dollar it issues, it will get maybe 98 cents on a net basis. So the flotation cost adjustment is meant to ensure that there is full recovery of the full amount of equity needed to fund the utility assets.
So it's not evident in your testimony how those flotation costs are distributed.
Well, when you say it distributed, the flotation costs are associated with the equity balance for the company, but the flotation cost adjustment is on the cost of equity itself. The point of this part of the testimony simply is that the fact that equity is issued at the parent company, not at the operating company level, does not negate the need for a flotation cost adjustment. A company goes out and issues $1 of equity but only gets 98 cents back, and then invests that 98 cents in its subsidiaries. It's still only 98 cents. So whether the subsidiary goes out to the market directly and issues equity and takes the 2% hit, it only gets 98% from the market, or whether it gets 98% from the parent doesn't matter.
And one last question on this, on flotation costs. Do you show any evidence that demonstrates that the Questar Gas shareholders weren't fully compensated through the merger with Dominion Energy for any equity issuance costs that Questar Gas incurred prior to the merger?
That is absolutely not the basis of the analysis, so no.
Okay.
The question is generally, when the company, whether it's the operating subsidiary or the parent, issues equity, does it issue equity at a discount? And the answer is yes, it does.
And finally, as I understood your testimony, I think it was when you were talking to Mr. Moore, you said that a parent company may be more risky than the operating company?
Yes.
You criticized Mr. Oliver in your rebuttal testimony on page 95, I think it is, because he he challenged your proxy companies for being the parent company or holding companies of the operating company. Is that correct?
Well, I disagreed with Mr. Oliver on that point. That's right.
Well, okay. Semantics. Hasn't it been clear in your experience that the parent is virtually always more risky because they're involved in so many more activities than the utility?
It's, to be fair, it's not always the case. You can have a parent that is principally the holding company of operating utilities. They may be 97% of the company's total operations as measured by operating income. There may be, for example, and I'll just give an example, and I'm not speaking about a specific company. There may be a situation where part of the non-utility operations may be a project that is secured by a long-term contract with a counterparty that's rated, a strong A. So I think it's just hard to make general comments like that, to draw general conclusions like that.
You understood Mr. Mendenhall's testimony this morning that Moody's expressed concern about the parent in this situation being highly levered.
I do, and I also recall Mr. Mendenhall speaking about Moody's recognition of ring fencing provisions that are in place. And I also noted in, I think, my discussion that Moody's also considers the factor of structural subordination, which means that if a parent company has debt and it uses funds from operating companies to pay that debt, it is one step removed from those funds. And so simply as a matter of process, Moody's typically will reduce the parent company by one notch as a result of structural subordination, not necessarily as a result of business risks. But yes, I hear that. I heard that testimony, and I understand the company does have ring fencing provisions in place, which Moody's has recognized.
And that was to mitigate the risk that Moody's perceived of the parent, is it not?
Right, which is shown in its credit ratings and still with the other credit supportive aspects of that the company has in place, and I think we all hope to stay in place.
Okay, thank you. That's all I have, Mr. Chairman.
Why don't we go ahead and take a break and then come back at 1 o'clock for Mr. Russell's cross-examination? Is there any objection to that?
Very short.
Okay. I'm sorry, would you prefer to go ahead now?
I don't think it'll make much of a difference. My cross-examination will be very short, but we're not going to get through the witness before lunch anyway, so it doesn't make much difference to me.
Why don't we break for an hour and come back at 1? On the record, Mr. Herbert, you're still under oath from this morning, and we'll go to Mr. Russell for any cross-examination.
Thank you, Mr. Chairman. Mr. Herbert, I'd like you to turn to rebuttal exhibit, I believe it's DEU Exhibit 2.09R.
Yes, I'm there.
Okay, and just so we all understand what this exhibit is, it's a list of gas rate cases in which the commission had, from, what was it, 2015 through the end of, I guess, September of 2019? Is that right?
Yes, that's correct.
Okay. I want to focus your attention on one entry, and this is a follow-up question to a question that you received from Major Kirk
Okay.
earlier this morning. He had asked you about a Colorado ruling, ROE of 9 point, I can't remember what, whether he said 9.3 or 9.35%. And your response was you didn't remember whether that was a gas or an electric case. And so I'd like to point you to, I guess if you're looking at the paper copy, you don't have the row numbers, but there's a Colorado entry with the date of December 21 of 2018 with a 9.35% ROE. Do you see that?
I do see that, yes.
Okay, does that refresh your recollection as to whether the one he was referring to, or whether there was a Colorado ruling in a natural gas rate case?
Yes, it does.
Okay, all right. And just for the sake of it, going to the other side of Utah, Nevada, the two entries below that showing the Southwest Gas Corp rulings with ROEs of 9.25%. Do you see those as well?
Yes, those were in 2018 as well.
Right, but within the last 12 months, correct?
Yes, correct.
If only barely.
If only barely.
Okay. And we mentioned, we established that this exhibit identifies rate case rulings from 2015 through the end of September, or near the end of September of 2019. I just want to make sure I understand how to read this. On the very bottom right-hand side of the last page of this exhibit, you have an average and median. That's for that entire period, correct?
For the entire period, correct.
So that the average period for all of these is 9.62% ROE, right?
Through September 2019, correct.
Right, yeah, for the entries just on this chart. It doesn't include some of the other ones that were mentioned in prior questioning that may have been outside of this period. And then the median, at least for this chart, is 9.6% ROE. Is that correct?
Over the entire period, correct, yes.
Yeah, for the period that's encompassed in this chart, right?
Yes.
Okay, that's all I have.
Okay.
All right, that's all your questions, Mr. Russell? Okay, thank you. Any redirect from
Yes,
Dominion?
please. I'll pick up where, is that picking me up? I'll pick up where Mr. Herbert left off, or where, sorry, Mr. Russell left off, Mr. Herbert. Do you have an understanding of what the average ROE was from the last rate case in 2013?
My the average authorized ROE in 2013 was 9.68%.
Okay, and do you have and what's your understanding of what the average ROE is at present?
Present, it's about 9.7%.
Okay, so fairly comparable.
Quite comparable, yes.
Okay. I want to confirm the company's, your understanding is the company's authorized ROE currently is 9.85%?
Correct.
I'd like to talk about, you were handed two documents earlier today, and if you could pull those out. One is OCS Cross H2 and OCS Cross H1. Would you put those in front of you?
Yes, I have them.
Earlier, you were testifying about, you were asked the question about what has changed for the company between 2013 and 2019. And I'd like, if I could, to have you refer first to OCS Cross Exhibit H2. And if I could, would you read on page 2 of that document the paragraph called Rating Outlook?
Yes. Under Rating Outlook, it reads, "The negative outlook for Questar Gas reflects the company's financial profile, which has been weak for the rating since Dominion acquired the company in 2016. Moody's expects Questar Gas to generate a ratio of cash flow to debt in the high teens range over the next few years, primarily reflecting a decline in cash flow triggered by a general rate freeze, tax reform, and increasing debt.
Okay. So what do you understand that paragraph to be communicating from Moody's? What are they trying to tell the company relative to why they're rating it the way they are?
That the company had a negative outlook at that point in time because its credit metrics were weak for its rating, meaning it was weak for the guidelines that Moody's had for the company's rating. And looking forward, Moody's expected the company to generate a cash flow to debt in the rate of the high teens, and that too weighed in Moody's determination of the company's credit rating at that time. But the principal point being that the company's financial profile was weak for its ratings category.
And in particular, they appear to be concerned, do they not, with the cash flow that they say was the decline in cash flow triggered by a general rate freeze, tax reform, and increasing debt.
Correct, and again, as we talked about a little bit earlier today, it's cash flow relative to debt at the time.
Right. Now, if you could go down to the section called factors that could lead to a downgrade, would you please read that section?
Yes. Cash flow to debt metrics below 20% on a sustainable basis. And second, if regulatory provisions in either Utah or Wyoming were to become less supportive.
So let's deal with the first of those items. What do you understand the first of the items to mean?
That means if the company's ratio of cash flow to debt, which Moody's expected to be in the high teens, if it were to fall below 20% on a sustained basis, so looking forward based on the company's expected financial condition, if that ratio were to fall below 20% on a continuing basis, that would be a factor that would lead Moody's to downgrade the company.
Okay. And then what about point 2 there?
If regulatory provisions become less supportive, regulatory provisions can be a broad category. It can refer to regulatory relations, it can refer to the regulatory climate, it can refer to rate mechanisms. But if any of those were to become less supportive, if they did not continue to support the company's current credit profile, then Moody's would consider that a ratings negative and a factor that then could lead to a downgrade.
Okay, now flip over to the next page, page 3. About halfway down there is a highlighted, or a bolded sentence that says weakened cash flow will persist over the next 18 months, but managing financial policies should help improve metrics. Could you just read the first sentence there of that section?
Yes, it reads, at about 14%, Questar Gas's ratio of CFO pre-working capital to debt through the last 12 months of the third quarter 2018 is much lower than A2 LDC meaning local distribution company, peers that have averaged around 23% over the same period.
Okay, and can you explain what you understand that to mean?
It means that Moody's looks at the company's cash flow to debt ratio, not only on an absolute basis, but also relative to the company's peers. And at 14%, that ratio is well below the company's peers at about 23%.
So from an investor standpoint, and based on your professional opinion, how might investors be viewing this data or this information about how Questar Gas is performing relative to its peers when they consider the kind of rate of return they would require to invest in this kind of company?
Well, we talked a little bit earlier this morning about the fact that the cost of capital is comparative in nature. It's based on the foregone opportunity to invest in another company of equivalent risk. If now you see a company with higher risk than its peers, if you see a company that at the margin is going to have cash flow ratios that are lower than its peers, indicating higher levels of risk, that would suggest to an investor, certainly debt investors and equity investors as well, who again look at these issues on a relative basis, the company would be comparatively more risky, and therefore you would require a comparatively higher return to invest in it.
Okay. Could I now have you, in your binder there, look for Mr. Mendenhall's rebuttal testimony? And there's an exhibit attached to it, which is exhibit, DEU Exhibit 1.10R.
Zero R?
Yeah, that's correct. Or, excuse me, I apologize. 1.01R. Apologize. Yes, thank you. Should be right after at the end of the testimony there, where the exhibits pick up. Very first exhibit following his rebuttal testimony.
Oh, let's see. I'm sorry, it's going to take me a minute.
Keep, at the very top right corner, you'll see there's some exhibit numbers if you're in the exhibits.
The exhibit numbers. And I'm sorry, the exhibit was?
I don't think he's, yeah.
101R?
101R.
After all these years.
There you go. We were just reviewing the prior Moody's Investor Service report that was dated January 30th, 2019. I'm now showing you this Exhibit 101R that is the update from Moody's as of August 19th, 2019. Do you see that?
I do, yes.
I'd like to now refer to the same sections we just looked at on the prior exhibit and have you focus in, if we can flip over to page, well, I guess let's first on page 1. This report was issued in the context of a downgrade. Is that right?
It was, yes.
Okay. And then on page 2, the address, Moody's address is part of the reason that there was the downgrade. I'd like to focus at first at the top of page 2 where there's the credit challenges. Do you see that section?
I do.
In particular, can you describe what you understand Moody's to be highlighting from a credit challenge standpoint? What do they mean by that?
Credit challenges are generally factors that Moody's will consider that if they move the wrong way, if they create pressure for the company, could lead to a ratings action, could be a ratings action such that they put the company on watch or that they actually wind up with a downgrade.
Okay. And let's look down at the factors that could lead to a downgrade. You see those 2 points. Would you please read those?
Yes, the first of the 2 factors is cash flow to debt metrics below 16% on a sustained basis. And the second is if regulatory support or the ability to recover costs were to decline.
So on the first bullet point there, the one we just read a moment ago was if cash flow remains below 20%. Now they've moved it down to 16 and indicated that if it's below 16 for a sustained period of time, that could lead to a further downgrade. Is that your understanding?
That's right.
And then regulatory support language appears to me to be the same as the prior document. Is that your understanding?
It is.
So then lastly, I guess let's look at the ratings outlook section just above that. Would you read that, please?
Yes. The stable outlook for Questar Gas reflects the company's low business risk and stable cash flow production. The stable outlook also incorporates our view that the current rate case in Utah will yield a higher rate base and net income, helping the company to generate cash flow to debt metrics between 17 and 19% for the next 2 years, and that short-term debt and upstream dividends will be increasing.
Okay. So now, having reviewed those 2 documents, I'd like to discuss some of the questions you were asked by several of the attorneys. There was a discussion about why couldn't you just, if you're DEU, take your 60% equity and reduce it down to 50% on an operating basis? Why wouldn't you and why couldn't you do that? I'd like to probe that for a moment with you.
Okay.
As an initial matter, has the high equity ratio been supportive or not supportive to maintaining the current credit metrics?
It has been supportive.
What do you mean by that?
It means that if the company were to have had a lower equity ratio, if it were to have had more debt in its capital structure, there would have been more pressure on its cash flow metrics, putting downward pressure on its credit rating. So the 60% equity ratio has been supportive of the company's credit profile.
So if one were to make the decision internally at Dominion Energy Utah to take and go from 60% down to 50%, what would be required to do that?
If you were to move down to 50% and have your actual capital structure be 50%, it would mean taking equity out of the capital structure. You would have to send equity up to the parent in the form of a dividend.
Is that what you meant earlier when you said used the phrase dividend up?
It is, yes.
And how does one come up with the cash the ability to pay that kind of a dividend to bring your metric down?
Well, in this case, you have a company that whose cash flows are strained. You certainly could not get more equity because that would be counterproductive to wanting to bring the equity ratio down. That would leave you to going to the debt markets to get cash that then could be sent up to the parent.
So let's assume we did that. Let's assume we went out and you had a couple of attorneys ask you about, isn't the cost of debt cheaper than the cost of equity? Why don't we just go borrow whatever, $100 million or $200 million to dividend up to make that up? What impact would that have on the company's credit metrics, do you think?
Well, if we remember that the ratio is cash flow to debt, and cash flow is generally net income plus sort of non-cash elements. Net income is a big part of cash flow. If the equity ratio were to be reduced in this proceeding, the company's net income would fall. If you had to issue debt in order to dividend up equity, then the denominator, the amount of debt in your capital structure, would increase. You would face the situation where cash flow is falling, debt is increasing, your ratio of cash flow to debt would be going down further still, putting downward pressure on the metrics that Moody's has identified as an important factor that could lead to a further downgrade.
And that's, when you say that, are you referring to the cash flow to debt metrics below 20 or 16% issue?
It is.
Okay. Now, you've heard, I want to, now having talked about all of that, you've reviewed information from the rate case in 2013. You've reviewed information to prepare your documentation for this proceeding. In your mind, what has changed between the company's position in 2013 versus the company's position in 2019?
Well, I think we can just look to what Moody's has said. We can see the degradation in the important cash flow metrics. Cash flow to debt, we've seen it fall. And importantly, we've seen Moody's talk about the fact that the company's position is weak relative to its peers. And again, not to overstate the point, but when we talk about the cost of equity, it is a relative exercise. And so we look at it relative to its peers. If the company's becoming weaker relative to its peers, it's becoming more risky. And therefore, investors would require a higher return.
Let's emphasize that point at the end. I want to make sure you have an opportunity to clearly understand that. ROE, or the return on equity, is the rate at which investors, it's the rate at which the investors are compensated.
The equity investors.
The equity investors, correct. And could you please explain that last point where you said that if the risk, if investors view the company as being higher risk, that would inevitably require a higher rate of return on equity?
The basic principle in finance is that risk and return are related. The more risky an investment, the higher the return investors require to commit their capital to it. If we were to look at a group of peer companies whose risk is lower than this company, they may put their money there. The only way they would invest in a higher risk company is if the return is high enough to compensate them for that additional risk. So if the company's risk profile has increased over time relative to its peers, the only way you'd be able to reasonably attract capital is to offer a return that compensates investors for that additional risk. So the return would have to be higher than it otherwise would be.
So in your estimation, is Dominion Energy a higher risk investment than it was in 2013.
Well, I think if we just review the Moody's documents, we have to come to that conclusion.
Okay, thank you. I want to talk about a couple of other issues. You were shown an exhibit DPU Cross Exhibit 1, which is some rebuttal testimony of Michael L. Platt from docket number 19-057-13.
Yes.
It's probably going to be a loose exhibit there. And I know you testified you don't know anything about that, so I'm going to ask these in hypotheticals.
Okay.
I want you to assume, for the sake of my questions, that the facility at issue in this particular proceeding that's in Mr. Platt was testifying about is not constructed and will not be completed until 2022.
Okay,
You have that in mind?
I do.
I also want you to assume that it's not, the aspects of that facility are not included in the revenue requirement in this particular proceeding. You have that in mind?
I do.
Given those two if those are both true, then does anything you have to say here, or would anything relating to that facility have any bearing on what you're saying for purposes of the rate of return on equity in this case, or the capital structure in this case?
No,
Why not?
it's simply not part of the case we're looking at right now.
You recall you were asked about the question about an insurance policy. If that
Yeah.
insurance policy doesn't yet exist and won't exist till 2022, should you or anybody in your position be factoring that in when you're calculating the return on equity for this case?
No, I have not. It's beyond the case.
Could you turn to line 798 to 800 of your direct testimony, which is on page 43?
Yes, I'm there.
Could you just read the sentence that picks up there right at the bottom? On 798, it picks up at 798 and goes over the page.
There's a sentence that, in my direct testimony?
Yes.
Yes. As the percentage of debt in the capital structure increases, so do the fixed obligations for the repayment of that debt.
So what do you mean by that?
It means that as you add more debt into the capital structure, you have to pay that debt regardless of your revenue. It is a contractual fixed obligation that remains in place regardless of what other elements of your revenue structure, your cash flow change.
So if, I want to follow up on a question that was asked by another attorney. If you were to go out and increase your debt for any of these operational purposes, whatever they happen to be, what kind of, how would what you're saying here factor into the company's return on equity?
Well, to the extent the amount of debt in the capital structure increases relative to what you consider to be a proper target, when you have more leverage in the capital structure, you increase those fixed obligations, and therefore the probability of not meeting those obligations increases. It's a matter of financial risk. It's a matter of leverage. The effect of leverage is it tends to concentrate risk on the equity holders, because in the end, it will be the equity holders who are responsible. So as you add amounts of financial leverage, you increase financial risk. And I think we talked about earlier this morning, the two general categories of risk are business and financial risk. As financial risk increases, the return required by investors, equity investors, also will increase.
Thank you. Could you now locate OCS Cross Exhibit H1? It's the AGA rate and regulatory update.
Yes, I have that.
First off, what do you understand this document to be?
It is a document put out by the American Gas Association summarizing rate and regulatory activity by states.
And this is only related to gas cases, right? Rate cases?
Correct.
So there at the top, there's two boxes. One says orders issued and one says average ROE. What do you understand the numbers in those boxes to mean?
That would be the orders issued for natural gas utilities across the country, and the average return on equity associated with those orders from July 1st through September 30th, 2019.
And would you read the first sentence that is right below those two boxes?
Yes, it reads, the average ROE authorized gas utilities was 9.94% in the third quarter of 2019, compared to 9.69% in the second quarter.
And what do you understand that to mean?
That quarter over quarter, the average authorized return increased. It is, in the third most recent quarter, was 9.94%.
Now let's go down to the bottom sentence of that first paragraph, if you'd read that as well.
The bottom sentence reads, there were only 10 gas cases that included an ROE determination in the first 3 quarters of 2019 versus 40 in 2018. In the first 9 months of 2019, the median authorized ROE for gas utilities was 9.72% versus 9.6% in 2018.
So if I understand correctly, in 2018, the median there was 9.6. The first 9 months was 9.72, and updated through September 30th is now 9.9, or 9.94 was from July 1st through September 30th.
Correct.
And would you characterize that as an upward trend in ROEs, at least according to the AGA?
Yes, at least according to the AGA and these data points, yes.
Oh, and the 9.94, is that number within your range of reasonable ROEs that you have determined in this proceeding?
It is. The lower bound of my range is 9.9%.
And are the ROEs recommended by any of the others who have appeared in this case within the, are any of the averages over the 18, 19, or 19 revised through to September 30th within the ranges recommended by anybody else in this proceeding?
No, they are not.
In other words, they're all above those ranges recommended by the others.
The authorized returns are above the ranges recommended by others, correct?
All right, 2 other questions. You were asked about the effect of, when you add income taxes after the ROE is determined. You were asked about what that the cumulative number would be. My question for you is just, do we take into account what the income tax portion will be when we determine ROE in a case?
No, the ROE number is typically looked at on an after-tax basis.
And then finally, you were asked about a Virginia case. I just want to make sure I'm clear. Was that a general rate case?
It was not.
So and it is your understanding that this is a general rate case?
It is.
Okay. I have no further questions.
Thank you.
Okay, thank you. Any recross, Mr. Jetter?
I do have a bit of recross, thank you. You just testified a moment ago that I'm going to summarize here, that the commission should ignore known events in the relatively near future with relationship to the liquid natural gas facility. Is that accurate?
I testified that it's beyond this case, it's beyond the materials we viewed in the context of this case, correct?
Okay, but is the timing of that the basis, or is it that you have not reviewed that?
The large part, the timing, yes.
Okay, and do you expect decarbonization to happen in the next 3 years?
Oh, that's a point I made earlier. It's a long-term issue, and it's unpredictable in terms of both its effect and timing. I agree with that point.
We should consider that factor, but not a very specific known factor that will occur in about 3 years.
Well, what I said was that if you look at what we've seen, for example, in the investment community, there are concerns related to decarbonization. Now, I was quite clear, the effect and timing are extraordinarily difficult to quantify.
Okay, but it is your testimony that that should be considered?
It's my testimony that the investment community has noted that concern.
Okay, and is it your testimony that the investment community would not be interested in a significant risk reduction in 3 years' time?
Again, I'll go back to what we talked about earlier. I don't understand the issue of the risk reduction in the context of that LNG analysis, so I just can't comment on that.
Okay, so you're not sure whether it should be considered or not?
No, what I said was I don't understand. I don't know this testimony. I don't know that analysis. I don't know what's meant by risk.
Okay, so you don't know whether investors should consider this?
I've told you my view on that. I've told you that my view is that I understand investors have noted the risk of decarbonization and electrification. And I've explained to you that I don't know this testimony, I don't know the analysis, I don't know the discussion of risk or even the definition of risk.
Okay, so that's a little bit different than a statement that the commission shouldn't consider it.
I can only tell you what I can do.
Okay, thank you. And I just wanted to clarify something that was stated earlier, I just think an error. On OCS Cross Exhibit H1, I believe it was stated that the 9.94 was a median, and is it accurate that that's an average?
Oh, if I said median, I didn't mean to. It does say average here.
Okay, thank you. Those are all of my follow-up questions. Thank you.
Thank you.
Mr. Moore?
Can I direct your attention to OCS Cross H2,
Yes, sir, I'm there.
the front page?
Yes.
There are some credit strains noted by Moody's too, aren't there?
I'm sorry, what was your question?
The last highlighted heading, credit strength.
Oh, yes, absolutely.
Could you read those into the record?
Sure. Stable and predictable cash flow derived from cost recovery mechanisms on around $1 billion of rate base, cooperative relationships with regulators in Utah and Wyoming, management financial policies are improving the capital structure, and ring fencing like provisions help offset some of the risk of its highly leveraged parent. I think we've talked about all four of those points throughout the morning.
Thank you. I'm not sure, Chairman, that I moved for omission of OCS Cross H2. I'll move for omission now to double check that.
I also can't remember, but if any party objects to that motion, please indicate, Jimmy. I'm not seeing any objections, so the motion's granted.
That's all I have.
Okay, thank you. Major Kirk.
No question, sir.
Mr. Meekum?
Just one quick one. Mr. Hebert, weren't the concerns that Moody's expressed in the, I guess it's Mr. Mendenhall's 1.01R, expressed in the context of the company relying heavily on equity, including retained earnings? And in other words, if they had done or issued more long-term debt, wouldn't that have freed up more cash for cash flow?
No, I think it's the opposite. I think what Moody's is saying, the company retained cash to build up its equity cushion so that it could mitigate some of the risks associated with its cash flow. It is that financial management policy of putting additional equity in, creating an additional equity cushion that helped mitigate some of those risks. And absent that cushion, the risks would increase.
Nothing further.
Okay, thank you. Mr. Russell?
No questions, thank you.
Anything else from Dominion? Yeah, I'm sorry. Anything
No,
else?
no further, nothing further from me.
Okay. I just have one or two questions. So when investors are looking at utilities, we've had some questions recently about how far into the future they look. I mean, does the test year of a rate case have much impact on investor outlook on a regulated utility?
Yes, it can, because if you were to look at the resolution of a case, and I think a good example are some of the comments by Moody's. The resolution of a rate case will speak to the cash flow that would be expected over at least the near term and going a little bit into the future. So that's certainly one element, that the outcome of the outcome of a rate case will affect the cash flows. But secondly, the resolution of a case, as Moody's says here, will be a signal to the financial community regarding the nature of the regulatory environment, the company's relationship with the regulatory commission, the stability and predictability of the commission. So while I agree many of the models are long-term, the current case, the current test year, the resolution of the current case is important.
Regulatory approvals of capital investments that aren't going to occur till after the rate case, though, would affect that regulatory environment, wouldn't they?
Depending upon the terms, yes, I agree with that.
Just one or two more questions. In your direct, you cite to this study by the American Gas Association, I assume commissioned through ICF on decarbonization and electrification. It was titled Implications of Policy-Driven Residential Electrification, correct?
Correct.
Were the policy-driven issues typical of Utah that the AGA was studying?
It's a good question. It's very broad, Race. And as I think I'd mentioned this morning, a lot of the concerns regarding electrification, at least based on my observation, now are focused on the coasts. And that's where we're seeing a lot of the discussion. But when we think about the risks generally to the sector, it's something investors would have in mind. I do think that when we look at this type of risk, and perhaps this type of uncertainty is the better term, and I say uncertainty because the implications are very difficult to quantify. When you say risk, you normally have some history, and you can look at the probability of something happening, and you can associate numbers with it. But here we have uncertainty. We don't know what's going to happen, when it's going to happen, what the implications are going to be. So I agree with you that the policy implications are not necessarily what they are here in Utah. The circumstances might not necessarily be what they are here in Utah, but the broad concern is there.
Okay. Thank you. That's all I have. Commissioner Clark?
Thank you. Back to Virginia for just a second. I
thank you.
apologize for taking us there, but I'm just curious. What I think, at least what I understand you to have told us, is that the return on equity that was approved in a recent order in Virginia does not apply to the rate base of the utility, or at least not the general rate base. It might be applying, or the commission might intend that it apply to certain components of rate base. But can you give me a more precise explanation there as to
Yes,
what it's
sir.
applying to? Thank you.
There are two components. The first has to do with what are referred to as the rate adjustment clauses, RACs. And they have to do with specific discrete investments in certain types of assets, generally generating assets. And it goes back to legislation in Virginia that was meant to encourage the development of in-state generation and the development of renewable resources. So when the company would develop a project and commit equity to that project, because it was in part in furtherance of achieving a public policy goal, the company would be eligible for what the legislature referred to as an enhanced return. And depending upon the nature of the asset, whether it's a carbon capture type asset, whether it's offshore wind, whether it's nuclear, the enhanced return would be from 100 to 200 basis points over the base return. So that would mean it would be anywhere from 10.2 to 11.2% for those projects, depending upon their nature. And I would say that that return would be in place not for the life of the project, but for, in some cases, the first 10 or 15 years. And I'm sorry, I mentioned there were two pieces. The second piece was, I should have thought about this. The second piece was for what they refer to as the triennial earnings test. So the evolving legislation in Virginia means that in 2021, for Virginia Electric and Power Company, the commission will review the company's earnings relative to the 9.2% plus 70 basis points, so 9.9%. The commission in that first triennial review, easy for me to say, triennial review in 2021 will not be able to increase the company's rates and can only decrease the company's rates by $50 million.
So this enhanced return is applied to policy preferred or preferenced assets, the 9.2%, is it irrelevant with respect to the rest of the rate base of the Virginia utility that's we're talking about, or is it applied to the rest of the rate base?
It is not applied to the rest of the rate base. The company's current rates are in effect. The general generation distribution rate base, not including those special projects, will go on earning their existing return. The only time those assets will be subject to a test under this most recent return will be in 2021 in the triennial review, if the return is beyond that 70 basis point deadband.
Thank you. Now, with regard to, and I'm really asking about the LNG facility, but I'm going to put this in sort of hypothetical terms so that I can understand or present it to you in a way that I think you can fairly consider it without being familiar with the case itself. But
Okay, appreciate that.
just assume that a significant asset, by that I mean, say, costing in excess of $100 million, is the subject of an application that comes to the commission under a statute which allows the company to seek advanced approval for investing in the asset, and which presumes a level of cost recovery that is whatever the proposed cost is in the application proceeding, if it's approved, and assume that it is approved, and so there's this approval of a yet to be constructed asset with some assurance of cost recovery that comes via this statutory structure.
Yes.
Is that approval going to, how is that approval going to be assessed in Moody's view of the degree of regulatory support in the jurisdiction?
And without speaking for Moody's, but just based on my experience dealing with them,
Right.
what I would say is that if there was a project that had received pre-approval, I think from the rating agency's perspective, they will look at pre-approval, the possibility of some disallowance at some point. But if the project is in line with what it sees elsewhere, if the project is the type of project that would normally go into rate base, as it would in other utilities, I think Moody's would look at that, as we've talked about here earlier today, as a supportive arrangement. One of the issues we sometimes see is while some legislation, while some programs will speak to pre-approval, in the final analysis, there's always some element of post hoc review which might open the company up to some level of disallowance, but typically for prudence reasons. But I think generally speaking, that type of legislation, that type of structure would be something that would be supportive, much like we see with infrastructure trackers in some cases, forward-looking test years, in some cases, multi-year rate plans.
And sophisticated investors would have the same view, would you expect?
I think so.
Thank you. Those are all my questions. Thank you.
Commissioner White?
Good afternoon.
Good afternoon.
Just want to go back to a line of questioning prior to lunch. I just want to test my understanding, which wasn't that great, of what you were saying with respect to the concept of risk supportive versus risk reducing. And I think in the context of regulatory mechanisms, I just want to make sure I understand that, how that affects it. I mean, in Utah, you're probably aware that we have a number of those types of
Right.
mechanism, so help me understand that.
Sure. So I think the conversation had to do with the distinction between, and I'll back up, this is from the perspective of the rating agencies, had to do with the distinction between something that is credit supportive versus something that is credit enhancing. A credit supportive mechanism would be something that's put in place that would mitigate the downward effect that otherwise would occur, but for that structure. So one example that I sometimes use, and it doesn't come into play here, but it's, I think, easily understandable, is companies with a bad debt rider. If a company has a large bad debt expense, and then they have a mechanism in place to help recover that expense on a more timely basis, that is credit supportive. What it does is support the company's credit profile, because absent the mechanism, its profile would be diminished. It does not improve the company's credit profile beyond what it otherwise would have been. So that's the distinction we try to draw.
So the current, is it safe to say that the current mechanisms in place support the status quo of the outlook of the company's risk profile?
Yes, I think when we read Moody's, the language speaks to the supportiveness of the regulatory environment, which is good.
The question I had, I know that you've had a lot of, probably more than you were anticipating on electrification, but it's a pretty fascinating issue right now. What other than the investor outlook, kind of these general, my sense is that it's more of a general kind of sense of, sussing the future. Are you aware of any jurisdictions, both FERC or state jurisdictions, that have actually applied this concept with respect to a risk profile that flowed through a equity, order?
Not yet. I know it's an issue that has come up. It's come up in an unfortunate way in Massachusetts, for example, because what began thinking about the issue in Massachusetts was the incident in the Merrimack Valley, where there was a high-pressure system that destroyed many homes. And at that point, the risks associated with gas were starting to be considered, and electrification was starting to be thought about. But it's too early yet. It's not something that anyone has put a number on. It's a concept that people have talked about, but it's just too soon to come to a definitive conclusion.
And maybe related to that, and I apologize that this is a legal question, but and maybe I should know this already, but I'm just trying to figure out. I get the concept of how the investment community looks at kind of long-term ratings and things like that, but I'm trying to figure out the sandbox that we should be playing in. In other words, when we should be applying risk elements to what period of time. And I think we've kind of danced around this with respect to the LNG and maybe even the decarbonization efforts, but is that in this case, what should we be looking at in terms of what is currently in play that we should be applying to this case? And again, I recognize that may bleed into legal theories, but...
Oh, that's okay. Yeah. I think in this case, we have, it's fairly clear with the company's recent downgrade and with Moody's concerns about the company's credit profile. I don't think we have to look that far into the future because this just recently happened with the company. So in this proceeding, I think we just don't have to look very far into the future. We've seen what would happen, and I don't think we have to think too far into the future to realize that it's important to maintain the company's credit profile. And the equity ratio, the return on equity, are two things that are very important, not only in supporting the company's cash flow, but also in signaling to the investment community the support of the commission. So in my view, in this case, we have a pretty defined view, and we can look right to what has happened and what likely would happen absent a supportive outcome.
Let me circle back to this. So if I hear you correctly, it sounds like the general time parameters or outlooks of the investment community and how they perceive risk and cash flows, et cetera, don't necessarily sync up to for example, a test year or a rate effective period. These two concepts sometimes conflate and can potentially bleed over into each other, but they are counter reactive.
Well, it's an interesting question. The outcome of a current rate proceeding, of course, is very important because it will affect the near-term cash flows. Simply because of the time value of money, near-term cash flows are more valuable and so will be of more importance. But here, because we have a situation where the company has been, again, downgraded, and to me, equally important is the commentary about the company's financial strength relative to its peers. The resolution of this case, I think, will go some ways to speaking to the financial community about the company's financial profile going forward. Yes, some models look forward in time, but here, the resolution of the case will give a strong signal to investors as to what they might expect looking forward.
Thank you. That's all the questions I have. Thanks.
Thank you.
Thank you for your testimony today.
Thank you, sir.
And we're ready for your next witness.
We have an expert who needs to leave today on a flight tonight, so we're going to take Mr. Alan Felsenthal as our next witness.
Good afternoon, Mr. Felsenthal. Do you swear to tell the truth? I do. Thank you.
Mr. Felsenthal, good afternoon. Would you please state your full name for the record?
My name is Alan Felsenthal. F is in Frank, E-L. S like Sam, E-N-T-H-A-L.
Mr. Felsenthal, would you please introduce yourself to the commission, providing a brief sketch of your background and your experience?
Okay. I'm a managing director at PricewaterhouseCoopers.
And I'm not sure your microphone is on.
Push up.
Thank you.
Is that better?
Yes.
I'm a managing director at PricewaterhouseCoopers, and I'm presenting testimony on behalf of Dominion Energy Utah, supporting the company's rate-making position on pension costs and related components.
Mr. Felsenthal, you've submitted in this proceeding some rebuttal testimony, is that correct?
Yes.
I have that marked as DEU Exhibit 6.0R with Exhibits 6.01R through 6.03R. Is that accurate?
Yes.
Do you have any corrections to your testimony?
Well, I have one. It's on page 7, line 177. There's a number there that says 8.18 million. The correct number needs to be 5.61 million. And that's it.
With that correction, Mr. Felsenthal, do you adopt the rebuttal testimony and the exhibits you've submitted in this proceeding as your testimony for this proceeding?
I do.
Have you prepared a summary of your rebuttal testimony that you've provided in this case?
I have.
Would you please go ahead and provide that to the commission at this, before we do that? I move to admit exhibits DEU 6.0R, 6.01R through 6.03R into the record.
If anyone objects to that motion, please indicate to me. I'm not seeing any objections, so the motion's granted.
Mr. Felsenthal, go ahead and provide your summary now.
Okay, well, thank you. Let me start off by saying I've had an over 40-year career, primarily at Arthur Andersen and PwC, and I've been focused during that career on audits of regulated utilities, as well as providing consulting, rate case advisory support, and training, various seminars on utility accounting, income tax, and regulatory issues. Over the course of my career, I presented testimony in 10 regulatory jurisdictions and at FERC. In its rate case application, the company has removed all pension-related components, which are the prepaid pension cost, a prepaid pension asset of $112.5 million, the related accumulated deferred income taxes, $27.8 million, and pension expense, which in this case is a pension credit of $5.5 million from the revenue requirement determination. Company witness Stevenson supported this position on the basis that Dominion Energy Utah did not contribute to the pension trust in 2017 and 2018 and does not anticipate making cash contributions to the pension trust during the test period. Both OCS and UAE disagreed with the company's treatment of pension expense and recommended an asymmetrical rate-making treatment by including the negative pension expense and revenue requirements while excluding the other components, the prepaid pension asset from rate base and the ADIT. That is the asset, the prepaid pension asset, that is responsible for the pension credit, denying any return associated with this amount. I'm not going to pretend that pension accounting is easy. It's a complex issue, but it's important to understand the interplay between pension costs and credits and the prepaid pension asset to conclude why these components must be treated consistently and symmetrically. My understanding is that this is an issue of first impression for the Utah Commission. Historically, the company has always incurred a pension expense and has always made cash contributions to the pension trust for the benefit of its employees, both current employees and retirees. Now the company has a pension trust that's fully funded, and accordingly no contributions are required. The inequitable results stemming from the proposed rate-making position advocated by OCS and UAE, providing customers the benefit of the lower pension expense, in this case negative, without compensating investors the source of the prepaid pension asset that is lowering pension costs. The existence of a pension credit does not produce funds to lower the company's overall revenue requirement. It's a journal entry. Earnings on the assets in DEU's pension fund can only be used to meet DEU's pension service obligations. In other words, DEU does not have discretionary use of such earnings, which contribute to a reduction in, or sometimes, like in this case, a negative pension cost. So what's important is to understand there are two concepts. Generally accepted accounting principles, GAAP, pension expense, recognizes the cost of employees' retirement benefits over the employee's service period. It has several components that are determined on an actuarial basis. However, contributions are made to a pension trust to comply with ERISA and IRS requirements in order to ensure that the funds are available to meet the retirement obligations. These two concepts are different. A prepaid pension asset is the difference between contributions to the pension trust in excess of the cumulative GAAP pension expense. The key components to determine the GAAP pension expense are service cost, which is the actuarial present value of the benefits for employees for a given year, and because present values are used, the second component of pension expense is the interest cost. Conceptually, service cost and interest cost are generally independent of how or even if the plan is funded by the employer. The third component of pension expense is the expected gain or loss on the plan's investments in a given year. To the extent that that asset exists in a pension trust, applying an expected return on such assets reduces pension costs. This is important. The prepaid pension asset reduces pension costs. As I've explained, the prepaid pension asset is the amount of contributions to the pension trust in excess of cumulative pension expense. Because pension expense is included in the determination of revenue requirements, the source of the prepaid pension asset is investors and should earn a return. In this manner, customers benefited from a reduced pension cost occasioned by the existence of the prepaid pension asset, and the investors are compensated for this provided benefit by receiving a return on contributions to the pension trust above the level of pension expense. So these are the pension factors that need to be dealt with in the context of rate making and the revenue requirement. Prepaid pension assets, pension costs, and the related accumulated deferred income taxes. These factors are interrelated. The company has excluded all of these components in their filing because they are not currently or expected to make further contributions to the pension trust. This approach follows FERC precedent and is symmetrical in that all components are eliminated. This approach is also consistent with the position taken by other affiliates of Dominion when the pension trust is fully funded. Hope Gas in West Virginia, East Ohio Gas in Ohio, and more recently, FERC ruled and affirmed this rate-making treatment to eliminate all pension components, including the exclusion of a pension credit from a revenue requirement calculation in a Dominion Energy Transmission tax reform proceeding. The approach advocated by OCS and UAE provides customers the benefit of the lower pension expense, in this case negative, without compensating investors, the source of the prepaid pension asset that's lowering pension expense. An alternative but symmetrical approach, which I talk about in my testimony, could be to include all elements in the cost of service. Under a fair and equitable and symmetrical approach, revenue requirements would include all components, the pension credit, and a return on the investor-supplied prepaid pension asset which produced the reduction to pension cost. This approach produces a similar result to that recommended by the company in its filing. The bottom line is that for rate-making purposes, all pension factors should be treated symmetrically. So what I've done in my testimony is I've said that to be symmetrical, you can exclude all the components or include them all. In both cases, you get close to the same answer. The company's advocated for the exclusion of everything. They've relied on FERC precedent for that. An alternative approach is to include everything, which gets you to a very similar answer. Thank you.
Thank you, Mr. Felsenthal. Mr. Felsenthal is available for cross-examination.
Thank you. Mr. Jetter?
I have no questions, Mr. Chair. Thank you.
Excuse me, can we have a moment?
Yes. Do you want us to go off the record for a minute, or just a quick moment?
Just
Okay.
have a conference here with council.
Would you like us to go on to one of the other parties, or do you just want a few minutes?
You can go on to one of the other parties.
Okay. Major Kirk, do you have any questions for this witness?
No, sir, no questions.
Okay. Mr. Meekum?
No questions.
Mr. Russell?
Yes, I do. Thank you, Mr. Chairman. Mr. Felsenthal, I'd like you to turn to 9 of your testimony, please, starting at line 230.
Okay?
In that section, you include a discussion of pension expense and how it's treated under GAAP, some of which you summarized in your opening here. And I wanted to ask you a couple of questions about Financial Accounting Standards Board Opinion 87, or FAS 87, which you also discussed in your testimony. Maybe I'll start out by asking you to explain what that is, just to lay the groundwork here.
Okay, as I said, we'll call it FAS 87, is the pronouncement issued by the FASB that governs the accounting for pension costs. It was issued in 1987. It lays out the factors to include when measuring pension expense for the period. As I said in my testimony, there's, the first component is the service cost. That's the actual present value of the benefits for employees for a given year. Since present values are used, the second component is the interest cost. As time grows closer to when the benefits recognized in the past will be paid, the present value increases. This accretion of the obligation is measured as interest cost. Conceptually, service costs and interest costs are generally independent of how or even if the plan is funded by the employer. The third component of pension expense is the expected gain or loss on the plan's investments in a given year. To the extent that assets exist in a pension trust, applying expected return on such asset reduces pension costs. And since it's an expected return, the difference between the actual gain or loss on investments and the expected return is referred to as the actuarial gain or loss. And the FAS 87 allows this gain or loss to be deferred into future periods in order to reduce the volatility of the pension expense. The net effect of this deferral is to include the expected return on investments in the pension expense for the given year, and the remaining components of the pension expense are essentially the recognition through amortization of the deferral of actuarial gains and losses that occurred in the past, such as plan amendments or other changes in the pension benefits. FAS 87 allows these retroactive benefits to be deferred and amortized over the remaining service lives. Taken collectively, these components comprise the pension cost for a given year.
Thank you. I want to direct your attention to the discussion starting on line 257 of your testimony. The question there is, when does the pension accrual stop? Your testimony states that once the employee retires, his or her expense accrual stops and pension payments begin. Over time, pension expense, which considers investment returns on pension assets, reducing such expense, will equal the pension benefits paid to retirees, less expenses of the plan, if any. And I want to focus our attention on this second sentence, over time. Now, under FAS 87, expense is based on an accrual and not a cash basis, right?
Correct.
The amount of pension costs recorded is generally different than the actual amount of annual contributions made. Is that correct?
Yes, they're done on two different bases.
Right.
There's GAAP. GAAP covers the pension expense, the income statement amount, and the contributions are based on the government rules for funding your pension plans.
Now, over the life of the plan, however, total contributions are expected to equal the total FAS 87 expense, right?
Yes.
Okay. Now, you acknowledge, I think, in your testimony that current rates, in effect, include pension expense as part of revenue requirement, right?
The current rates,
Rates that are applied today, right now.
in the company's last rate case, there was a test year pension expense.
And the pension asset was not included in rate base in that last that last rate case, correct?
That's my understanding.
Okay. And do you know whether pension asset has ever been included in rate base in Utah?
Interestingly, and we said this in response to a data request, the company had a pension asset included in Utah in, you get the right year, it's data request 1104,
Who's?
Kelly Mendenhall. Can I read, you want me to read from it?
Well, can you tell me who asked the data request so that you and I are on the same page? And you've got something in front of
He's
you.
he's looking for the title at the top of the page. What, is it OCS? Is it?
OCS data request number 11.04.
Okay, is that in the testimony somewhere? What's the, just so he and I can both look at it?
No, I don't think it's in his testimony. I just think it's a,
It's a data request, it's response, data
Yeah,
request.
it's not an
response.
exhibit, okay.
It's an exhibit that
Ram
is
is- Ram-
part of Ms. Ramos's testimony if you want to look there.
Okay.
2.07, I think, Phil.
Okay, if you'd give me just a second, Mr. Felsenthal.
Sure.
It's connected to Ramos's director, Sir Rebuttal. Do you know? Sir Rebuttal?
Sorry about it.
And again, the number was OCS 11, what?
04.
Thank you, I'm there.
And I'm sorry, Mr. Schnarr, could you remind me again what the exhibit number is connected to the Sir Rebuttal testimony?
It's OCS 2.7S.
2.7S, thank you.
And it's, if you've got it up electronically, it's page 20 of 26 of that PDF.
There it is. I'm there, are you there? Okay, thank you. Okay, Mr. Felsenthal, I think you can go ahead and answer. Thanks for giving us a moment.
Was there, I'm sorry, was it, what's the, can you repeat the question?
I think the question that I asked you,
Question was,
Was-
have they ever included?
yeah, if you're
pension?
aware if they've ever included the pension asset in,
The response to the data request says the company can confirm that the pension asset was included in the 1999, 1995, and 1993 general rate cases as part of the 165 account, which is prepaid expenses. Following the 1999 case, the company changed the account from 165 to a payable to affiliates account. Following the 1999 case, the account related to the pension changed, and it's unclear why the company excluded the balance from rate base. Following the merger, Dominion Energy noted that the positive pension balance should include it in a separate asset account, and the company has included that account in its base period rate base consistent with the 1999 treatment.
do you understand that last sentence when it says noted that the positive pension balance, is that talking about the pension expense or the pension asset?
I don't know.
I don't either. So, at least from the looks of this response to a data request, the pension asset has not been included in rates, at least in the last 20 years. Is that right?
Not recently. Yes.
Okay. But it seems that pension expense has been included at least through the last two litigated rate cases. Is that right?
Yes, there's I think they provided a response, or in response to a data request, they submitted how much pension, or which rate proceedings, and what the pension expense amount included in rates was. I can add just one thing, that this prepaid pension asset, prior to like the mid-2000s, the pension asset was a small amount, because for the most part, the expense and the contributions were not that far off. What happened in 2006, the government put in what they call the Pension Protection Act, which increased the amount of contributions that the companies had to include in order to protect or make sure there was enough, that there was more on hand to fund the pension cost when they became due. So if you look in the contributions, and there's a schedule that's been provided, and I believe, find it. the response to data request 1105 shows that the contribution amounts have gone from a couple million of dollars a year from, let's say, 1998, until more recently, it's like, starting in 2006, it's 12 million, 10 million, 8 million. So the numbers went up considerably because of this Pension Protection Act, which required more contributions.
And in those years that you're referring to, where the pension contributions went up, that's also during the time that pension expense was included in revenue requirement during these rate cases that we're talking about, right?
Well, again, and this is in Ms. Ramos's rebuttal. In the well, depending where I want to go, in the 2008 base year with the 2010 rate case, there was 5.9 million of pension expense in rates. In the 2012 base year, 2014 test year rate case, there was, at the time we thought it was 8.18, but it's been revised, it's 5.6 million of pension expense has been in rates. So there has been, in those rate cases, there was a request to recover pension expense.
That request was granted, correct?
The request, in the test year, that amount was part of the price that customers were asked to pay in revenue requirement based on that rate case.
Okay, and as we said earlier, the pension expense over the life of the pension asset should equal the pension benefits paid to retirees, right?
Over the life.
Yeah, and if ratepayers are only paying, or if ratepayers are only asked to pay pension expense when pension expense is positive, doesn't that mean that ratepayers will overpay pension expense over the life of the pension asset?
Well, see, I disagree with the concept that you're stating. Ratepayers pay for service. The services, the amount, the price they pay is based on a test year estimate of costs. But as soon as that test year is over, the costs, what the ratepayer is paying in rates has no, I won't say no relationship, but there is very little relationship between the amount that the customer pays after the test year versus the cost that the company is incurring. So I don't think that, I would not argue that the customers they pay for service, they don't pay for individual costs. I don't think you can go to a customer's bill and say, well, here's your $100 bill for service this month, of which $6.25 is reimbursement of pension expense, and $6.50 is reimbursement of payroll expense. In a general rate case, where there's no tracking or true up, once rates are set, that determines the price, but it's not necessarily based on specific costs.
And in fact, you mentioned earlier that the company has not made a pension contribution since 2017, correct?
Correct.
And yet the rates that have been in effect since that time have included, I think you mentioned $5.6 million of pension expense in the revenue requirement, correct?
I'll say it again. 5.6 million was the pension cost included in the company's test year in its 2014 test year in its last rate case.
So yes, was the answer, is that right?
What was your question? The question was, in the last rate case, pension expense was one of the costs included in determination of revenue requirements. It was $5.612 million, and that's all I know. I can't say whether, and I wouldn't say whether in years after 2014 that the company that amount has been used to pay the pension expense that's been incurred for those years afterwards, whether positive or negative.
Let's talk for a moment about the pension asset. There are as you mentioned earlier, required minimum contributions to a pension fund, right?
Correct?
Utilities have some discretion, within limits, of course, in making pension contributions above those required minimum amounts. Is that right?
Yes.
And do you believe that a prepaid pension asset should be included in rate base?
Yes, definitely.
Okay. So how should the commission determine whether excess contributions, those above the required minimum, whether excess contributions to the pension plan are prudent, given the latitude that utility management has with respect to the amount of contributions and the timing?
Well, I don't want to speak for the company. The company can probably do it better themselves, but my understanding is they have a pension committee. They decide based on a number of factors how to fund the pension plan. They want to ensure that there's enough in the plan, in the trust, to be able to pay the benefits when they become due. And what I say in my testimony, the amount that the company pays comes from investors. I think the investors, as a result, the amount that's in the pension trust, in the prepaid pension asset, reduces pension expense to the benefit of ratepayers. And what I'm saying is, to the extent that the customers are getting a benefit of lower pension expense brought about by contributions by the investors, they're entitled, they should get a return on it.
My question was not about how the company goes about determining how to exercise its discretion to make pension contributions above the required minimum.
Right.
My question was how the commission would determine whether that decision is prudent.
Like I say, the commission would have to put its own judgment, I would guess, over that of the company in determining what's the company meeting with its actuaries, professional advisors, an understanding of the market, understanding of returns, understanding of pension benefit payments, what kind of risk they want to take. I think all those factors lead into how much how much the contribution can be for a given year. If you think about it, and I'll just use an example. If today we knew that the ultimate benefits that the company's employees would need once they retired was $3 million, and you could put in $1 million today, or $2 million, or some amount, which will, with earnings, accrete or produce income to get you that $3 million, you could fund the $3 million benefit payments by only putting in $2 million or $1 million or whatever it is. So I think that's one of the factors that goes in there. The more they can put in, the greater it will grow, unless something terrible happens like 2008, where the market just craters. But I think that's another factor that needs to be considered when they're determining how much to fund. What is the tolerance for declines in the market? But over in the long run, one of the factors that the company considers is how much can we put in that will grow so there will be enough in there to pay the benefit payments.
In that scenario that you just described with the company exercising its discretion to put in money, if the prepaid pension asset is included in rate base, what stops it from becoming a sort of fund where the utility can park investment dollars that will earn its weighted average cost of capital in a rate case without having to justify the investment as used and useful as it would have if it were investing it in plant to provide service to its customers?
No, that's a fair question. The part that you're looking at one side of the equation, however much they put in the prepaid pension asset, however it grows to, whatever length it grows to, the earnings on it reduce pension expense. And in what I calculated, or pension cost, what I calculated in the company's case is the the prepaid pension asset, which will earn at the Dominion expected return of 8.75%, that produces, that produces a lower pension expense of around $10 million. If you then turn around and allow a return on that prepaid pension asset, it is less than or very close to the $10 million. So I would think that the way you would determine that this is a bad deal for the ratepayers, if that's, I guess that's possible, is if the net is harmful for the customers. But right now, it's a benefit for the customers having this prepaid pension asset, which reduces pension expense.
You mentioned in your opening summary that pension expense is, I think you called it a journal entry that doesn't really affect revenue requirement. Is that an accurate, it's been a few minutes anyway.
No, it's a journal entry. Pension expense is a journal entry, but the debit part of it, if it's an expense, that does should enter into revenue requirements. Either way, normally, in many jurisdictions, as long as companies are continuing to make contributions, the accrual basis of accounting works, and you get the pension expense or credit in revenue requirements, but at the same time, I believe, you ought to include in rate base the pension asset, which is giving rise to that lower pension expense.
This will be my final question, perhaps. But isn't it asymmetrical to include pension expense only when the expense is positive and never when it's a credit?
What I've said here is the company has included a credit, a pension credit, and it's only including the credit, which I characterize as asymmetrical, because you've only included the credit in revenue requirements, the lowering of pension expense, without including the asset coming from shareholders that gave rise to that that reduced pension expense, which in this case is reduced lower than zero. But what I said is, the reason I've read the FERC decisions, when FERC has had a concept that when there are no contributions, you stop making contributions potentially because the plan is fully funded, or somebody believes there's enough in there to pay the benefits, that you stop recording any pension expense for rate-making purposes. You still have pension expense for GAAP, and it would be negative. You'd still have that. But for rate-making purposes, they'd say, no, you're not making contributions, no pension expense, no pension credit, no pension anything. So FERC is, and what the company has done by taking everything out, is symmetrical. They're taking all the points out. What I propose, my alternative approach, is to put everything in. Put in the pension expense, whether positive or negative, but also factor in to rate base, let them earn on the pension asset contributed by investors that's producing that negative expense or that lower expense. What's not symmetrical is to just pick out and say, well, I'll take that negative pension expense, I like that, we'll reduce revenue requirements for it, not consider any of the pension asset. And when I said journal entry, what I meant is this, and this is an example. I'll make a simple example. Let's just assume that the company has filing a rate case and they have two costs. They have payroll of $10 million and they have negative pension expense of $2 million. So they file a rate case, they receive a revenue requirement of $8 million, the 10 minus the 2. They collect $8 million from customers, but they have $10 million of payroll expense. How are they going to pay the $10 million of payroll expense? Answer, they need $2 million extra dollars from who? Not going to come from the ratepayers. This was just a journal entry reducing the rates. The way I'm going to get the extra $2 million to pay the payroll is to get that from investors. There's only three sources of funds: ratepayers, customers, the investors, or the government, and the government's not helping. No disrespect. No, but in this case, it's just those two. So that's why the negative pension expense, or a reduced pension expense, doesn't have to be negative, a reduced pension expense, which is just, again, it's a journal. That reduction has to come, the reduced pension expense, which doesn't turn into, which reduces revenue requirements, has to be made up somewhere else, and that has to come from investors.
What you call asymmetrical, including a pension expense, but not including the pension asset, do you agree that that's exactly what's been done in the last at least 2 litigated rate cases in this state?
It looks like there was no, the pension expense was included, there was no offset for the prepaid pension asset.
Okay, thank you. That's all I have.
Okay. Why don't we take a 10-minute break, and then we'll go to the office's cross-examination. So we'll come back at, let's say, 2:50. We will go to the Office of Consumer Services for any cross-examination of Mr. Felsenthal.
Hello, Mr. Thamthal. I'm sorry I butchered your name.
Happens all the time.
Just some housekeeping matters first. You have access, I'm sorry, I don't have the exhibits here. The line of questions deals with your recent changes to the pension expense. So I'm just going to wonder, in your packet, do you have the Dominion response to OCS data request number 11.12?
I think so. Yes.
Robert,
Is that-
what was that number again?
It was 11.12.
Is that an exhibit that we would have too, or you're
No,
just, okay?
this is just relating to his change in his testimony today, so I wasn't able to prepare the exhibit.
Sorry, Robert, what was that you just said?
These questions relate just to the change in his testimony.
Oh,
and
I see.
Since that just occurred, I wasn't able to prepare an
Okay,
exhibit.
all right.
This data request refers specifically to the line in your testimony that you have changed. Isn't that correct?
Yes.
Do you know why, and you'll see in the answer, the $8.1 million figure was responded. The response contained the $8.18 million that you had in your testimony that has been changed, correct?
Correct.
Do you know why this data response wasn't corrected?
I think what you're asking is, when I adjusted it, I started with 8.18, and I reduced it by 2.468, not the 3805. Right?
All right.
And the reason is, the 3805 clearly states it was made to pension and OPEB expense. So it combined pensions and other post-employment benefits, and the pension-only piece, I've been told, is the 2.468.
When did you discover this mistake?
This week.
Robert, I just will note for the record, the answer actually includes the statement about the reduction, the need to reduce the 8.18. It's stated in the sentence below the one you were just referring to. So it doesn't need to be corrected. It has the reduction in the next sentence.
I see, thank you. Okay, we're going to switch gears here. I'm going to hand you, or we're going to hand you a copy of OCS Cross Exhibit F1.
Thank you.
I'll represent to you that this is the testimony of Thomas P. Walfar. I might have mispronounced his name, so I'll spell it for the court reporter. Wohlfarth, who is the Senior Vice President of Regulatory Affairs with Dominion Resources. Mr. Walfar gave this testimony under oath at the hearing to approve the settlement in docket 16-05701. A settlement, the record approval of the merger between Questar Corporation and Dominion Resources. I'm going to ask you to turn to page 18 and 19 and read the highlighted portion.
Paragraph, comma, I think that's 11, comma, in the stipulation deals with the commitment to within 6 months of the completion or the approval of the merger, we will, at shareholders' expense, contribute $75 million to the pension Questar Pension Fund. And the benefit of that will be, comma, comma, obviously a function of pension expenses is return on pension assets. And that will provide a an expense reduction benefit for Questar Gas customers in perpetuity in essence. The comma. So I think with this pension contribution, this is really a win for it's a it's, comma, I'd say a win-win-win. It's good for the company because it really stabilizes the pension plan. And of course, it's good for customers as well because they are the beneficiaries of the pension plan. And most importantly as well, it will provide a $3.3 million, our estimate, annual benefit in perpetuity for customers.
Thank you. Request to admit OCS Cross Exhibit F1.
If anyone objects to that motion, please indicate to me. I'm not seeing any objections, so it's granted.
Now I'm going to hand you a copy of Cross Exhibit F2. I'm going to represent to you that this is a copy of David M. Curtis of Dominion's written testimony in the merger case explaining how the pension contribution will provide customers with approximately $3.3 million in annual benefits in perpetuity. I'm going to ask you to turn to page 4 and 5 and read the highlighted portion. There are 2 pages 4, which I noticed. So could you go to the page 4 with that starts with line 70?
Well, I've only got one page 4, but that's okay. I've got line 70.
All right.
Yes. The major components of pension cost include service cost for the current year's accrued benefits, interest cost on the plan's liabilities, amortization of actuarial gains and losses, and a credit for estimated returns on plan assets. An additional contribution of $75 million to the pension plan would change the calculation of estimated returns on plan assets. The higher return on assets would directly reduce Dominion Questar Gas's portion of pension expense from the Dominion Questar retirement plan. The pension expense is included in rates as part of cost of service. Shall I read the question?
Yes, please.
Question. How much will customers benefit as a result of the pension funding? Answer. Based on a 7% expected return on plan assets, the $75 million contribution would result in approximately $5.2 million in annual pension expense reductions, pension contribution multiplied by expected return on plan assets, close paren. Applying Questar's current allocation methodology, $3.3 million in annual benefit would be allocated to Dominion Questar Gas customers.
Request to admit OSC Cross Exhibit F2.
If anyone objects to that, please indicate to me. I'm not seeing any objections, so the motion is granted.
Isn't it true that under Dominion's plan to exclude the negative pension costs from the revenue requirement, customers will not receive the approximately $3.3 million in annual benefits that Mr. Wilford promised and explained by Mr. Curtis?
The pension expense will be reduced by that amount, yes.
But the customers will now receive the approximately $3.3 million in benefits. Isn't that correct?
They will receive, it's the 75 million is a component of that $112 million prepaid pension asset. As a result, even in my calculations, when I'm figuring out the benefits to customers, the reduction in expense, it's, this 3.3 million is part of it.
You testified that it would be unfair for the customers to receive the benefits of including the pension expense, the negative pension expense in the revenue requirement without allowing the shareholders to receive return on investment in pension asset. Isn't that correct?
What I said is, it's unfair to not be symmetrical. And the shareholders contributed amounts, some of which, 75 million of which, comes from this testimony, this merger agreement. So, but the entire prepaid pension asset reduces expense, which is what I said. And all I said is this asymmetrical treatment would be that investors should get a return on their assets.
Well, let me ask you this question in another way. Assuming hypothetically, the commission agrees with the OCS and includes the negative pension costs in the revenue requirement and doesn't include the pension asset, that would benefit the ratepayers to a significantly more degree than if the pension offense, if as Dominion is suggesting, both the pension expense and the plan assets are excluded. Isn't that correct?
For sure, sure. Because you're taking the good, the credit, the reduction in pension expense without compensating the investors for the assets they contributed, causing that reduction in pension expense. Of course, that's better.
And isn't that what was promised by Mr. Wolfoff and explained by Mr. Curtis?
I don't know. They just said there will be a reduction in pension expense, and there is.
Thank you. I have no further questions.
Any redirect?
Yes, thank you. Mr. Felsenthal, I want to just get a couple of basics so that we're all on the same page. The pension asset we're talking about, that is a fund of money that is held where?
In the pension trust.
And is that part of the company? Can the company access those funds to use them for its payment of its cost of service?
No, and I make that point in my testimony. I should have made it earlier. The monies in the pension trust can only go to making the pension payments. It can't be accessed and used for general corporate purposes, which is why in my example, like with my $10 million payroll expense offset by $2 million of pension credit, it's not like there's $10 million. The $2 million that has to be funded because I don't have access to the amount that the ratepayers paid of that's in the pension trust.
So let me approach it mathematically this way. Let's take that credit amount, whatever it happens to be. Let's just say it's $3 million. I'm just making that up. If that credit is $3 million and we took and gave customers and reduced their revenue requirement of the company by $3 million, what is the impact of that on the company?
The company has less cash of $3 million.
So if its expenses were, if it needed, had a revenue requirement of $17 million and you took the credit and applied it to that $17 million, reducing it by 3, so that there's now, the customers have got that benefit, what does the company have to do at that point?
The company has to borrow, find $3 million to fund its,
I'm going to object at this point. This
Yes,
is
yes,
outside the cross.
Do you want to respond to that, Mr. Saban?
Yeah, I don't think so. I think we need to understand this, and I think Mr. Russell and Mr. Moore's questions, in my mind, I want to clear up and make sure everybody's understanding what's going on here. But
And I'll apologize for my benefit. Would you repeat the last question you just asked?
Sure. My question was, if you take the $3 million credit and you use it to reduce revenue requirement as is being suggested by the two parties that are challenging the company's exclusion of that credit from the revenue requirement analysis, my question to him was, what do you have to do? What would the company have to do to cover that money that is taken out by the credit?
Yeah, I understand the objection, but I think I'm going to allow this as within the scope of the cross-examination.
And I actually don't remember if you had anything more you were saying on that, Mr. Felsenthal, when the objection
I'll start
came up.
again. So if there's a pre-credit, their pre-credit cost of service of 17 million, and you apply a $3 million credit to reduce the revenue requirement to 14 million. The question is, how are you going to pay the $17 million of costs when you've only got 14 million from the customers? Okay, if that credit came about by earnings on the pension trust, those monies are in the pension trust. I can't access them. I can't access those monies. They have to go to pay the pension benefits. So I'm going to have to go borrow or seek investor money to make up for the credit, the reduction in pension expense caused by this.
Okay. Thank you. Do you have an understanding one way or another of whether the company made a $75 million pension contribution to the pension trust?
I believe they did. I don't know that for sure, but I think they did.
Would you take it as fact that occurred?
Yeah, the reason I'm saying that is because there's a prepaid pension asset of 112 million. And in the contributions that I've seen in the past, the contributions and the expense, it doesn't come close to that.
Okay.
So the extra contribution to the pension trust makes sense to me that it came clearly from the investors, directly from the investors.
So when there is a credit, as there is now, how does that benefit customers?
The credit, well, it depends on whether there's contributions or not.
Well, let's take what's going on now, real world. My understanding is there's no contributions being made and there is a credit. How are customers benefiting, if at all, from the fact that there is a credit?
The customers are benefiting because pension expense is being reduced by the amounts, the earnings on, the expected return, and the prepaid pension assets.
So the customers are not being required to pay otherwise expenses that would exist absent there being a credit.
Correct.
Is the company taking, in that circumstance, any benefit from the customers by not including the credit in the revenue requirement?
No.
Mr. Russell asked you a question earlier about, in those years where there was an expense, a pension expense, and customers were being asked to pay a portion of that pension expense. Do you understand you remember when he was asking you about that? Can you tell me, during those years, by not including the asset, were customers being made worse off by the fact that the asset was not being included in the revenue requirement calculation?
No, in those years, for whatever, because the pension expense was reduced by the expected return on the pension asset, but the pension asset was not included in rate base or didn't get earnings. The customers were benefiting at the, I hate to use the word, expense of the investors who funded the prepaid pension asset. In other cases, I've called that the free lunch syndrome. They get the free lunch, they get a reduction in pension expense. There's still an expense. There still is positive pension expense, but it was less than it otherwise would have been because the earnings on the prepaid pension asset reduced it. But the company did not ask for a return on, at least since 1999, the assets that gave rise to it, the investment that gave rise to it.
So in that circumstance, if I understand you correctly, you're saying that the party that missed out, if at all, on getting a benefit in those years was the investors who did not get a return on the asset itself being included.
Exactly.
Okay. You testified earlier, or you were asked about the question of when customers pay this expense versus don't pay this expense, and you offered an explanation that customers don't pay specific expenses, they pay for services. If you were to do what the other side is suggesting, well, let me ask it this way. Do we have an issue with pensions where they're handled on a single item, as a single item expenditure in these kinds of cases you've been involved in? In other words, are they dealt with purely in isolation as a pension expense, or are they dealt with in the overall revenue requirement?
They're almost always dealt with in the terms of the overall revenue requirement. It's the single, I mentioned in my testimony that certain jurisdictions have a tracker, a pension tracker, where they keep track of the pension expense, the assets that gave rise to it, and they true it up annually. So that way, everyone's even, no one's out, no one's short. The actual expense is paid for by customers. The customers get the benefit of the credit. It all works out.
Thank you. Mr. Russell, excuse me. Mr. Russell talked to you about the impact of perhaps overfunding the pension asset. Is it true that if a pension asset is overfunded, the excess money would stay in the pension account for the employee benefits and can't be withdrawn by the company for other purposes?
That's correct. The asset, once it goes to the pension trust, the funds in that trust can only be used to pay the pension benefits.
But it's true also, isn't it, that the funds that stay in that account will defer future expenses as long as they stay in a positive state, a credit state?
As long as there's a prepaid pension asset, as long as there's funds in the pension trust, the calculation of pension expense is reduced, or is credited for the earnings on, the expected earnings on those assets.
And do you have an understanding of whether customers have been required or have not been required to pay pension expenses, or whether there's been planned contributions since 2017?
My understanding is since 2017, there have been no contributions, no further contributions to the pension trust. None were required.
And subject to check, let me ask you, if you assume, for the sake of my hypothetical, that the company is under-earned in every one of those same years, would the customers have missed out on any benefit from any contributions they made? Any monies towards contributions they made?
Not sure, could you rephrase that, or?
If customers were paying for pension expense by virtue of some rate case in 2013, and the company is actually under-earning in every year, let's say the company under-earns in every year since 2013. Okay, do you follow me? Mm-hmm. Have customers been hurt in any way in the contribution portion that was included in rates during that period of time, if the company's under-earned?
Definitely, I mean, the customers aren't paying for some costs if they're under-earning.
Is it your position that the company's treatment of the asset and the credit in this particular rate case is consistent with FERC precedent?
Yes. There have been a number of FERC cases, which I cite, where when there's no contribution, FERC's and the companies have attempted to use accrual accounting and get the pension expense and the prepaid pension asset, and FERC has said no. In this case, because you've made no contribution, no expense, no pension anything. So they've just zeroed everything out, which is what I said in my testimony, and I also did a calculation to show that excluding everything as a result of zero, including the prepaid pension asset, the related deferred taxes, and the negative pension expense, in other words, all components, also has basically a wash.
So two more questions. In the world we're in right now, where there is a credit of some amount, are customers going to receive either now or in the future the full benefit of that credit?
If you put everything together, the customers, like I say, if you take the credit, you take the assets, the asymmetrical return on plan assets and include it all, it basically, all of that would inure to the benefit of the customers.
Right, so let me make sure you understand what I'm asking. If we do what the company is doing and you take everything out, or we do the alternative of putting everything in either case, will the customers receive the benefit of the full benefit of the credit money, the monies that are sitting in that trust account to pay for that pension, those pension expenses as they arise? That's my question.
Absolutely.
Okay, and is the company getting some benefit from the customers by having that credit in there? Are they keeping some benefit from the customers?
No, like we said, the pension trust is a self-sustaining trust. The monies that go into it can only be used to fund pension benefits.
And finally, you were handed two exhibits, OCS Cross F2 and F1 and F2. I just want to know if in that testimony,
But isn't that just what Mr. Wolfall and Mr. Curtis promised them?
I think again, just reading what you sent me, what you gave me, it says that they will benefit from this 75 million contribution to the trust. And they are getting a benefit. There's a reduction in expense.
Yeah, well, they said that they would benefit by 3.3 million annually and in perpetuity.
In expense.
And that's going to happen regardless of whether you include the pension asset, pension expense in the revenue requirement or not?
I'm saying the pension expense is reduced by that amount.
Is that going to happen regardless? So, well, then what difference does it make if the pension expense is included in rate base or not, if the customers receive the precise same benefit?
Could you please rephrase that?
Do the customers receive the same benefit from including the pension, a negative pension expense in the rate base without including the pension asset in the rate base, as they would if all pension assets were taken away from the rate base, as Dominion suggests?
I'm not saying Dominion suggests it, but obviously, I said earlier, if on one hand, you're going to reduce expense by some amount, and that's it, there's going to be a benefit of that amount. If you are more symmetrical, like I think you should be, the reduction in expense is offset by should be, offset by the funds, the source of the funds that contributed to that lower expense.
But my
So
question
obviously,
was,
if you have a lowering and an increase combined, that's going to be less than if you just reduce it by the expense.
my question was, what benefit will there be a difference in benefit, assuming that the pension expense is included, negative pension expense is included in rate base, and the pension aspect is excluded, and when the negative pension aspect is excluded, will the customers receive the exact same benefit?
The math would agree with that, that it's not as, you're going to get a benefit if you only reduce expense without putting the other side in. Yes.
Well, then why does Dominion care? Why don't we just go with OCS's suggestion if the same results apply either way?
I didn't say that. We're not communicating. I'm saying that the pension expense is reduced because of the 75 million. That will result in less pension expense. Okay?
Right.
Okay? So that's one number. That's a benefit to the customers. What I'm saying is, if you are symmetrical, and include as an offset the funds that contributed to that negative pension expense, it's less of a benefit, for sure.
Okay, let me try
But
this
it's
another
fair.
way. I don't think you're answering my question, so let me try it another way, see if I can make it clearer to you. Mr. Kerr stated that applying the current allocation methodology, $3.3 million of annual pension benefits would be allocated to Dominion gas customers. Now, that works as a reduction in the revenue requirement when the expense is negative, correct?
I don't know if it says, the expense is lower by 3.3 million.
If the expense is negative, does it reduce the revenue requirement?
If the expense is lower or negative, it reduces the revenue requirement, yes.
Does it reduce the I'm having a problem to see how it makes a difference. Why don't you explain to me what is a free lunch and what the customers receive as a free lunch and what the customers receive if, as Dominion suggests, the pension negative pension expense is excluded from rate base?
Okay, what I mean by a free lunch is if investors contribute assets, investors contribute assets, those assets reduce an expense. And I only considered the reduction in expense in determining revenue requirements. They are without considering the return on the investment that the investors have contributed. It's a free lunch.
And that free lunch is worth about $3.3 million, isn't it?
Based on reading the second page 4, lines 78 to 82, it looks like there was a $3.3 million benefit to the customers that they are receiving without paying for the assets, the symmetrical asset that caused it.
And they won't receive that under Dominion's theory that the negative pension expense should be excluded from the rate base. Is that correct? They won't receive that free lunch.
They don't get it, right? No one should be entitled to a free lunch. You
Thank
should pay for the,
Go on, I didn't mean to cut you
no,
off.
I was gonna say, if there's a reduction in expense due to an investment sourced to investors, you should handle both. That's why we have a rate base, earnings, right? That's why there's a return on a rate base and there's operating expenses. If the return on the rate base results in positive or negative expenses, they should both be handled symmetrically.
That's all I have, thank you.
Thank you. Mr. Russell?
Thank you. Mr. Felsenthal, are you aware of testimony or responses to data requests that identify what the pension expense would have been without the $75 million contribution made in 2017?
You'd have to, I've seen that somewhere.
Okay. I don't want to belabor this point. Just come with me for a second. If the pension expense, absent that $75 million contribution, would also have been negative, and the $75 million contribution made it more negative, and then the company is saying, well, let's zero it out, the customers are not receiving the benefit of the negative pension expense that they would have otherwise received absent the $75 million contribution, right?
Yes.
Okay. And then I want to ask you one other set of questions. It may only be one. Mr. Sabin asked you some questions about who benefited and who lost from not including the pension expense since the 1999 rate case. Do you recall those questions?
Vaguely.
I may have said pension expense. I meant to say pension asset if I said pension expense.
Right.
Okay, my apologies.
That's why it was vague.
Yeah, I'm sorry. Mr. Sabin asked you some questions about including the pension expense, but not including the pension assets since the 1999 rate case. Do you recall that?
Yes.
He asked you who lost out from that series of events. Do you recall that?
Yes.
And your answer was that shareholders lost out because the pension assets were not included. Is that right?
Yes, the investors did not get a return on the investment they put in, which caused that negative pension expense. That lower pension expense.
But doesn't your answer assume that the pension asset was positive?
It could go either way. I agree. If it's a negative pension expense, it should reduce rate base. It should go either way.
You said negative pension expense.
Pension
Asset, you mean?
Pension asset.
Okay.
Well, then it's a pension liability, right?
Right. If it's a negative pension asset or a pension liability, by including it, it would reduce rate base, right?
Correct.
Okay, that's all I had. Thank you.
Can I ask just a couple of clarifying questions? Unless it would peeve you.
No.
Okay.
Beyond that.
I want to be clear on a couple of things. The company, it is true, is it not, that the company is not asking to include the asset in this case and receive a return on that asset?
No, the company is excluding all elements, all components of pension.
Okay, so if the commission were to adopt the company's position, the company wouldn't be receiving any return on its pension asset, regardless of how we want to look at it. There just wouldn't be a return on that portion.
Correct. There'd be no compensation one way or the other, expense or return on anything to do with pensions.
Okay, now if the commission went with your alternative, which was to go and be symmetrical the other way, include the credit, include the asset, include all components of the pension issue, the customers would still be receiving the benefit of the pension contributions in the form of defrayed expenses, and the company would be earning a return on the asset itself.
Correct.
Okay. Under the scenario that is being advocated by the OCS and by the American Natural Gas Council, UAE, you would have a circumstance where, if I understand you right, you'd have a circumstance where customers would get the credit applied to reduce the revenue requirement, but there would be no corresponding gain to the company on the asset funding that credit.
Correct.
And there would be a shortfall for the company in the revenue requirement between what customers are paying and what the revenue requirement actually is.
Right, that would be similar to whichever example we've used, the 17 million versus, or the 10 million versus 8 million example, where there's not enough revenue requirement to pay the cash expenses.
Last set of questions. So when the contribution was made, the $75 million contribution, or any contribution, by the way, of investors, isn't it true that money would offset some portion, at least, of customer expense for that pension account, either now or in the future?
Correct.
So customers, in the circumstance where Mr. Moore was talking about, where you make a $75 million contribution, those funds customers would receive the benefit whether it paid an expense today or whether it defrayed expenses into the future or created return to defray expenses into the future. That would be received wholly by the customers.
Either way.
Thank you. That's all.
I apologize for doing this again. Getting to
At some
that,
point, we have to cut it off, but sure.
getting to the last question, when you mentioned the customers would benefit in the future, that wouldn't be an annual benefit, would it?
It would be a benefit as long as there's a prepaid pension asset. The amount might change.
The amount might change, so it wouldn't be approximately $3.3 million annually in perpetuity.
It could be more. If the company puts in, they didn't, but if they decided to put more money in, the number would be greater.
But they didn't.
They haven't.
I have no further questions.
Okay, thank you. Commissioner White?
Good afternoon. You've noted some FERC and other jurisdictional precedent to allow for this concept of your option two, which is, I guess, the symmetry of allowing the asset. I apologize. I know these terms. The asset to be rate based and versus the potential accounting of the revenue requirement, right?
Of the expense.
Yeah. And are you aware in those contexts of those other jurisdictions whether or not those were decided prior to that decision to infuse the pension fund with from shareholders, I guess?
I mean, a significant.
Yeah, let me just tell you where I'm trying to get here.
Okay.
And the predicate here is essentially it would be an investment decision. In other words, there would be a potential for a return on it in exchange for the symmetry or the wash. Was that issue decided before a particular company or investors were allowed to make that decision?
I'm not sure the history of it, but I do know in my testimony, I have a couple of state examples where they were made aware, or at the time, somebody may not have asked for it prior, but once they were able to demonstrate that the source, the key is, what is the source of the prepaid pension asset? If it's one big contribution, like 75 million, well, then you know. They said they were gonna do it, they did it. In the normal course of business, to the extent that there are reductions in pension expense, okay, and there are contributions being made under ERISA that are in excess of pension expense, that's a contribution made by investors, and they need a return on it.
And that's the question I'm getting at is, if the regulatory construct of an investor, they expect a return on their investment, But typically that's, the predicate to that is the request to make that investment. So that's why I'm wondering, and you're saying you're not aware of any jurisdiction that's actually opined on that prior to the investment being made?
I don't know. There could be. I don't know. I just know that they ended up by having this concept. There was it was at one time called a prepayment.
Okay.
And prepayments, because you're prepaying for the pension expense.
Okay.
Right? You can't get it out of the fund, and the investors, it's their money. They proved I've seen cases where they talked about it being used and useful, all that other good stuff, and they've got a return on it.
Let me ask you another question. This partially has to do with the testimony from Mr. Walfarth that's referenced in OCS Exhibit F1. And I'm looking at page 19, starting at line 3. And I'll just cut to the chase. It references as part of the merger commitment a charitable contribution in the amount of $1 million. This merger came in as a stipulation, and so we're not privy as the commission in terms of the puts and takes and what goes into that. But I guess my question is there a distinction to be made between that's shareholder money, right? $1 million. Was there an expectation from shareholders to earn a return on that?
I don't know. I would say the difference is there wasn't a benefit. There's not a reduction in cost like there is on the pension.
Okay. That's all I have. No further questions.
So I'd like to focus on the 37.5 million. That's the portion of the asset that's not directly related to the merger and what may have been represented to the commission and to the people of this community or the state regarding what the 75 million was all about. So let's just, for hypothetical purposes or for my purposes of trying to understand the investors as the source of the asset. That's what I want to understand better. I don't think we have a situation where debt was issued or shares were issued to generate 37.5 million to put into the pension fund. Is that correct?
I don't know, but I'll accept.
Yeah. I mean, probably not, at least, right? So in the situation where, and I'll just use simplifying assumptions, we have $5 million in rates that's been authorized as an annual pension expense. And let's say we have a year where sort of magically the gap accrual is $5 million, the actuarial ERISA calculation is $5 million. So $5 million in rates come to the company, and then the $5 million that goes into the pension account that same year to meet the ERISA requirements is somehow that is investor contribution rather than the source of it being customers. Is that how you're thinking about it?
No, in that case, if the customers were, if pension expense was $5 million, and the ERISA requirement was $5 million, there's no prepaid pension asset. Because the prepaid pension asset is the excess of contributions over expense.
Right. So
in that case, there'd be zero.
okay, we start with that happening over a number of years. Now that starts to increase because of the earnings performance of the fund, and we find that we have more than is required under ERISA. So that extra is now investor asset as opposed to some other ownership. Is that correct?
Can I try this?
Yeah.
Let's say that we started with that, your assumption that the $5 million of pension expense. Let's say because of earnings on the pension assets, that pension expense now is $3 million. but the ERISA contribution is still 5. In that case, now there's a $2 million prepaid pension asset. It couldn't have come from customers. They only paid 3. So it would have, the source would have had to come from investors.
But it really came from the earnings on the,
No, the earnings are still in, the earnings are not in there. The earnings reduce the expense. The earnings don't go to the asset. The contribution is still, in your case, $5 million. But the pension expense is now less. So if you just do the calculation of what's prepaid pension expense, what's the prepaid pension asset? It's contributions, in this case, 5 million. Now the pension expense is 3 million, been reduced from 5 because of the earnings on the prepaid pension asset,
I understand.
okay? And
I understand what you're telling me.
Okay.
Thank you. That's all my question.
I think I have a question. It might just reveal my ignorance of GAAP, or it might be a question you've already asked and answered, and if it is, I apologize, but.
I hope it's one of those two.
Yeah. You know, we've talked about the statements of Mr. Wolfarth and Mr. Curtis in the merger docket about their estimate of a 3.3 million annual perpetual benefit to ratepayers. So, let me ask you this. If we were put aside the rate base issue, assume we're not making a change to rate base, we're not putting the asset in rate base, but we were to accept the office's proposed negative accrual adjustment to expense, would that change impact the the estimated 3.3 million perpetual annual benefit to ratepayers?
There's two calculations, right? The 3.3 million is a calculation based on the $75 million contribution to the pension trust. Okay, so that's gonna be 3.3 million as long as that 75 is there.
Okay.
The only question then is it appropriate to have earnings or have the source of the 75 million, the company, get a return on it?
Well, I want to put that issue aside.
Okay.
I just want to ask the impact of the negative accrual adjustment to expense that the office is advocating for without the rate base change.
If 75 million stays as a prepaid, included in the prepaid pension amount, then that amount times, I think it might even be more than 3.3 million, because Dominion's got a higher expected return on assets. But it's math. It's a calculation of what the annual benefit is. It's however much is in the prepaid pension asset times the expected return on plan assets that are used in coming up with pension expense.
Oh, okay, and that's not impacted by the expense adjustment.
Right.
Okay. I think that's my only question then. Thank you for your testimony this afternoon. And we're ready for your next witness.
Before we call our next witness, we just want to, Mr. Felsenthal needs to catch a plane. Or is there any reason we need to keep him around for any longer?
I'll just ask any parties or commissioners if they have any objection to that to let me know. I'm not seeing any objection, so thank you.
Thank you.
Thank you.
The company calls Jordan Stevenson.
Good afternoon, Mr. Stevenson. Do you swear to tell the truth?
Yes.
Thank you.
Good afternoon.
Good afternoon.
Could you please state your name and business address for the record?
Yes, Jordan Stevenson, 333 South State, Salt Lake City.
Mr. Stevenson, can you please identify your employer and tell us what position you hold there?
Yes, I'm a regulatory affairs manager for Dominion Energy Utah.
Mr. Stevenson, did you pre-file direct testimony in this docket labeled DEU Exhibit 3.0 with attached exhibits, 3.01 through 3.32?
Yes.
And did you also file pre-filed rebuttal testimony in this docket labeled as DEU Exhibit 3.0R with attached exhibits DEU Exhibit 3.0R, 3.01R through 3.09R?
Yes,
And do you adopt those documents as your testimony today?
I do.
The company moves for the admission of the company's pre-filed direct testimony of Jordan Stevenson marked as DEU Exhibit 3.0 with accompanying exhibits 3.01 through 3.32, as well as Mr. Stevenson's rebuttal testimony marked as DEU Exhibit 3.0R with attached exhibits DEU Exhibits 3.01 through 3.09R.
Okay, if anyone objects to that motion, please indicate to me. I'm not seeing any objection, so the motion's granted.
Thank you. Mr. Stevenson, are you able to summarize for the commission the testimony you've offered in this docket?
Yes. In this docket, the company originally filed for a revenue requirement increase of $19.2 million based on a 2020 test period, average test period, I should say. The calculation of that revenue requirement included a forecast of increased revenues from customer growth, adjusted for customer usage per customer. It also included a forecast of O&M expense projected in the 2020 period, as well as capital investment increase. Since that time, since that filing, we have had several adjustments discussed throughout the period of discovery in this case. And for the sake of simplifying and organizing my presentation or my summary, I have prepared a table that summarizes the testimonies that have been submitted in regards to these adjustments.
May I approach and provide this document?
Yes.
Thank you.
I do. Thank you. Over the course of this docket, we've had over a dozen specific adjustments to the revenue requirement we originally filed, proposed by various parties in this case. This table is my attempt to summarize each of those adjustments and where the parties currently stand on those issues.
Mr.
So this comes
Stevenson,
from.
I'm sorry to interrupt, but before you get too far, would you please just identify this as by its title
I
for the
will.
record? Thank you.
Yes. We have titled this DEU Hearing Exhibit 7. And so I've organized this so that there's three main categories, and it's color shaded. So the top section you see that's highlighted in green represents areas or adjustments proposed by parties in this case, to which we have, I'll call substantial agreement. You'll notice some of the specific amounts differ slightly as you move across these columns. The reason for that is the treatment of inflation, whether it's included in the test period or not, as well as the lead lag factor used or the return on equity slightly change the amounts of these adjustments. So the final adjustments, whatever the final amount is, will depend on some of those factors. So that's the reason why there is a little bit of variance in these numbers, but this is to provide an overall view of where we stand substantially on these issues. So going through this green section, you see row 2 represents our original proposal that the company submitted of $19.2 million for the 2020 test period. That would be the revenue requirement increase in 2020. The next line is an adjustment to cash working capital. This is a rate base reduction that results in an overall reduction in the revenue requirement. The reason for that adjustment is the lead lag factor changing from the original proposed factor to a lower factor. And by way of background, the company did meet with representatives from the division and we reviewed the various proposals or adjustments that the division has filed in testimony, and we do agree to those adjustments to the lead lag factor. The office's position is slightly different. I'll note that I believe that depreciation and deferred income tax, the treatment of that item is not agreed to by the office, so I won't represent that we are all in agreement on that issue. The next item on row 4 of the exhibit is the removal of an audit fee accrual. And I will note that upon review of the surrebuttal testimony of Ms. Ramus in this case, the company does agree with the full removal of the audit fee accrual, so we are on agreement to that issue. That's a little different than where we had left things in my rebuttal testimony, but as Ms. Ramus correctly points out, we had included accruals in our analysis that are capital items, not expense items, and those should not be included in that analysis or in that adjustment. So we agree with the office's adjustment on that. The next few items relate to fines being removed from the test period, an adjustment to property tax expense, and then we have an additional operating and maintenance reduction of roughly $600,000 for the test period, which is an update to savings that the company projects will occur in 2020. I will note that the office didn't expressly agree to the $600,000. I think their position, and I apologize if I misstate anything, but I believe that they would like to see a removal of all inflation in the test period, and I think the $600,000 would kind of be included in that removal of inflation. So that's down in a lower section of this matrix. The next group of items is related to transponder, or I will call these partial agreement items, not fully agreed to, but partially agreed to. The first couple items on rows 9 and 10 are related to the treatment of transponder activity in the test period. And my original projection for transponder retirement activity that we filed in 2019 and 2020 utilized system-wide factors to estimate the impact of 3 things. One is the construction work in process that remains in CWIP account 107 at the end of the test period. I'll note that is not a rate-based account, and so we withhold a certain amount of all capital additions, and we include those in CWIP, and we do not push that through into rate base. And we used a historical 5-year average factor for how much would remain in CWIP that was based on a system total additions for that. We also had a factor for proceeds, which increases the 108 amount, and we had a factor for dismantling costs, which reduce the 108 account. For all 3 of those factors, we used a system-wide total to calculate what the transponder activity would be. Ms. Ramus has recommended that transponders should be accounted for individually rather than using system-wide factors for proceeds and dismantling specifically. This results in a $3.6 million decrease to rate base in 2020. Ms. Ramus's testimony does not address the system-wide factor used for construction work in process related to transponders. Upon further review of transponder activity and after reviewing Ms. Ramus's testimony, I do agree that it is appropriate to regard transponders individually and to update the dismantling and proceed activity. In my analysis, I also updated the construction work in process factor as well, and that's why my adjustment is slightly different. So I'd call that partial agreement on that issue. And moving on to row 11, this relates to excess deferred income tax adjustments. The parties largely agree on the treatment of excess deferred income tax, except for the amortization period for non-plant related EDIT. The company has proposed a 12-year amortization period. The UAE has proposed a 10-year amortization period, and the office has proposed a 5-year amortization period. The company recommends a 12-year period because the lion's share of non-plant-related excess deferred income tax balance is pension-related, and the pension has a remaining service life of 12 years. In addition, the 12-year period mitigates volatility in the revenue requirement collected from customers over time, meaning that it will not result in a large decrease in the revenue requirement for a short period of time, followed by a large increase at a later date when that balance has been fully amortized. Related to this recommendation as well, it's important to note that the current excess deferred income tax balance is currently included as a reduction to rate base in the 254 account, meaning that a rate of return is included in the test period to the benefit of customers for any unamortized balance. This return fairly compensates customers throughout the time period of amortization. So for these reasons, the company disagrees with a 10-year period or a 5-year period, which are not based on the costs that contributed to the EDIP balance and the increased volatility by rushing a credit over an arbitrarily short amount of time, especially when recognizing that customers are fairly compensated with a rate of return because we are reducing rate base by the full unamortized amount of EDIP. And now turning to the items in blue, row 13 relates to an adjustment to projected plant and service. As we talk about the projected plant and service, I just wanted to refer back to my direct testimony in Exhibit 3.09. While you're opening it up to that page, I'll just note that the company has included a capital budget in 2019 of $233 million to be spent in 2019, and then $277 million to be spent in 2020. Exhibit 3.09 includes a comparison of actual capital spending over the last 5 years to the budgeted amount for each of those years. And I'd refer to row 6, where we show on average we spend within 1% of what we have budgeted as a company. And I believe that's evidence to the fact that we do not require a capital reduction in 2020 as far as what's included in the test period. We have high confidence that that is an accurate number. I will note as well that as we reach the end of 2019, the company anticipates that it will end the year slightly above the $233 million capital budget. And the difference between the $233 million in 2019
I'd like to raise an objection to this as not being a summary of testimony. I think we're potentially exceeding the length of the filed testimony, and it appears to be a live SIR rebuttal or SIR rebuttal, and that's ultimately my objection.
Okay, does anyone else want to weigh in on the objection before I go to Dominion?
The office would weigh in on that, in that we're now seeing numbers changing. It's difficult for us to work through several rounds of testimony and additional rounds of discovery to try to figure out what the issues are, to then come and understand anew what the issues might be in the form of adjustments or modifications being made on the stand, as opposed to a real summary of what has already been provided.
Okay. Before I move on, let me just ask, well, I want to ask two of you a question, but first let me go to see if Major Kirk or Mr. Meekum or Mr. Russell want to weigh in on the objection at this point. Mr. Russell?
I'm not sure if this is actually responsive to Mr. Jetter's objection. I note that at least a portion of Mr. Stevenson's testimony or summary of his testimony has been to alert the commission to where the company's position is now, as opposed to where it may have been at the end of rebuttal, adopting some portions of the surrebuttal testimony of the interveners. I don't have a problem with that. I'm not sure why that would be objectionable. I think the point of what we're doing here is to ensure that we all know what the company's position is, what the parties' positions are, at least on those numbers. I will note that it's a little difficult to do that on the fly, to kind of adjust what we're doing on the fly, but to the extent that we're, that the point of this summary is to kind of let everybody know where the company has adopted the testimony of other parties. I think that part of it is appropriate anyway.
Okay. Let me just come back to Mr. Snar and Mr. Jetter before I go to Dominion. And my question I wanted to ask for you is similar to the issue that Mr. Russell just raised. Is it your position that without an allowance for live surrebuttal, if Dominion sees some issues in your surrebuttal that cause them to move where they are, what's the right process for us to handle that? Mr. Jetter, let me go to you first.
So I think it would be reasonable to do that. The trouble I think that I'm seeing is the interweaving of arguments supporting the company's position. It's not a clear, we agree on these 12 different adjustments, and here they are. It seems to be a bit more than that. And with respect to the position matrix, at least for the division's position, I don't think it accurately reflects our position, particularly in the basis that it assumes issues that we have not opined on, that we either support or don't support adjustments from other parties that have presented those positions.
Okay, thank you. Mr. Snar?
I guess it's difficult to object to actions that'll bring the parties together and recognize resolution as opposed to a continual fight where there is no fight. I acknowledge that. But in this case, it's been difficult at times to figure out exactly where we are, including the formal filings, but also through discovery. And I just need to air that as a process that we're struggling with. I guess having said that, we'll defer to the commission to determine how we best handle things.
And then let me just clarify, is your motion to exclude this matrix and also an objection to some of the summary verbal statements that Mr. Stevenson is making?
I guess yes to both of those. I was intending to object to the entry of the position matrix into the record on the basis that it doesn't at least accurately reflect the position of the division. And
although at this point we haven't had a motion.
That's correct. And so what I'm struggling with is as we go through each one of these issues, there's a combination of position change and testimony in support of that. And I don't have the ability right now to evaluate all of that potentially new testimony and whether that's consistent with each of these issues. The testimony and rebuttal position. So I recognize it's a little unorthodox to object to a changing position getting closer to potentially our position. But I'm not sure how I can reasonably respond if there are testimony differences that are subtle. I may not recognize them. And I wanted to address that before we went on.
Okay. Let me let you respond to
Thank
this
you.
discussion at this point. And
Yeah,
then
I have a few responses. And first, I want to clarify the purpose of this exhibit. As Mr. Stevenson was preparing his summary, it became clear through the process, this litigated process, where we had direct testimony, rebuttal testimony, and surrebuttal testimony, that the company had some adjustments that they agreed with. And in an effort to summarize his testimony, he wanted to make it clear, to narrow the issues for all of you, so that you could see where there's agreement and where there is not. And the only changes from his rebuttal would be those where the company is moving in the direction of the adjustments advocated by the parties. And to the extent that that is live rebuttal, we will readily admit to the fact that we're here to tell you they were right on some points. And that's what you'll see here as a change. That was our only intention. So this is offered in an effort to simplify issues for all of you, and it is our intent, and it is my understanding that it is accurate, and it is an accurate representation of the positions of the parties as drawn from their testimony, and arguments that Mr. Stevenson is articulating here reside in his testimony, with those few exceptions I mentioned. I would also point out that the other witnesses who have advocated for these adjustments are in the room with us today. So Mr. Stevenson will be subject to cross-examination on this exhibit. If there are errors, they can be corrected. And we will hear from all of these witnesses tomorrow. And they will have the opportunity to address anything in this exhibit that they see where he had an error. And I will tell you, I will represent to you that it is my understanding our intention was to be accurate. So I guess if the parties would like us to withdraw any sur rebuttal and not opine on those adjustments that we agree with, we can do that. But everything else you see in this exhibit is in the testimony. The only thing this exhibit does for you is simplify things.
Can I clarify as well? I should have stated when I began this that a blank space in any of these columns is only blank because that particular party didn't necessarily take a position. So I don't mean to represent that the division is not accepting any of these adjustments by leaving that blank. And I probably should have said that up front, so.
Okay. Why don't we move forward this way? I'll give Commissioners White and Clark an opportunity to ask any questions. It's probably an appropriate time to take a short break, and I assume since there's a public witness hearing at 6, there'd be no objection to taking a 10 or 15-minute break and then going for about another hour or so, and then having a 20 to 30-minute break before the public witness hearing. Is that objectionable to anyone, that process? Okay, well, Commissioner Clark, do you have any questions on this motion that we have in front of us?
No, I don't have any questions.
Okay.
I think I know where we are.
Okay, Commissioner White?
Yeah, I don't have any questions, thanks.
Well, why don't we take a 15-minute break, and then we'll come back and try to have some direction on how we're going to move forward here, and then we'll go for another hour or so before we break before the public witness hearing. Thank you. At this point, we're going to allow Mr. Stevenson to.
Mr. Chair,
yes.
before you rule, in talking to my witness, he can't track back the number that Mr. Stevenson has for the ANGC position. And I think that's perhaps the problem with this document. I get what Mr. Stevenson's trying to do, and I applaud him for it. But if it's not documented, and parties can't track their own position, and ours is pretty simple because we're really capital structure and ROE. That's the problem with the numbers on this document.
No, I understand, and I think the way we're going to move forward on this, we're not going to, we're going to allow Mr. Stevenson to continue his verbal summary. This document is not yet in evidence, but we're going to let Mr. Stevenson complete his summary, and then allow parties their cross-examination. In the event that we conclude that we don't, in the event that we did finish with Mr. Stevenson today, we just want to assure parties that we want to ask for him to be made available tomorrow. So if, as a result of this, any other questions or issues need to be clarified tomorrow, they can be. At this point, we don't feel it advances the process to not allow Mr. Stevenson to present his view of his summary of their position. We understand there's some objections to how he's characterizing other parties' positions, and we'll take that into account and consider that, and of course allow cross-examination on this today and tomorrow if anyone desires it. At this point, we haven't had a motion to enter this into evidence, so if that comes, we'll deal with that as it happens. But at this point, I think we're going to allow him to continue his summary and move forward that way.
Thank you. And I'll just reiterate again, as it relates to each of the amounts on this exhibit, ultimately, the commission will rule on an ROE that will change each of these amounts. The lead lag factor changes these. Whether or not inflation is included changes these. So I didn't mean to show this as kind of the final end-all number. It's mostly just meant for representation of where I think currently we are. So I apologize for any concerns that may have caused. I will say the DEU figures to the right is our case, and that's based on the rate base we have today, the ROE we're proposing and everything. I'll continue on. I think we had arrived at the blue section. These are the areas where we do not have agreement today, and I addressed the projected plant in service. I was going to mention, as in testimony, in my rebuttal testimony, I mentioned 3 very large projects occurring in 2020 that are increasing the projected plant in service over what we have in 2019. And those relate to a $10 million increase to the infrastructure replacement program that Kelly or Mr. Mendenhall discussed earlier today. We also have a $14 million investment to a Kern River Gate Station that will improve reliability to the northern region of Utah, and a $19 million investment to expand the southern system to meet a rapidly growing area of St. George. None of these projects individually or any other projects have been opposed by the parties in this case. Reducing the 2020 capital budget included in the test period does not eliminate the company's need to pursue these capital projects, but rather will cause additional strain to the company's cash flow and credit metrics as it invests in this needed capital. Moving on to line 14, the removal of inflation. In calculating the non-labor O&M expenses to include in its 2020 test period, the company used inflation factors provided by Global Insight, a firm that independently calculates inflation specifically by FERC account for regulated operations. This method has been approved in prior rate cases the company has filed, dating back to the same method used in the Rocky Mountain Power case in docket 0703593. And the company has not departed from that procedure. The office and the UAE do not include inflation in their test period, and as such, I believe fail to reasonably represent conditions that will be in place during the test period. Referring to Exhibit 3.4R of my rebuttal testimony, I provide an exhibit or a look at total O&M expense, even after including inflation. So 3.4R of my rebuttal testimony, looking at column E, shows the total adjusted level of operating and maintenance expense in the 2018 base period at $124,440,000. You can see on column G, the forecasted total O&M that we've included in the 2020 test period is actually $100,000 less than the 2018 base period. And so in effect, all of the effects of inflation we have adjusted out of the case ultimately through savings adjustments that I've detailed in my testimony as well. Looking at that same exhibit, I would just point out on row 15, this hasn't been a huge topic in this discussion, so I just wanted to highlight the large savings we've included in the test period for 2020, which amount to $7.2 million of labor-related savings in 2020, and an additional $1.1 million of non-labor savings were made possible by expenses that the company has incurred in 2019, but did not include in any test period. And shown on row 15 of my exhibit 3.4R is $15.3 million of severance payments that were incurred in 2019 to enable $7.2 million of ongoing expense. And the company has not proposed to defer or amortize any portion of the expense it occurred to enable those savings going forward, but it has included 100% of the savings. So as such, I believe that our O&M level is appropriate. Ultimately, is slightly lower than 2018 O&M, and as such, I don't believe a reduction related to inflation is necessary. And then referring to the pension credit, all I'll say about the pension credit, I think we had plenty of discussion on that just a few moments earlier by Mr. Felsenthal. But I would just reiterate that removing the pension credit from 2020 does not reduce the amount of non-pension O&M that the company has to pay, or rather, including a $5 million pension credit does not result in excess cash of $5.2 million that the company can use to offset other O&M expenses. And as such, the cash drain that introduces into the company, we believe should be addressed and removed. And then related to professional services, these have also been referred to throughout testimony as LNG-related services. The company does not agree that these professional service costs should be removed from the 2020 test period. The company has several large projects that will occur in 2020 that rely on such professional services as were included in the 2018 base period. While the 2018 base period expenses related to an approved LNG facility, the professional services in 2020 will relate to other projects occurring in 2020 that are part of ongoing distribution operations. And then the final two rows here relate to cap structure and return on equity that have been addressed by other witnesses, so I will not delve into detail on those two issues. And this concludes my summary.
Mr. Stevenson's available for cross-examination and also commission questions.
Okay, thank you. I'll go to the division first. Mr. Jetter, do you have any questions for Mr. Stevenson?
Mr. Stevens, I do have some questions regarding an exhibit that's been passed out. I don't know that it's been entered into the record yet, but the exhibit that's at least marked as DEU Hearing Exhibit 7 under the column entitled DPU. DPU is intended to represent the Utah Division of Public Utilities. Is that correct?
Correct.
And the revenue deficiency or surplus calculation in this model assumes no adjustments from the filed position of Dominion Energy Utah for any of those blank spaces. Is that correct?
Right, that just indicates that I think the division included a statement that if it were silent on an issue, that doesn't imply that it agrees or disagrees with any given issue, and so I've just left that blank in those cells.
Okay, and that negative 342,688 calculation is based on those cells being calculated as a zero value?
That is.
Okay. And would you agree with me that that may not represent the revenue deficiency or surplus recommendation of the division?
I agree. I don't know that it's on the record what the final bottom line is from the division. I just tallied up everything that was on the record.
Okay, and so that number doesn't reference to any division testimony?
I'd say because it's a sum of the other numbers that are on testimony, I think it is derived from testimony. However, if the division would like to, I guess, update, obviously wouldn't argue if you'd like to include other adjustments to the table that haven't been included in testimony.
Okay, thank you.
I don't know if my attorneys agree with that, but.
Those are the only questions I have. I don't actually have any cross on your testimony otherwise. Thank you.
Thank you.
Okay, thank you, Mr. Jetter. Mr. Moore or Mr. Snar?
Yes, thank you. I'll proceed with the caveat that we may have to do a little work tomorrow in case I miss some things. Thank you.
As we said, we'll accommodate that with this witness.
Good afternoon, Mr. Stevenson.
Afternoon.
I'll ask you some questions, and it's basically...
We're not picking up your microphone, sorry.
Oh, I'm sorry. Let me ask you some questions. I'm basically trying to clarify where we are in the sense of whether or not the office and Dominion have found resolution, or to help identify the issues where we haven't found resolution. And so that's the intent of my questions. Let me work through a few of these to see if we can progress with that. First of all, isn't it true that the individual adjustments that you have presented in this hearing exhibit, at least for use in your summary here, that the individual adjustments are somewhat dependent on the order in which you make each adjustment in your model, including ultimate adjustments to ROE?
Yes, that is true.
And so you wouldn't be surprised then that the office might disagree with many of the individual representations of value or numbers here in explaining their position in response to you.
Yeah, that's true. And just to get into a little more detail, each time O&M changes, for example, there's a cash working capital component that enters into rate base. So if you have not yet updated the cash working capital factor when calculating the adjustments, there would be a shift. That also goes with return on equity because that is applied to that rate base. And so there's steps that if you do it in a different order, it could shift slightly. I don't think it'd be a huge shift, but it would have an impact.
Okay, thank you for that clarification. Let's focus for a minute on plant in service. I'd like to direct your attention to your rebuttal testimony at lines 67 and 68. You have that there?
Yes.
In those lines, you suggest that Ms. Ramos's proposed adjustment to plan and service should be denied because she does not assess any of the individual projects themselves. Isn't that what you said?
Right.
Isn't it true that the detailed list of plant projects making up your ultimate 2020 budget was not included in the company's original filing?
The 2020 individual projects were not included in the original filing.
And it wasn't really provided to other parties in this proceeding until you presented your testimony in rebuttal. Isn't that correct?
Actually, no, I think we did provide several data requests on September 5th or around early September in response to the Division of Public Utilities that included individual projects accounting for the total change from the 2018 capital budget to the 2020 capital budget. I think it amounted to 66 some odd million worth of capital projects individually specified.
Now, I'm not sure if I'm focusing on the right data requests, but I believe some of the data requests that you provided related to plant projects during the time frame you represented also had caveats that this was not the final budget and not the final list. Isn't that true?
I'm not sure. I'd have to check the data request.
All right. Isn't it true that the actual level of 2018 capital expenditures was $212.2 million? And I believe you have an exhibit 3.09 that reflects that.
Let me just check that number. The actual capital spending in 2018 was $212 million.
And while we're there, the actual actual and projected capital expenditures for 2019, they were expected to be $232.4 million. Is that right? On that exhibit?
I'm sorry, are you referring to my direct exhibit 3.09?
Yes,
And you're referring to 2014?
2019, excuse me.
Oh, I'm sorry. So my exhibit 3.09, I don't see a 2019 figure on this.
Let me,
double.
maybe I've referenced the wrong number here. Let me look at that for just a minute.
But I do know offhand that it is around 233 million total in 2019.
Thank you, that's all I needed to know. And with respect to 2020 test year, isn't it true that we're looking at what you're projecting or forecasting to be $277.7 million?
That's correct.
Okay. Isn't it also true that the functionalized categories associated with the company's requested capital expenditures for the test period differ significantly in the company's rebuttal testimony from what was initially proposed?
The functional categories meaning?
The functionalized categories associated with each of the capital projects.
I think I know where you're referring to. If I recall, Ms. Ramos includes a table in her testimony that includes categories of capital additions that differed by subcategory. And I'd agree that there were changes between categories. I think in total, the overall change from 277 million went up slightly to 278 million with the update. Yeah.
So I was going to kind of build to that, and I wasn't going to ask you to comment on her exhibit, but you've reviewed that exhibit, and are you acknowledging that some of the shifts that she portrays there are in fact based upon the numbers that were initially provided and then later provided by the company?
Yeah, the original numbers came from a capital budget that was prepared in the fall of 2018. And at the time we provided my exhibit, my rebuttal exhibit 3.1R, we had updates to projects that caused shifting in those numbers. And I would add that's a typical experience for us as we move throughout the year, that there are updates to project costs.
All right, thank you. Let me move to the transponder issue, and I appreciate that you've indicated some, perhaps coalescing on something that might work, but at least as presented in your exhibit, I don't think we're close on our numbers yet. So let me ask a couple of questions so we can highlight the issues here. Isn't it true that the costs associated with dismantling and removing transponders that occurred during the period from 2016 through 2019 were booked to either construction work in progress 107 or to plant in service 101 as the new transponders were installed?
That's correct.
Okay. And isn't it true that the company has agreed that the amounts booked to plant in service should be reduced by the dismantling costs for the old transponders in order to avoid a double counting as those things are rolled up in the company's filed case?
Yes, so that's where, when I looked at the 101 balance, so sometimes I refer to plan and service as 101, which encompasses all the sub-accounts, including transponders. And it's true that as we adjust the dismantling costs and move costs out of the 101 to the 108, that it impacts both sides. The 101 account will drop as well as the 108, so there's a neutral impact on rate base through that accounting entry, and the 101 drops as a result. When I reviewed that, I looked at the total 101 balance as it relates to transponders to review, is it at a sufficient level and does it need to be adjusted? And based on my analysis of transponders, we are at an appropriate level because there's a construction work in process factor included in the 101 that removed 29% of all transponder additions. And in reality, transponders do not remain in construction work in process. So we used a system-wide factor similar to how we did dismantling and to how we did proceeds. We used system-wide factors. We also used a system-wide factor for construction work in process that should not have been, I mean, if you're doing a specific to transponder adjustment, that one should be updated as well. And I understand that that's probably a lot of moving parts to describe verbally, so I'm happy to write it down as a journal entry. We have a pad as well, if that would help. I could write it out, so I don't know if that'd be helpful, but.
I think that might be helpful. You wouldn't be surprised that our number crunching of those same concepts aren't coming up with exactly the same numbers.
Yeah, I'm happy to write it down and we can, I can share that with you.
Okay. We can do, as long as we get that so that I can have my witness look at it
Okay.
overnight, that's fine. We don't need to spend time writing it down right now.
That's fine.
Thank you. Let's turn to cash working capital now. Both the office and the division questioned the appropriateness of the lead lag study that the company included in its original filing. Isn't that correct?
That's correct.
And then after reviewing the division's recommendation through the division's witness, Mr. Thompson, as I understand it, the company agreed to accept his recommendations. Is that right?
That's correct.
Now, and I understand, I believe that making those adjustments, the lead lag study that the company now supports results in a reduction of the net lag days from 7.358 days as initially proposed to a negative 0.828 days as you run that through the company's model. Is that correct?
Right.
All right. Now, isn't it true, and again, I'm trying to focus on where we differ with where you are right now, isn't it true that after accepting the division's suggested recommendations, that the company's lead lag study still seeks recovery of amounts associated with depreciation and deferred income taxes?
Yes.
Isn't it also true that amounts associated with depreciation and deferred income taxes do not involve an actual outflow of cash being made by the company?
So I believe in my direct testimony, I address the issue of both of those things, depreciation and deferred income tax. And I also included a reference to an individual named Haney. I think it's Robert Haney, who discusses that particular item. And the cash flow with depreciation actually occurs upfront when the company invests in the asset. And what happens is depreciation expense is then recognized going forward. And I believe that the problem arises where as depreciation expenses occur, and that increases the accumulated depreciation balance, there's a period of time where there's a lag between when the 108 or accumulated depreciation has been booked and when you actually collect that depreciation expense from customers. And so because we have a revenue lag that's meant to recoup the depreciation expense related to that asset, we receive the impact of that depreciation expense, or the 108, 30 some odd days after the actual entry has occurred. So our rate base is always 30 days too low because the 108 change happens right away at the end of the month, and the revenue associated to that happens 30 days later. So I believe that's the answer to your question as to why there's a cash impact.
So we may still be at odds on that point, but we'll address that. Would you accept, though, subject to check, that if the commission decided to remove or exclude the amounts associated separately with depreciation and deferred income taxes, that might result in the lead lag study that the company now supports being adjusted such that the negative 0.828 days would actually change to a negative 0.905 days?
I reviewed Ms. Ramos's exhibit showing that impact and agree.
Okay. On non-labor expenses, I do recognize that the company is indicating that you're going to reflect a reduction of O&M expense by $601,333. Is that right?
That's correct.
And just for the sake of clarity of issues, that's without the office and Dominion coming together on whether these inflation factors ought to be applied in that area. Isn't that correct?
Sorry, could you repeat your question?
The adjustment of $601,000 is a reduction you're planning to make, but just to point up what's still at odds between the office and the company. The office still believes that the way the company has applied certain inflation factors is not correct. Do you understand that to be the case in terms of where the issues are still?
Yes.
Okay. And in reviewing some of the non-labor expenses, would it be accurate to say that the company, if we look at the 2018 results and then look at some of the individual non-labor expense items, that for some of the actual or forecasted experience that you've had in 2019, that there may be still some decreases that the company will reflect in individual items? Isn't that right?
So you're saying, looking at the 2018 actual results for certain O&M items,
and comparing it to where you're coming out in 2019, aren't there still some individual items where you're showing a decrease in the expenditures in 2019?
That's true. In fact, going back to the exhibit that I referred to in my summary that summarizes our O&M projections, you'll see that we have included a reduction in 2019 of 1.9% in O&M expenses overall. So yes, certain items have been reduced in 2019.
Okay, thank you. I was going to ask some questions about the accrued audit fees, and I think based upon your summary, we don't need to touch that, so we can put that one aside. With respect to the EDIT amortization, you indicated that the company is supporting a 12-year period of amortization, that UAE is supporting a 10-year, and the office is supporting a 5-year amortization period. Am I accurate in what you said?
Yes.
And I think, without going into the numbers, whatever, the office will concur with you that those are the differences in terms of where the issues are.
Yes.
Okay. Now, with respect to the professional services in the company's application, certain outside services fees were included in the 2018 experience, particularly related to the approval of the voluntary resource decision, the LNG application. Is that correct?
Correct.
You've indicated that that's representative of ongoing efforts year to year, and the office has taken the position that those events are really non-recurring events, or at least infrequently occurring events. Is that correct?
I believe that's the positions, yes.
Today you testified that there may be additional individual regulatory proceedings or projects related to plant or whatever. Do you have more specific information about what you're suggesting that we ought to consider?
Sure. For example, just a few, December 1st, we filed a new filing for expansion of service into Eureka that currently does not receive natural gas service. That particular effort will include special services, professional services. And in addition to a lot of these, I believe that as you look at the kinds of services that were included related to the LNG costs, these are very common shared type services for all kinds of projects, engineering analysis, legal work. If we require those kinds of services for those projects, I don't see the basis in removing those particular types of costs from the test period in 2020. So Eureka is one example. We plan on filing another docket related to HB 107 bill that passed earlier this year at the legislature, which is directing the gas, or the intent is to direct the gas utility here in the state to pursue clean air type projects. That is also special type projects that will be included in 2020 efforts that will require these type of special services as well. So.
Now, were these projects you've identified today previously included in your testimony or in the company's initial application?
I don't believe I got into detail as to specific projects.
All right. Subject to looking at this a little more carefully and perhaps doing some more work tomorrow, that'll conclude my cross for now.
Thank you, Mr. Snar. Major Kirk.
Yes, sir, thank you. I do have a few questions. Good afternoon, Mr. Stevenson. First, I'd like to direct your attention to the...
I think we're not getting you on the microphone.
Can you hear me now? First, I'd like to direct your attention to DEU Hearing Exhibit 7. And line 19 on there reflects a revenue deficiency surplus calculation. And for FEA, you have that calculated negative $4,872,595.
Right.
Earlier, you said where parties have not taken a position, those are reflected as blanks on this sheet. Is that accurate?
That is true.
And so just because FEA hasn't taken a position on items 3 through 16, that negative 4 million is calculated as if those are zeros, even though they're blanks. Is that correct?
That's correct.
So if FEA did take a position on some of the other parties' positions and join them in briefing or adopt those in our briefing, that number would ultimately change. Is that correct?
Yep, I'd agree.
Thank you. Next, I want to ask you a couple questions about the capital expenditures. In your testimony, you indicated that there was some planned capital expenditures in 2020. Approximately how much is that?
Total is 277 million.
277 million. The company hasn't yet spent that money, correct?
That's correct.
And if hypothetically the commission ordered a different capital structure than what Dominion has proposed, those expenditures could be funded through debt or other methods of financing, right?
Well, first off, I think whatever the commission chooses to ultimately approve doesn't necessarily line up with what actually the company's funding. For example, currently the company is using 60% equity in its capital structure, and we project in 2020 it will be 60% equity. We've proposed 55% equity to this commission. So what actually ends up being funded does not necessarily line up with the order that comes out of this case.
So you'd agree then the company has discretion to choose how to finance those capital expenditures?
Sure.
And those could be financed through long-term debt instead of capital expenditures, correct?
Well, I think however you choose to fund those, it would still be a capital expenditure and would require a return to capital issuers. And so, yeah, I'm not sure if I understood your question correctly, but.
As far as where the money comes from, that could be from debt or from equity.
Sure.
Even though they're a capital expenditure, you don't necessarily have to use equity to pay for it.
Right.
Thank you.
Well, sorry, you just said it could come from debt or from equity, but we'd have to use equity to pay for it. I think how it works is whatever the ratio of debt to equity is, that mix of capital is what's used to pay for it. So in our case, we're projecting actual equity will be funding 60% of the total capital budget, and 40% would come from debt. We've proposed 55-45 for the sake of rate making in this case.
So to exhibit 3.31, your cost of capital worksheet, so you could take a look at line 20.
Okay, yep.
And on what's labeled as column E, proposed, there's $203,257,107 there. Is that the proposed amount of, what does that number represent?
That number represents the projected amount that will be in place in our 2020 test period.
The projected amount of what?
Of common equity, specifically in account 211, miscellaneous paid-in capital.
And that would be essentially additional funds from shareholders put into that account in 2020, is that correct?
Yeah, that would be, I believe so. That's the definition of equity, is it's funds from shareholders.
Right.
Yep.
And that money hasn't already been placed in that account? That's just a plan that the company intends to take?
No, actually, that infusion into that account occurred in 2018. I think you can see, as you look at column C, well, let me back up. It was in place at the end of 2018. I can't remember for sure if it happened in 2018 or a prior year prior to 2018. But yeah, it's currently there as of the end of 2018. We project it'll still be in that account at the end of 2020.
But that money hasn't yet been spent on anything.
So I'm not sure I'd agree that it hasn't been spent on anything. I think the equity balance on a balance sheet doesn't necessarily mean that's a cash account waiting to be spent. It's an accounting balance that represents the amount of funding that came from shareholders at a certain point in time, but that doesn't tie to a cash account.
At the end of the day, though, you would agree that the company does have discretion to determine how to finance capital expenditures in the future, regardless of what your actual capital structure is or what your approved capital structure is.
Yes, I believe the company has discretion.
Thank you.
Questions?
That concludes my questions.
Okay,
Thank you.
Mr. Meekum?
Thank you, Mr. Chair.
I'm sorry, can I just correct one thing? I think we are limited in certain activities we take. I just don't want to leave the record unclear that our discretion isn't limitless. We did have to come in and request approval to get capital funding, or our equity percentage up above 55% in a prior docket. That was related to a merger commitment. So I don't want to leave the impression we have complete discretion as to equity decisions we make or debt issuances we make. There is some regulatory proceedings involved with that, so.
Okay. Do you have any follow-up to that clarification?
Nothing further. Thank you.
Okay, thank you. Mr. Meekum?
Thank you, Mr. Chair. Mr. Stevenson, with respect to your exhibit, marked hearing Exhibit 7, with respect the A and GC position, you've got numbers down in row 17, 18, and 19 for us, reflecting the fact that we really only took positions on rate of return on equity as well as capital structure, correct?
Correct.
And where did you get those numbers?
So we have a Excel model that's been filed as part of my direct testimony and also as part of my rebuttal testimony. In there's a cell for the cost of equity that can be changed. And I believe we derived this amount by just changing the cost of equity percentage in the model, and then that flowed through, as well as the capital structure tab within the model that flowed through as well.
So as we've looked at, as my witness looked at his exhibits, he couldn't track the number. As an example, the $1,599,000, that didn't track anywhere to an exhibit. Are you able to document an exhibit that it came from?
No, because it came out of the model, I don't think we have memorialized that change in an exhibit.
Are we to assume, you may be familiar with Mr. Oliver's testimony, but are we to assume that the capital structure or the ROE, or excuse me, the capital structure is 50% equity or 52% equity or 55% equity and 9%? I mean, what are we to assume? So I don't know what you fed into your model.
So as it relates to the capital structure, we adjusted the portion of equity to match the testimony of Mr. Oliver, I believe, and subject to check, we could reconcile where the difference was. It may be that there was a difference in rate base that the equity was applied to. I just have to check and we can reconcile that.
So, to the best of your understanding, you think it's 9.5% ROE and 50%, 50% equity ratio?
I believe so, yep.
And how do you intend the commission to use this document if it's admitted?
As I mentioned, I recognize that the amounts on this document may change as some of these other factors change. The purpose was just to have something to refer to organize a summary that obviously has a lot of moving parts. And so I think ultimately the commission will likely verify the amounts on this, and they'll likely be different based on what other factors are ruled, whether it's a different equity percentage or a different cap structure or a different total amount of expenses. That will slightly shift all of these amounts. So ultimately, when the final order comes out, all of these amounts will need to be refreshed and updated.
Okay. All right, thank you. That's all I have now. We may have more tomorrow.
Mr. Russell?
Turning to DEU hearing exhibit 7, you've got a column for UAE numbers, and I think I'll just note for the commission's purpose that UAE's proposed adjustments can be found in table KCH1S, which is on page 5 of the surrebuttal testimony of Kevin Higgins. Some of the numbers in that table are the same as those that are represented in this position matrix, and some of them are different. I think we can chalk up the differences to the order in which some of the adjustments were made, because as Mr. Stevenson indicated earlier, there's a cash working capital component, and if you make the adjustments in different orders, some of them come out differently. But in any event, if the commission wants to know the proposed adjustments that UAE has put forth, those are found in the surrebuttal testimony that's been pre-filed by Mr. Higgins. And with that, I'll leave DEU Exhibit 7. Mr. Stevenson, we tread a lot of ground on pension expense with Mr. Felsenthal, and I don't intend to go over that again, but there's a couple of points that I do want to get to. I'm not sure if this was in your testimony or somebody else's testimony, or if it was a response to a data request, but there has been some discussion amongst the parties about what the pension expense would have been in the test period 2020, absent the $75 million contribution. Do you recall that?
I do.
Okay. And that pension expense, absent the $75 million contribution, would have been a negative number, correct?
It still would have been a negative number.
Okay. And do you, offhand, do you know what that negative number would have been?
I believe it shrunk to possibly 2 to 3 million.
Yeah, and I think maybe the best way to do this is to go to, it is Exhibit 2.16, OCS Exhibit 2.16, filed with the direct testimony of Donna Ramus. And for those with, and it's OCS data request number 3.02. For those with the electronic copy, it's page 23 of that. It says page 22 at the bottom. It's 23 of the electronic version. OCS 3.02 is the data request. Exhibit is 2.16.
Okay.
And if I wanted to determine what the negative pension expense or the pension credit would be for 2020, absent the $75 million contribution, using the numbers on the table at the bottom of the company's response to OCS 3.02, how would I do it?
So, yeah, I believe what this reflects, so we're on page 22, so this is OCS 3.02, correct?
Yeah.
So what this table shows is beginning in 2017, we had a $75 million contribution level. And we had an assumed return percentage of 8.75%. And so for each year, you can see the $75 million contribution is now worth $96 million because of that compound growth of the 75. So we have a $96 million balance currently related to that contribution. The second column applies the expected return on plan assets of 8.75% to arrive at an $8.4 million credit that reduces the overall service cost or expense in the pension fund. And then ultimately, that pension is allocated down to Dominion Energy Utah, so that becomes a $5.5 million credit. And then of that amount, some of it ends up in capital based on total labor, and some of it ends up in expense. And so the final column is $2.9 million expense value. So I believe that is the amount that the asset is, the $75 million is now contributing to a credit, is $3 million. I would note that in an additional update to this amount, we provided, I believe it's attached to Ms. Ramos's Exhibit 2.07S. There is a data request asking for an update of the forecasted pension credit. It is now $2.8 million rather than 5.2. So these come from a third party, Towers Watson, that runs the actuarial reporting and the return on assets, and provided an update. So that amount may have changed slightly since this data request was prepared.
Okay, I guess what I'm trying to find is if I can figure out what the pension expense would have been in 2020 absent the $75 million. Can you tell me that by looking at this table? I mean, I will tell you that there is another data request. In fact, it's OCS 3.03 that's not part of this exhibit. I can give it to you if we need it, but it references, the question was asked, and I'm paraphrasing, but calculate the pension expense absent the $75 million, and that response just referred back to this data response. So I'm just wondering if you can look at this and tell me what it is, if that's how you derive it.
Yeah, I think we've included a $5.4 million credit in the test period, total credit. If you subtract 2.9 from that amount, you end up with, and I was warned not to do math on the stand earlier today, but we'll round up 3 million minus 5.2, so you'd be at 2.2.
Okay, thank you.
But let me just highlight as well that it's my position, and Mr. Felsenthal's as well, that as long as contributions exceed expense, that asset that exists within the pension account has been funded because the total contribution exceeded the expense. And I believe the assumption is, over the last 20 years plus, is that expense level has been included in our rates. And so that total asset actually came from the excess contributions over what has come from ratepayers. Under that assumption, I think the $75 million is one piece of it. The whole $112 million, though, is still something that our position is came from shareholders. And so whether or not we look at the $75 million or the $112 million, I think the total credit, the story is the same as far as our position is. The whole $112 million sitting in the asset account today came from shareholders.
Well, I think there's some testimony from Ms. Ramos on that position as well, and maybe we'll hear from her tomorrow. Hopefully we'll hear from her tomorrow. Dominion's position in this case is that the negative pension expense or the pension credit should not be calculated or included with respect to the calculation of revenue requirement, correct?
That's correct.
Okay, and the upshot of that is that by not including it, I guess it depends on how I say this. If you include it, it reduces revenue requirement. If you don't include it, the revenue requirement goes the other direction, right?
So I'm going to back up a little bit. If you include the pension expense, yes, you reduce the amount of revenue requirement the company can collect from other operating expenses that it incurs.
And in exchange for Dominion customers being denied the benefit of recognizing that negative pension expense in this case, is Dominion willing to forego seeking recovery of pension expense in the future if and when it turns positive?
Well, so my position on this pension credit, and I don't know that this came out really thoroughly earlier, but as this, we can look at this exhibit we actually have open, OCS 3.02, the data request. That's part of, I can't remember what exhibit we're in, but that data request we just referred to. It's OCS 2.16D. You can see as the return is earned on the funding contribution level, the balance within this account increases, right? So we start at 75 million. In 2020, we anticipate being at 96 million based on this chart. So every dollar of the pension expense, or I'll say every dollar of pension credit stays in this particular account. And the company cannot go into that account and pull money out. And so my position is that this credit ultimately benefits customers in that it prolongs the amount of time before we have it flip back to a positive expense. So if you picture it like a bank, like a piggy bank, and there's a return accumulating and this balance is getting larger and larger and larger, the company's not paying dividends with that cash. It's not taking that cash to offset expenses anywhere. It stays in the piggy bank, doesn't go anywhere. It's true that we have an accrual accounting entry each year, but that doesn't mean the cash went anywhere. It stays in the account. That accumulates and even adds more of a credit, and all else being equal, that balance keeps rising. As long as that balance is rising, the chances that that expense within a pension account is going to flip back to a positive are getting lower and lower and lower, which means customers don't have to worry about expense for a prolonged amount of time. And so I think this credit is benefiting customers as it goes along, even if we're not rating the piggy bank to pass it through each year. The company doesn't benefit at all from that cash being in that piggy bank. I don't know if that made sense, but.
I understand your position. That didn't actually answer my question, though. The question was, I understand it's DEU's position that it does not believe it's appropriate to include the pension credit in rates in this rate case. My question is, when that pension expense flips back to positive, is the company willing to forego including that positive pension expense in revenue requirement in that future test period?
Well, it's hard for me to speculate into future test periods that may occur 3, 6, 9 years from now. I think what we've done is prepared a position based on the circumstances in play today. And if we come back to another general rate case and file a position, we will have to justify that position based on the merits and based on the circumstances in place at that time. I don't think that now is the time to address future rate case circumstances that may be in effect. So,
Okay, so that's not something that the company is willing to commit to right now.
no, I think I wouldn't commit to the treatment of any particular cost in a future rate case.
I'll ask you to turn to line 522, your direct testimony, if you would.
Could you repeat the
Line 522.
522? Okay.
You have a question on line 522, and that question is the company proposing changes to the way pension expense is included in the revenue requirement going forward? The answer is yes, and you identify the proposed changes. And I guess what I'm wondering is if the company is not willing to commit to what it wants to do or what it will propose to do with pension expenses, positive or negative now, when you say going forward, you only really mean this rate case, right?
Right. Yeah, this rate case, which encompasses 2020 and beyond until we file the next general rate case.
Okay, let's talk about excess deferred income taxes for a moment. There was a lot of ink about EDIT throughout this docket, and we've kind of narrowed things down to the amortization period for non-plant EDIT. And I gather, as Mr. Snar summarized, we've got office sitting at 5 years and the UAE sitting at 10 and the company at 12. And I think it might be useful very quickly to kind of talk about what that non-plant EDIT is. And I'll try to do it as quickly as we can because this stuff can be complicated. But excess deferred income taxes are the amount of income taxes that have been collected in rates that are in excess of the company's tax liability going forward, right? I'm being very high level.
Sure, and I'll note we don't have any rider treatment, so we get to collect it in rates versus included in a test period, and then it changes. But yes, it was included in a test period.
Sure, and then because of the Tax Cuts and Jobs Act that was recently passed, there's been a series of SIR credits that the company has been returning EDIT back to customers. And there's been some agreement between the company and UAE's position about a fourth SIR credit. There was also some discussion about plant-based EDIT and how that is amortized, right? In the testimony. Yeah, there is some discussion in the testimony.
Right, for the, I believe it's the 2019 plant-based EDIT.
Right, and there are some very strict rules about how that plant-based EDIT gets returned, and it basically gets returned kind of over a long period of time commensurate with the depreciation of plant-based assets, right?
Right.
Okay, and so what we're left with is this non-plant EDIT where there aren't those strict rules about how quickly that excess can get returned to ratepayers, right?
Correct.
Okay, and would you agree with me that the commission has a fair bit of discretion as to how it can order that non-plant EDIT to be returned over what period of time?
I do believe there's some discretion there.
Okay, in your summary, you indicated that the company believes that a 12-year period is correct, and one of the sort of principles that you offered is that a 12-year period will alleviate rate shock, right? If we return it too quickly, then when it drops off, then rates will go up the year after it gets returned, right?
That's right.
On the other side of that balance, I suppose, that the commission has to consider is the fact that this is money that has already been collected from ratepayers, and it's getting returned over a lengthy period of time. It's not quite as lengthy as the plant-based EDIT, but it's still a fair bit of time, right?
Right, 12 years.
Or 5 or 10, even
or
then.
Or possibly 5 or 10.
Yeah,
right.
even
our position is 12.
Yeah, no, I understand that your position is 12. I'm just trying to lay out the consideration for the commission that the taxes, the rates have already been collected, and it's just an effort to give it back to the ratepayers. But the longer you wait, the less overlap there is from the ratepayers that paid the tax and those that you're returning it to, right?
Sure. Yep.
Okay. Okay, that's all I have. Thank you.
Thank you.
Okay, I think with that, we'll probably adjourn for the day and plan to return tomorrow with the understanding that probably before we go to redirect, we'll give other parties, if there are still remaining concerns over the exhibit or the summary, to ask further questions. I think I'm going to make an unusual commentary from the commission that may help this issue. If it helps to allay any concerns of whether this exhibit that's been passed out would be used for rate-making purposes and in order drafting, we just want to assure everyone that we have our own internal processes and modeling as we work through our decision points, that you know, we wouldn't use this exhibit as a basis for calculations in an order. And there's also the caveat that there's a reconsideration period if we get any math wrong that allows corrections. If that helps, maybe it doesn't, but I know all of you will be thinking about between now and tomorrow whether you want to ask further questions on these issues. And with that, we're in recess. We have a public witness hearing beginning in about 30 minutes, and then we'll reconvene the evidence you're hearing tomorrow morning at 9 a.m.
And Mr.
Thank
Chair, may we talk about order of witnesses? Because we've got, I know my witness has a flight out of here at 5 o'clock
Sure. Do we need
tomorrow.
to stay on the record for this, or can we have the corporate
No,
reporter
we can
stop?
go off the record.
Okay. I think